So guys, our next discussion will be on financial instruments. Sir, financial instrument standard is the base for many standards. Forget about the length of the standard. We are going to do it 100%. But you don't take any pressure of this is a very big standard. 150 questions are there in study material. Don't worry about all that. Go on following the concept. There are hardly some, if you mark the good questions which are worthy of exam, hardly some 20 questions, 15 questions, that two of 7-8 models, model 2 questions, 15 to 18 questions only will be selected. Remaining questions are all small theoretical questions just kept in the study material, make you understand the concept better. But they haven't been asked in the exam till now. Coming in the exam is less likely. Chance is anything, but chance is less. The proper good questions are hardly some 7-8 models. Small, medium and big questions up also 15, 18 is the maximum number of questions which are of examination range. Okay, so don't worry about number of questions. Concept no compromise, sir. You have to understand it organically. Let us start. Ind AS, financial instrument chapter basically culminates of 3 standards. One is Ind AS 30, which deals with the presentation of instruments. Ind AS 109, which deals with the recognition. And last one is Ind AS 107, talks about disclosures relating. A disclosure standard never came till now, and there is nothing much to discuss also in that straightforward standard. For material also it is there, 1.5 page on disclosure. Ind AS 32 and 109 are very important. In fact, Ind AS 32 is a highly theoretical. You don't have much questions of numerical there, they are all theoretical questions. But entire accounting and all will be there in Ind AS 109. Our main standard actually is 109. But before going into 109, to understand this base formation happen without understanding the meaning of what accounting. So first is AS 32 we will talk, then we will 10. Now coming to the definition of financial. Standard says financial instrument is a contract. See, even when you are talking about a contract, I cannot enter into contract with myself, no. So contract has to be entered at least between 2 parties, 2 or more parties should. These people have entered this contract, turning out to be a financial asset for one. The same contract is financial liability or classified as a equity instrument of the other entity. So there is a contract. A contract is a financial asset for one party and financial liability or equity for another party. So the standard directly does not tell you the person to whom or the entity to whom this contract is a financial asset is often identified as the person to whom this is either a financial liability or equity, that fellow is understood as. So I can simply say like this: for a holder, the contract is always a financial asset, but for the issuer, it will be either a financial liability or it will be a. Somebody asks you, somebody talks, sir, we want to learn accounting of financial instruments. Go and read in the standard. There is no accounting for instrument. It is accounting for these 3: asset, liability, equity. 3 components ka accounting is there. Instrument ka accounting and separately we don't have anything. Contract how to account means first fellow will account it like a financial asset. Second fellow should account it like a financial liability or equity. So we have accounting mentioned for those 3 components. Now what is a financial asset? Sir, the definitions I have given here are abridged definitions. Some more points are missing, but whatever missing points are there that I have covered subsequently in the standard. Whatever definition, are shortcut definitions. They are important. Shortcut definitions. Remaining portion is covered inside the standard, because if I put the definition also, I will not be able to explain that without knowing further concepts. So listen here. Financial asset is any asset is cash. Cash is always a financial asset. Equity instrument of another entity, another company ka equity that is an asset for me. Our asset should be classified as a financial asset. I am A Limited manufacturing company. I have extra money. I purchased equity shares of Infosys Limited. So another entity ka equity instrument is an asset for me. Then this is classified as a financial asset. Next one. There is a contractual right. Our entity has a right. What right? To receive cash or any other financial asset from another. If I have a right to receive money from somebody, or if I have a right to receive any financial asset from somebody, then this right also is a asset. Cash, bank, these are financial assets. Equity shares of another company which is an investment for me, that is also a financial asset. Right to receive money, right to receive financial asset is also a financial asset. Right to receive money example is what, sir? Debtors, bills receivable, investment in debentures, investment in bonds, they are all right to receive money. They are all financial assets. What is right to receive financial asset? Any other financial asset? Simple. I have invested in a convertible debenture of some company. A company will pay me coupon for 5 years. At the end of 5th year, they will not pay me my money back. Rather, my bond is converted into 100 equity shares of them. So when I am a holder of a convertible bond, what all rights I have? I have right to receive cash for a period of 5 years, and at the end of 5th year, I have a right to receive equity shares of that company, and equity shares of other company is also a financial asset. No, therefore, right to receive equity shares of other company is also a financial. The entire bond is a financial. Next. A contractual right to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. Simple example for this is, let us say you entered into some derivative contract or option, futures, short position. Now the maturity, suppose let's say I have taken a long position. This contract means what, sir? I agreed to buy some share on a future date at a predetermined price. Normal forward contract entered on stock exchange. Maturity date is after 2 months, but today is my balance sheet. As on today, if I compare, I agreed to buy 200 market low futures. A contract had I entered today, I would have to agree to buy at 270, but I already agreed to buy nicely at what rate? 250. If I close this contract today also, square up also, then also some potentially favorable gain is there for me. Then this futures contract, the favorable position, whatever you are having, or what if the futures contract instead of favorable position, you have an unfavorable position. You square up this contract today, suffer a loss. Potentially favorable to the entity are financial assets, unfavorable to the entity, we treat it as financial. Get out of this contract, you will receive money. If you get out of this contract, you have to pay money. If I am going to receive money, asset. If I am going to pay money, liability. Coming to financial liability. Financial liability is any liability, that is, now financial asset, 3 points are there: cash, equity instrument of another entity, contractual right to receive cash. First point, second point are not there. Contractual right to receive cash is an asset. Contractual obligation to deliver cash or deliver financial assets to another entity is a financial liability. A third point of asset is opposite. Contractual right place, so we are now having contractual obligation to deliver cash or to any other financial asset to another. Next. To exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable. Imagine you are a writer of an option. After writing the option, you know that you are losing money, but you did not square up, you are still holding it. What is going to happen, sir? Likely, you are going to suffer a loss. Either you have to deliver shares to the other party at a lower rate, or you have to pay cash and get. Okay. Favorable situation. There is another point that we will directly discuss now. Coming to equity instrument, normal definition. Sir, in any company, there will be assets, there will be liability. Hypothetically assume all the assets are sold off. With that money, all the liabilities are repaid. Still some money will be left. money means who is having a right? That fellow is having that right because of a paper. Some people are having right on the residual amount because of a paper. No? That paper is called as. Now read the definition in the background. Equity instrument is any contract that evidences a residual interest in the assets of an entity after deducting all its. Should the company get liquidated, after paying all the liabilities, remaining whatever is there, on that who is having right? All those people are equity instrument holders. Clearly here, basic definition. Now, what are the examples of equity? Obviously, the plain ordinary equity share of the company. Plain ordinary equity share of the company is definitely a equity instrument. But if you observe the characteristics of equity share of a company, plain ordinary equity shares, some characteristics are there. What are they? Number one, no fixed period. If a equity share of any company, did the company promise you that they will deliver you a particular return? No promise of income. The company never promises that they will 100% pay you dividend every year. No promise of repayment. Company can buy back. No, sir. Company may buy back. You don't have a right to ask money from the company. Give money, they'll give you share. If you don't want to sell the share, but you cannot ask the company to pay you money. You cannot ask the company to declare bonus shares to you. You cannot ask company to declare dividend for you. You don't have any. Directly, company does not have any obligation to repay or to give you any return or to commit a fixed. These are all the characteristics of sale. These are also the characteristics of any instrument which is fulfilling these points be classified as instrument. Look at one example. Irredeemable preference share, discretionary dividend. Since it is irredeemable preference share, there is no promise of repayment. Since it is discretionary dividend, there is no obligation to pay dividend. The company may pay at its own choice, but it does not have obligation to pay. Similarly, I can give you some examples on convertibles also, but I will talk about it. So, any instrument which cannot create the obligation of returns, obligation of repayment of on the entity, all such instruments also will become. Equity instrument does not mean only equity share. Many instruments are there classified as equity. We'll talk more, we'll see more examples that go further. Identification of whether it's a financial asset or financial liability. Okay, you can talk from this. Bank balance is a financial asset. Trade receivables, financial asset. Advance given to suppliers. What will supplier give you back? Money. No, goods or services he will give you. Contractual right to receive cash is financial asset, not goods, not financial asset. Bills receivable, financial asset. Inventory, non-financial asset. Because inventory is not a right, no, it is a. The inventory does not have any right to receive cash. Once you sell the inventory, it either become cash or it will become debtor. At that time, it is a financial asset. Before sale, inventory is a non-financial. Investment in debenture. Pakka financial asset. You need not even ask whether it is convertible or redeemable or nothing like that. Pakka, this is a financial asset. Investment in equity shares. By definition, it is a financial asset. Investment in convertible debentures, of course. Prepaid expenses. I paid money, but in future I am not going to get money. I am going to receive some PP asset, but not financial. Damages receivable in court case. We fought in court. Court said, yes, you deserve money. The opposite fellow pay him 100 crore. The legal right. not a contractual. Insurance claim receivable. Insurance is a contract only, no? Pakka financial asset. Creditors bills payable. Obligations, a contractual. Loan taken, deposit accepted, debenture issued, they are all financial liability. Tax provision. Legal statutory obligation but not a contractual obligation. He and Nirmala aunty did not enter into any contract. Because I am born in this country, she is looting. Security deposit accepted, financial liability. Outstanding interest is a financial liability. Financial guarantee is also a. Now, in CA when we studied provision standard, contingent asset, contingent liability ke example is guarantee. Case 20. You do Ind AS 37, we'll discuss all examples except guarantee, because guarantee is no more a contingent liability. Guarantee has to be accounted as a real liability in accordance with AS 1. Next, there is derivative coming. So, what's the definition of derivative? From AFM, what do we understand? A derivative is any contract which derives its value from the value of its underlying. So, the value of this contract is dependent on something else. If something else is dancing, the value of this contract also will dance. That is same definition here also. Two extra points are there. First point is there is no or less initial investment. Talk about any derivative, the quantum of investment will be zero or it will be negligible. Futures contract investment is not there. Margin money is a security deposit. Forward contract investment is not there. Options kit is there. Compared to the contract value, premium is a very, very small amount. Next, value depends on value of the underlying. That's a point. Yes, such contracts are to be settled on a three conditions for a. In the material, just like that, I have given different type of derivatives. What is the meaning of long position, short position? You enter into any derivative contract and you want to exit out of the derivative contract, how to do, all that I have given here. But all that you must be knowing from your AFM. Sir, you have taken a forward contract for 3 months maturity. After 1 month, you want to get out. Agreed to buy dollar. Originally, you agreed to buy dollars after 3 months. Now 1 month is over. You want to exit. What will you do? Take opposite position. Enter into another forward contract for 2 months period with agreement to sell dollar. This is called as prematurity settlement. Same is there in forward, same is there in future also. Last question. Sir, I purchased a call option with 3 months maturity. I am a holder of a call option. After 1 month, I want to get out of this. I am a holder of call option, or I have a long call position to get out of this. Short call, sell off the call option or become a writer of the option. Not take put option. To exit out of an option, in the same option, opposite position you have to take. You should not take opposite nature option. That is wrong. Instead of getting out, you are putting your leg in something else also. So, you know that much, that should be. Options, when you enter, there is some status. So status is what? Single, fitted, ready to mingle, but nobody is looking at me. Like that, here also 3 statuses are there. In the money, at the money, out of the money. In the money means on a particular date, when you compare the exercise price in the option with the prevailing spot price, if you feel that the option is likely to be exercised, we call it as in the money. Compare with prevailing market price and strike price in the option, exercise price in the option. Option is likely to be lapsed, we call it as out of the money. They both are equal, we call it as. Suppose I have a call option. Strike price 100. Maturity not today. Maturity is after 2 months. Strike price 100. Today market letter share price 140. Market lo share price 140. Paper I have a right to buy the same share at 100 rupees after 2 months. Yes, sir. What is the chance of this option getting exercised? High? Very high. Because market price is not 102, 103. 140 rupees. Option is not just in the money. It is deeply in the money. Deeply in the money means high chance of. Important, sir. There are questions on that word, deeply in the money. Okay. Now, let it be any contract, including derivative. it has to be fitting under either financial asset or equity instrument or financial. There are only three categories. Financial instrument and general accounting is not there. You have to fit any contract into FA, FL or equity. Now, sir, derivative, how to do accounting, sir? How to do accounting for derivative? It depends. Depends. Derivative may be classified as financial asset. Derivative may be classified as a equity instrument, or derivative can be scoped out of this. Not covered under Ind AS 1. Derivative have got four fates. Either it will become FA, FL, equity, or get out of this standard. So why I have to write that again specifically is because I gave the definition of derivative after explaining FL equity. You should not think that derivative is also one more category. No. There will be three categories: FA, FL, equity. Derivative should also fall into either of those. By the way, while discussing definition, I told you, you enter into a derivative contract. On the balance sheet date, you understand that the derivative contract is very favorable to you. This becomes financial asset. The derivative, if you close right now, you have to pay money to somebody. Financial liability. If regarding third and fourth category, examples will come. Coming to the first aspect of our discussion was definition. This is contracts entered on non-financial assets executed in. I'll give you a small example. In that everything will be covered. Later on we'll quickly see the chart and move. A agreed by 100 kgs of at rupees 50 per kg, 3 months. No. A and B entered into a contract. A decided to buy wheat after 3 months. Price is already decided. Sir, do you all agree that this is a forward contract? Where is dollar, sir? Underlying asset is dollar. Here underlying asset is a commodity. Tell me, sir, wheat is a financial asset? Wheat. Non-financial. This is a contract entered on non-financial asset to be executed in future. Directly what I am trying to tell you is a derivative product. Derivatives are covered under the standard, no sir. Derivatives are covered or not only we are talking, because a doubt why I got is here underlying asset is not share of a company. Underlying asset is not currency of a country. Underlying asset is what? Non-financial asset. When you are doing a derivative transaction on a non-financial asset, is the derivative in the scope of our standard or not? That is our discussion. We are not going to learn the accounting of this. Our objective is just to understand whether 109 is applicable for this contract or not. If it is applicable, how to do accounting? Then we will do. Case 1. We think only from A Limited point of view. A Limited's objective obtain physical delivery 3 months time to meet own usage requirement. So after 3 months, what will A Limited do is, fellow will pay 50 rupees per kg into 100 kgs cash. He will pay full 100 kgs wheat physically. He will take it. He will use it for his own business purpose. Again, he will his business. He will sell it, or he will further process it, or something he will do. This is the only case where standard is not applicable. Scoped out. Sir, why is it scoped out? But this is a derivative contract. This gain or loss possibility is there. 100%. The objective of A Limited is hit that gain or loss. The moment you call it as covered under Ind AS 109, you know what will happen in hindsight. I am telling you, you have to go and apply FET. If you apply FVTPL, what will happen? On every balance sheet date, I have to keep on fair valuing it. Whenever I fair value, what will happen? Gain or loss will come. A gain or loss, I will take it into my PRL. If I take it into PRL, it will impact my EPS. When my goal is not to make the gain or loss, why do you make my EPS dance on every balance sheet date? And it is not applicable. And it is not applicable. You understanding what I am trying to say? Why they have scoped out is this fellow's intention is not to make gain or loss out of that. Gain or loss will be there eventually, because after 3 months when I am paying 50 rupees per kg to him, I know market price is not 50, market price can be 47 also, it can be 55 also. Gain or loss will be there, but his goal is not gain or loss, his goal is to obtain speculative motive, so he did not enter into this contract. The intention is not speculation. Why will you burden your P&L account with unnecessary fair valuation? Scoped. Case 2. Contract will be closed by way of net cash. What is the meaning of net cash settlement? Suppose at 3 months, market price of wheat per this per. We are A Limited. We agreed to buy at what rate? 3 rupees per. Tell me, sir, are we in a gaining position or losing position? I agreed to buy at 50 rupees. Market price is 65. Market higher price is there. I am happily buying it. I am gaining, no? Into 65 rupees of wheat, I am able to buy it into 1500 rupees gain I made. What will happen is, he will pay 1500 rupees. Or what about wheat? Wheat is only a joker there. I used wheat as a base to do my betting transaction. A Limited told that B, after 3 months, wheat price will increase. We told that much seen is not. Ultimately, I won. I lose, I will pay you money. This is betting transaction. Here, end result, transaction is happening in what? Cash. Cash is a financial asset only, no? Definitely covered. Is covered under speculative transaction, derivative, end result is cash. Happily, you will apply equity. Derivative account is separately we will learn. Timing or understand the scope is only to know whether it's covered or not. Sir, what if there is an option? Option means after 3 months, A Limited, if it wants, it can do physical delivery. If it wants, it can choose net cash settlement. Option is there. That case, how will you handle? It says, when the contractual option is there regarding the mode of settlement, then you should check the past history of settlement in similar transaction. How did A Limited close similar transactions in the past? If majorly substantial transactions are closed only by way of physical delivery, even though insignificant transactions you might have done cash settlement, but predominantly you should have done physical delivery only. In that case it is. But if I check in the past, 30% of the transactions you have done net cash settlement. 30% is not insignificant. 30% may not be major. 30% is not significant. In that case, creative move. Now also, then close by way. When it is scoped out is 100% physical delivery like case. Or option is there, when you look into your past history, almost all transactions, substantially all transactions you should have done in delivery, although few insignificant cases you might have done that case. In this, one more smart case is there. People who are extremely ultra smart. A Limited, sir. He is not at all connected to wheat business and all. He is doing some electronics business. But he entered into the above contract. Net cash settlement is not there. Only physical delivery is there. At 3 months time, what will happen is, this fellow will purchase 100 kgs of wheat by paying this 50 per kg. He will take the delivery, 100% physical delivery. After taking delivery, what will he do with this wheat? Is he into wheat business? He is into electronic business. What will he do with wheat? There is only one option for him. What is that? To sell the wheat. So whatever wheat you are buying in the contract, 3 months time, that you have to definitely sell it. When you sell it, you will definitely get a or is in substance net asset. Physical delivery only, but after taking physical delivery, you don't have position to hold this because you are not into that business. What will you do? Whatever price is there in the market, you will sell it off. This is in substance asset. For example, market price is 65. What will happen now? Purchase at 50 today, spot live will sell it off. Net gain is how much? 10 rupees per kg into 100 kg. Is as good as the case law. First, even though you are taking physical delivery, your intention is still relational. Buying from him, selling to somebody else. Net cash settlement means buying and selling to the same party. For that, why to buy, why to sell, directly cash will. Net cash settlement, indirectly net cash. So, overall moral of the story is, objective must be only to obtain physical delivery to meet your own usage, purchase, sale requirements. If you have any hint of speculation in your mind, it is wrong. That is all tabulated in this. First dabba, if you see, contract is settled by physical delivery, and physical delivery for own usage, sale or purchase in the ordinary course of business. Such objective exists throughout the period of contract. 3 months contract, first day physical delivery objective should be there. Throughout 3 months also it should be there. Any time mindless speculation and idea comes, 109 will come. Sir, how will 109 know that I got that idea? Sir, you should not understand standards like police and you are thief. Do not try to escape. We are talking about accounting is based on intention. If intention is physical delivery, don't apply equity. Your intention is speculation, get it. Exempted from 109. Coming to second one. Contract settled only by net cash settlement of gain or loss. Or contract entered is for the purpose of delivery only. But selling the commodity in the market immediately for a also deemed net settlement. Object situation pakka covered under. Finally, option exists to obtain physical delivery or net cash settlement. This check the today's intention, history of past settlements in similar contract. Some people ask me, sir, what if history he never entered into this kind of contract? The first time. You cannot check history simple. You are in the process of creating history. So current intention you see based on that you account. Ultimately also if that only happens, like that some 2 or 3 contracts if you do, 4th contract you have a history. Past is not there, what can you do? Past will get created. Not do anything. If it can be established that objective to obtain physical delivery, so cash settlement was done in insignificant cases. Also you are right. What is that? Is that? Turn back. Contracts to be settled in own equity instrument. Here total 6 points are there. The moment these 6 points conceptually we cover, take almost Ind AS 32 is over. Of Ind AS 32 will get wind up in 5. This is the most important thing in your study material. Almost on 40-45 theory questions are there only on this point. Out of these 6 also, main one is first. Understand F2F test, rest all are extremely. F2F test you should. Simple, sir. Whatever standard says, our company has entered into a contract. The contract is to be settled in own equity What is the meaning of own equity instruments? Our company has to issue our shares to somebody, or somebody will give our shares to us only. Like in a buyback case. Buyback case, what will happen? Shareholder will surrender our shares to our company only. Or you enter into a convertible debenture kind of a contract. What will happen? We have to deliver our equity shares to somebody. We are now talking about contracts which are to be closed by way of own equity instrument. In this again two categories. Category 1, where we have to deliver our shares. Case 2, somebody will deliver our shares to us only. This first case we are talking where we are going to issue our own shares. That most important aspect. What our standard says is, in any contract, there will be a consideration. Since you are going to issue shares, some number of shares, what our standard says? Consideration ka value is value of consideration fixed, and number of shares to be issued, this is also fixed. When we say that F2F test is passed and this contract classified as equity, so you will classify this kind of contract as a total equity instrument. F2F test is passed. Consideration, our company what it has received or it is going to receive, a consideration of value amount should be fixed. The shares what we are going to issue, our shares ka number should be fixed. Fixed wording is common, but what is fixed you should clearly understand. Consideration ki value should be fixed. Shares ki number should be fixed. If these two things are fixed in any contract, a contract is like yes. Or what if any one of them is variable? Either top one is variable or bottom one is variable or both are variable. In this case, contract will be financial. So, if you remember our starting discussion, the financial instrument contract will become financial asset for one party. It will become either financial liability or equity for the other party. So, for this fellow, clarity is there. If you are a holder, you will happily account it as a financial asset. But if you are an issuer, your accounting is dependent on how you classify it, and you have two possibilities, either equity or financial liability. So we are discussing when it will be equity, when it will be financial liability. Contract, just because contract is going to be settled in own equity shares does not mean that the contract is in. Hence, F2F test is passed, only it becomes. Now, focus on the examples. There will be some 5 or 6 examples now. If 5 or 6 examples end, you will clearly have total idea. Sir, a company has issued convertible debenture, raised return. The terms are will be converted into 1,000 shares. So these people paid me 10 lakh rupees. After 5 years, these debentures outrightly will be converted into fixed number of 10,000. You observe closely here. What is the consideration for the company? Of course, received already, and this is obviously. And what about the number of shares? Issued or to be issued? To be issued. If it is already issued, why will I call it as convertible debenture? That is outrightly equity only. To be issued about the discussion. Number of shares to be issued is 10,000 numbers. That is also. Now that these two are fixed, this particular contract classified as a own equity. Sir, how does it matter? What is the name of this venture? Classification. Will it stay not under non-current liabilities borrowings? It will not sit at the top equity heading. To understand, sir, place where you sit change depending on who you are. Your owner is on the top, outsider bottom you use. Sir, if stupid F2F test if you pass, why will it become equity instrument? Full point. Look at this. At year 5, market price of 120 rupees. Tell me, sir, to this shareholder, to these investors, how many shares we have to give? 10,000 shares. What is the worth of the shares we are giving to them? 10,000 into 120. That is how much? 12 lakhs. If you are an investor, are you happy or sad? You gave 10 lakhs to the company. After 5 years, they are giving you shares worth 12 lakhs. You are okay, not extremely happy. Why? Actually, opportunity interest also is there, no sir, but you are okay. You are not very happy, but you are not sad also. Market price is 180. Then the worth of the consideration what you are receiving as an investor is 18 lakhs. Definitely, you are happy. Company performed well, you are dancing. Company performed extremely well, 250 rupees. Startup completely invested, became gold. So 10 lakhs became 25 lakhs. Happy tears. Worst performance, 15 rupees. They are shouting. Whoever fellow recommended this stock to you. And the fortunes of the investor directly linked to the performance of. Sir, he is happy and company is not going to pay anything yet, or he is going to pay anything. When share price increases, who will dance? Shareholder will dance. Shareholder. These investors are shareholders, sir. They are debenture holders. They are also dancing. Name debenture, heart, soul. Like how equity shareholder prays that company should perform well, also, even though he is a debenture holder, daily going to temple. Price should. And it increased, he is happy. Price falls, he is sad. Same feelings. You are not outsider. Your shirt name is debenture, inside heart. Classified as equity. Safe risk objective. Suppose, same convertible debenture, I received 10 lakh rupees. I told these people that at year 5, equity shares worth 15 lakhs will be issued. If you see from company's point of view, consideration is 10 lakhs fixed. By the way, just to remind you, you should not understand this as consideration. This is consideration ultimately for whom? Investor. You are not doing accounting for investor now. Doing accounting for the issuer company. Issuer company point of the consideration is 10 lakhs that is fixed. Just because the number is changing, don't think that that is variable. Variable for whom? Investor. We are not doing accounting for him right now. We are doing accounting for issuer company. Consideration company with 10 lakhs fixed. Coming to the number of shares to be issued. Tell me, sir, how many shares I should issue? 15 lakhs worth divided by on the day whatever is the market price of it. Tell me, sir, the number will be fixed or will it change? Change depending on market price of the share. Now let us say market price of the share is 10 rupees. How many shares I have to issue? 1 lakh Market price of the share is 1000. 1500 shares are sufficient. Market price of the share is 200. Means how many shares I have to deliver to the other fellow depends on number of shares to be. Not fixed, it is variable. But number of shares to be issued is variable. If you have tested on instrument will be and shall. Look at this. Irrespective of how many shares you give, high number of shares you give, low number of shares, whether your company is performing extremely well, your company is performing bad, I investor face any which way his return is fixed. That fellow who accepts fixed return, how can you call him as a equity instrument? Ka fundamental characteristic is what? There is no promised returns to you. That fellow who is taking promised return cannot become owner. Outsider are asking for fixed return. Invested 10, you will get 15 lakh rupees form of share. No, so this is classic case of a here till here. X Limited, right say call option on its own 100 equity. Face price. That's it, sir. There is maturity period. Maturity. Tell me, sir, what is the meaning of call option? Call option will give a right to. Call option will give a right to buy or seller. Right to buy. Who is having call option? Who is the holder of call option? Limited rights means how can X Limited be holder? Stupid people. Y Limited is a holder. Who has a right to buy? Y has a right to buy. If that fellow has a right to buy, who has an obligation to sell? X Limited. From X Limited point of view, observe, I have an obligation to sell my own equity shares, not some other company shares. Since the underlying asset is our own equity, it won't be like selling equity shares. We'll be issuing equity shares to him, provided the other party is going to exercise the option. Am I clear here? Think from X Limited point. What is the consideration? 500 rupees per? No. Number of shares. Sir, why will we issue? We do not know whether option will be exercised or not. That uncertainty will anyway be there. But in case the option is exercised, we have an obligation to issue shares and they are fixed or variable. 100 shares, fixed, no contract rate is written. Fixed. Number of shares to be issued is fixed. Amount of consideration going to be received is also fixed. F2F test is passed. Therefore, this instrument is classified as a, here you see an example of a derivative getting classified as own equity. Favorable derivative, underlying asset, some other company ka share or currency, in that case, financial asset. Unfavorable, financial liability. Underlying asset is own equity instrument plus F2F test should be passed. Then it is classified as equity instrument. Derivative contract, underlying asset wheat to be obtained only by way of physical delivery. The derivative is scoped out. Derivative all four we have seen. Okay, next one. That is X Limited. There is another company, Y Limited. In this Y Limited, there are some shareholders. These shareholders are holding 100% shares in Y. 4 shareholders. Total amounting to 10,000 shares. Today, X Limited makes a deal with these shareholders. Deal is, at 6 months' time, they will give me their 10,000 shares in Y Limited. And as consideration, I will pay to them 5,000 shares So, Limited point of view, I want you to answer whether this contract to buy shares of Y Limited after 6 months by issuing our own 5,000 shares. The contract equity are. It's a very simple test. Our test is very simple. You have 2 points, no? One, consideration. The other one is number of shares we issue. How many shares you have to issue? This is definitely whatever consideration. Fixed or not fixed? Not fixed. Why? Consideration it's not about the number, it is a value. The 10,000 shares ka value after 6 months will I know today? Every day it will change. It depends on the market price of Y Limited share, isn't it, sir? So this is your test. Okay. Last example and then we're done. Last example is X Limited, let's say call option Y Limited. This price is equal per share. X Limited will issue 1,000 shares sales in year 1 100 crores will issue 2,000 shares sales in shares. So consideration per share in a way is fixed, 50 rupees per share. But number of shares to be issued is linked to some target condition. The target here, sales target. Now, how many possibilities are there? Either I will be issuing 1,000 shares, or I would be issuing 2,000 shares, or I would be issuing 3,000 shares. Number of shares to be issued is 50. Number of shares to be fixed. Standards guidance on this. You have to see that the target conditions are there, no? They are independent conditions, interdependent conditions. What's the meaning of independent or interdependent? How will you know? Simple, sir. Ask yourself. Can I fail first condition and still pass second condition? Is it possible? Not possible. The question. Can I fail first condition? Until my first year sales less than 100 crore. I failed. But second year 150 crore. Can I pass second like that? In that case the company has to issue how many shares? Can I fail first one, second one and still pass third one? Can I fail 2 and 3 can pass first one? Each condition can be satisfied independently of the other condition. No, sir. Is what? Is the contract law, whatever 3 situations are there, each situation is independent. It is as good as there are 3 contracts. There are 3 contracts. I'll tell you. This blue color part, whatever you are seeing, is the base, is common for every contract. First contract only up to here it is. Second contract E box is. Third contract third box is. There are 3 contracts and each contract number of shares is. For a single contract, no sir, how are you saying there are 3 contracts? Since the conditions are independent conditions, instead of writing all 3 situations in one contract, even if you have given him 3 separate contracts also, not have made any. Each contract number of shares is fixed. As contract is like. Okay, sir. Suppose I change like this. Same question will change. I make all this year 1 only. I'll give you 1000, 2000 or 3000 depending on first year sales. First year sales is 100 crores, then I'll give you 1000 shares. 150 crores I'll give you 2000 shares. 200 crores I'll give you 3000. Now all the sales, earlier it was 1, 2, 3. 3 different period ka targets. This time it is same year ka target. Tell me sir, can I fail first condition and pass second condition? Possible? Huh? Can I fail 1 and 2 and pass third one? Is it possible? Huh? Are interdependent. Targets are interdependent targets. Since they are interdependent targets, you can't tear them into 3 pieces and 3 contracts in a single contract. It cannot be split. In a single contract, 3 possible outcomes. Pakka number of shares. This is way. You all understanding or gone? Sir, this is important stuff, sir, because questions are there. See, exam is getting complicated, guys. Exam is getting really complicated. You don't know where, which question, how they will ask. There are a lot of untested questions in the study material. There are small questions, never came in the past. True. That does not mean that they will not ever come. You should be prepared for conceptual. Everything you should prepare. Important questions and all, past exam questions, more important. Sir. So, last example. So that is the last one. Okay. So there is Exit Limited, issued convertible debenture, amount received 10 lakh. It told that the debentures will be converted into equity share. The ratio of 1:1. 10,000 debentures are 1:1. If converted at 1 year time, 2:1. If converted at 4:1. If converted at, the company gave a choice to the investor. See, you paid me 10 lakhs, give you 10,000 debentures. Debentures will convert into equity shares. Or how many shares? Depends on when you are coming to. Come to me at first year, 10,000 equity shares. Come to me second year, 20,000. Come to me third year, 40,000 I will give you. Now, how will this company treat this debenture? Is it equity or liability? Liability. Consideration part is fixed. Tax varies. Number of shares to be issued, fixed or varies. How fixed? Well, can you come in the first year also, second year also? You can come either in the first year for conversion or you can come in the second year for conversion. Tell me, number of shares to be issued is changing, sure. But is it based on market price of the share? Is your returns fixed? Did I promise any particular return to you? Number of shares is linked to uncertain event. If I tell you that I will issue shares worth rupees 15 lakhs, then I am linking number of shares to what? Market price of uncertain variable. But here I am linking it to a certain event, not uncertain event. Certain event. What is certain event? Sir, we study or not, May exam will come. Time is certain, no sir. No matter what, time is certain. So, there is uncertainty in this. I am not promising any returns. I am not guaranteeing any returns. So, is predominantly that is all about our fixed to fixed test. Now, after fixed to fixed test, next discussion is on compound financial instruments. Now, what is the meaning of compound financial instrument is? A compound financial instrument is an instrument which has the characteristics of both equity, also a financial liability. That means it's not completely equity and not completely financial liability. It has the characteristics of both equity as well as liability. Let's quickly see some examples. So imagine there is a redeemable preference share. A company issued preference shares. These preference shares are redeemable after 5 years. So since definitely we committed to pay the principal amount after 5 years, there is an obligation to pay cash. Since there is an obligation to pay cash, there is a financial liability readily. But every year, whatever dividend I have to declare, that dividend is not mandatory, the dividend is discretionary. Since dividend is discretionary, it is just like the dividend on equity shares, where our company has a choice whether to pay or not. That means the distribution part, the dividend part is discretionary, but the principal amount is mandatory. That means there is a component of equity, there is a component of financial liability. Overall, we will call it as compound financial instrument. Another example is, we have issued a perpetual bond, perpetual debenture. That means irredeemable bond. That means the principal amount on the bond will never be repaid. Principal amount will never be repaid. But every year, mandatorily interest has to be paid. So since principal amount you need not repay, that portion is similar to your equity shares amount, because equity also we don't have obligation to repay the amount to equity shareholders. Likewise, these debentures also you need not repay. So that is the equity component. But interest every year we have an obligation to pay cash, so that becomes a financial liability wala component. So overall, this also becomes a compound financial instrument. So two examples we have seen. Now let's come to the third example, which is optionally convertible or optionally redeemable debentures. See, in optionally convertible debentures or preference shares, the option either to convert into equity shares or option to pay cash, the option could be there either with the holder or with the issuer entity. Any of them can have the option. Now, if the holder is having the option to select either cash or shares on the maturity date, if you observe closely, indirectly holder has a right to demand cash also. If holder has a right to demand cash, if a holder demands cash after 5 years of issue of the bond, as a company, I cannot say no. I have an obligation to pay cash there. Since I have an obligation to pay cash there, the principal amount should be treated as a financial liability. I do not know whether he will ask cash or shares after 5 years. But in case he asks cash, we do not have a choice. We have to pay cash. That is called as obligation to pay cash. Therefore, the principal amount should be included as part of financial liability. Now, coming to other scenario where option is there with the issuer entity. The company has the choice whether it will pay cash or issue shares at the end of 5 years or maturity date. Now, in this case, if holder asks cash, I can reject it. Which means what? The company does not have a obligation to pay cash. The company may pay cash eventually, but we do not have a obligation to pay cash. Since I do not have a obligation to pay cash, the principal amount is treated as an equity item. It should not be included in computation of financial liability. More clarity on this you will understand when we do accounting of compound financial instruments. As of now, we are not discussing the accounting of compound financial instruments. We are only talking the examples of CFI. So, debentures which are convertible or redeemable, either at the option of the entity or at the option of the issuer, these are compound financial instruments. Both are compound financial instruments. Now, here some people ask me a very interesting doubt. The doubt is, the interest on these debentures is mandatory. Every year you have to pay. Principal amount, so since interest is mandatory, this is definitely part of financial liability. In the first case, principal amount also we are including it as a part of financial liability. So, interest is also understood as financial liability. Principal amount is also understood as financial liability. Then how come it is becoming a compound financial instrument? Should it not be total financial liability in the first case where option is there with the holder? No sir, it is still a compound financial instrument because there is a equity element. Now how equity element is there? Listen, normally if a company issues plain redeemable bonds, how much coupon rate, how much interest the company should pay on that bond depends on the credit rating of the company, market interest rates and all. Imagine there is X Limited. A company, if it has to raise money by issuing redeemable bond, it should offer an interest rate of 14%. Redeemable bond. But this company managed to offer bonds only at 11%, but they are not redeemable bonds. They are convertible or redeemable bonds at the option of the holder. So what I am indirectly trying to say is, whenever you bring a conversion feature into bonds, the company will not pay 14% coupon rate. They will reduce the coupon rate. Investor also knows that he is not getting 14%, he is getting only 11%. He is willing to forego that 3% because he is getting an option to select, and in case after 5 years on the maturity date, he believes that, the investor believes that by taking the share conversion option, whatever he lost 3% per annum over the next 5 years, that plus some extra amount also he is going to get. That means option is given to the holder but not freely. There is a cost a holder has paid. What cost? He choose to accept 11% coupon each year instead of 14%. So from a company's perspective, if you see, normally when I raise a borrowing, I should be paying 14% coupon. But here I am paying only 11%. So by showing my equity shares, by giving him an option on my equity shares, I have managed to reduce my interest burden from 14% to 11%. This 3% whatever I should have paid normally, but I am avoiding right now, is the equity component. That is how equity creeps into the picture. Therefore, any which case, whether option is there with the holder or option is there with the entity, any which way, it is a compound financial instrument. Chalo, next case. Next case is called as contingent settlement provision. On this, there is no question, no example from ICAI side, but still standardly it is there, so we are discussing it. Contingent settlement provision means, it is just like the same example. Sir, I have issued a debenture. I told the investor that these debentures will be converted into equity shares after 5 years if market price of the share crosses 500. If it does not cross 500, then I will pay you cash. That means debentures will be paid in cash or will be converted into fixed number of shares, not at the option of the holder, not at the option of the issuer, but based on some contingency, uncertain future event. So based on some uncertain future event, if the settlement of this contract is linked, then our standard guides that you better treat it as a financial liability. Because you do not know what will happen, and if you call it as equity, you will not be accounting anything for the next 5 years. So you call it as a financial liability and do the accounting of financial liability for the next 5 years. That is the guidance given under the standard. Next. These are the cases where a company has to issue our own shares to the other party. Next we come into the category of other party will give our company ka shares to us only. In this first example is buyback. So you all know buyback accounting from your inter days. So buyback, what is the accounting that is prescribed? Okay, don't go into the share bought back account and all. Simple accounting, if I should tell you, the entry will be this. Cancel the equity share capital. Make the payment of buyback price. This will be recorded at face value. Here buyback price, so you should write this entry. Whatever extra amount you pay, that is premium on buyback, that will be adjusted to your reserves. This is a broad entry. This is with the amount of premium on buyback. This is exactly what is given under our standard also. The standard simply said, whenever a buyback of equity instrument happen, adjust it through equity. The term equity means he is not talking about an account, he is talking about a category equity. You have done schedule 3 already. Equity means what, sir? Equity share capital also, other equity also. So all your returns and surplus are part of other equity. So entry is this only, but broadly we'll write or show like this. When you're really passing journal entries, you should write this entry. Let's say this is about buyback. So a pretty simple case. Then there is another case, but which in the recent study material they removed it from the study material, so you need not bother about this. This is nothing but written put option by the company on its own equity shares. Imagine, sir, put option means what? An option which gives right to sell. A put option our company has not purchased, we wrote this option to the other party, underlying asset our company shares only. That means the other party, the counterparty, has a right to sell our company ka shares to us only. So indirectly, we have an obligation to buy back our own shares on a future date. Even this is also a buyback. Only thing is, earlier what we discussed was a straight buyback. This is a kind of optional buyback. Through option route buyback. Accounting will be more or less the same thing, but this example is removed from the study material in the last revision. So there is no point of discussing it. Although if you want, you can go through the entries, you will definitely understand it, but go through this entries after covering 109. Next, coming to treasury shares. The term treasury share means, though in India it is not permissible to do this, outside India many countries so this is permitted. What happens is when a company is having surplus money, they would like to park this money in some investment. Instead of buying some other company ka share and all, this company what it is doing is, it is buying its own company ka shares. So instead of buying some other company ka share, I buy my own company ka shares and I hold it as an investment. Later on, whenever our company ka share price increases, I will sell off the shares in the market. So trading in own equity shares is called as treasury share transactions. Okay. Now, what this standard tells is, whenever a company purchases its own shares and holds it without cancelling them. If you cancel them, it's buyback accounting. If you buy your own shares and you hold them without cancellation, then such shares you cannot show it as an investment in your balance sheet. So then what should I do? You should adjust it to equity. Adjust it to equity means what? Just like buyback accounting you did, same thing you will do. For example, you went to the market. You purchased your own company ka shares by spending 1000 rupees. So entry will be this. Equity share capital account debit, face value, to bank purchase price, gap whatever is there, reserves and surplus to adjust. Share capital you will reduce, reserves you will reduce. You will not show it as an asset. But asset is there with you. E shares you are only holding. They are not cancelled, but accounting you will write like this. Subsequently, when the shares are sold, simply reverse the entry. Bank account debit, selling price, to equity share capital, restate the face value again, reinstate the face value again. Whatever extra money you receive, park it in reserves and surplus. Let's say I sold it for 1400. I purchased it for 1000. I sold it for 1400. So there is a profit of 400. Our 400 naturally will get adjusted into reserves and surplus. This is the treatment of treasury shares. Now again, on treasury shares in this chapter, you don't have one question or one theory question or one discussion also. Nothing is there. But standard law concept is there. Later on when we do a standard called as Ind AS 33 EPS, in that one application of this is there. If you do not know this here, there you will face a problem. So you should learn this. That EPS wala question is an MTP question. So that is important also. So this concept now is also important for us. Next. Coming to remaining small point discussions in Ind AS 32. One is transaction cost. What is the meaning of transaction cost? When you buy a financial asset or when you sell a financial asset, when you raise a borrowing, financial liability, or when you repay a borrowing, when you issue equity shares, this process lo you incur some incidental expenses. Brokerage, processing fees, stamp expenses, these kind of things. These are called as transaction cost. Ind AS 32, this present standard, covers treatment of transaction cost relating to equity instruments only. Our own equity instruments, whatever are there, our own equity instrument related transaction costs are covered in Ind AS 32. So what is the treatment? You incur any processing fees or any transaction cost in relation to equity instruments, that should be adjusted in equity only. Don't take it into PRL. Sir, adjusting in equity means what? Adjusting in equity means what? Equity is a category. Under equity we have equity share capital, other equity. Obviously you can't adjust it to other equity share capital with the amount of transaction fees and all. So you have to adjust into other equity. Other equity means what? So many reserves and surplus items are there, you have to adjust there. Generally retained earnings will be adjusted. Sir, what about transaction costs relating to financial assets and financial liabilities? Transaction costs relating to financial assets and financial liabilities will be accounted as per the accounting methods discussed in Ind AS 109. In next 5-10 minutes when we start Ind AS 109, there it will be covered, sir. Okay, continuing further. Accounting for equity instruments. See, entire Ind AS 109, which we are going to start now, that entire Ind AS 109 deals only with accounting of financial assets and financial liabilities. Regarding equity instruments, there is no specific accounting given there. The only item or only principle relating to equity accounting is given in Ind AS 32. That is that line what you are seeing there. What did they say? Any contract or instrument which is classified as equity will be measured only at its initial value. First time you will record that at some value. That's it. It will stay put in the balance sheet at that value forever. Subsequently, there is no remeasurement for that equity item. So that is the guidance given related to equity. Own equity items should not be remeasured or fair valued again. Coming to interest and dividends. Though financial assets, financial liabilities accounting is covered under Ind AS 109, income on financial assets, expense on financial liabilities, where you have to account is covered under Ind AS 32. So financial assets ka income, that means the dividend income or interest income on your investments, that should be recorded in your PRL. Similarly, on financial liabilities, whatever expense, interest, dividend expense you incur, that also should be recorded in PRL. Correction is there for financial liabilities printed as income, please make it expense. Next, interest and dividend on own equity instruments. On your equity share capital, if you declare dividend, that's an equity item, sir. Equity item related payments should not be routed via PRL. So the discretionary dividend what you pay on your own equity shares should be adjusted directly into equity. That means retained earnings to adjust. Finally, there's one last case. What is that? I have financial liability. On that financial liability, I made a discretionary payment. So financial liabilities means if you make any discretionary payment, for example, I have a redeemable preference shares with a discretionary dividend. So prima facie, overall it is a compound financial instrument, but preference share ka principal amount is a financial liability. The dividend portion is not financial liability because that's a discretionary payment. Suppose in a particular year I paid dividend on such preference shares. That dividend should be adjusted in retained earnings. Reason it's a discretionary payment. It's not a cash obligation, it's a discretion. Something which is not obligation should not be treated like a liability and going into PRL. It's a discretionary payment, so there is an equity nature in that. Adjust directly into retained earnings, avoid PRL. Discretionary payments will never go into PRL. Next, coming to offsetting principles, meaning you have a financial asset and you have a financial liability. When you have a financial asset and financial liability, can you present a net financial asset and a net financial liability? Can you offset them? Simple example, I am A Limited. I sold goods to a company called X Limited. So X Limited is my debtor now. He owes me 1,000. In some other transaction, I owe to the other company 400. So I have a receivable of 1,000 and payable of 400. Same party. I am A Limited, he is X Limited. The question is, I have a debtor, creditor, both same parties only. Can I show net debtor of 600? 1,000 receivable, 400 payable. Can I show net receivable of 600? Can I offset them? The standard says you can present them on net basis if and only if settlement on net basis is legally permissible. If me and X Limited wants to settle on net basis, legally it should be permissible. It is permissible in our example. So that is first condition. Second condition, the parties should have intention to settle on net basis. Just because I have a receivable and payable with the same party, it does not necessarily mean that we will do net settlement. Sir, why not? Reason, I have a receivable which is due tomorrow morning, whereas this payable I have to pay after 3 months. Tomorrow morning the debtor comes and gives me 600 rupees. Why will I accept this? I'll say I have to pay you 400 after 3 months. 1,000 you have to pay me today. Why will you deduct 400 and pay me 600 today? Not acceptable. So just because legally it is permissible, parties will not do net settlement. So if both the conditions are satisfied, then only you can do presentation on a net basis. That is a guidance given. Now coming to next aspect, foreign currency convertible bond. As such, not very important, but on this a small carve out is there. Correctly observe. Our company has issued bond. But this bond is not issued in our local country. It is issued to foreign investors. Money is raised in foreign currency. So face value of the bond is $1. And this bond happens to be a convertible bond. Now, case 1. Bond is convertible into shares at year 5. For the purpose of conversion, issue price of the share is $0.20. So issue price of the share is given, means indirectly number of shares on conversion is also given. So if I ask you number of shares to be issued, $1 is the face value of the bond and issue price of the share is $0.20 per share. So if you process this, you will get 5 shares. So instead of directly telling you that one bond is convertible into 5 equity shares after 5 years, I am telling you that issue price is this. If somebody fixes the issue price like this, indirectly they are also fixing the number of shares to be issued, which means F2F test is passed. If fixed to fixed test is passed, this is classified as a equity instrument. That's the whole point here. Clear, ma'am? Now this is case 1. Look at case 2, much more interesting case. Same story, but issue price of the share is not $0.20, it is ₹20 per share. So issue price is not mentioned in foreign currency, issue price is fixed in our rupee currency. In this case, if you work out number of shares to be issued, $1 divided by ₹20 per share. You cannot cancel it right now unless this dollar is converted into rupee. That means for this conversion you have to take a exchange rate also into picture. Exchange rate on which rate? After 5 years, whatever exchange rate is there, that exchange rate I have to take. Numerator will come, divided by 20 rupees, some answer will come. Imagine exchange rate after 5 years is 120. In that case, I have to issue 6 shares. If it is 140, I have to issue 7 shares. If it is 80, I have to issue 4 shares. That means the output, the number of shares what I have to give is basically now becoming variable. Since the number of shares to be issued in this case is variable, ideally F2F test is failed. Now that F2F test is failed, the instrument should be classified as a financial liability. Correct? Absolutely correct. This entire thought process is in line with IAS 32, which is international standard. But India's 32 law, our country has taken a carve out for this case. What we people say is, even though the number of shares to be issued is variable, you will still treat it as or call and classify it as a equity instrument. We will not treat it as financial liability in India. Now what could be the reason for this? The reason is very simple, sir. The number of shares is variable because do I want to pass a particular return to the investor? If that was my goal, why would I fix the issue price first of all? If I am fixing the issue price of the share, it means that the intention of the company is to give you fixed number of shares only. The company is not interested to deliver a particular kind of amount to you at the end of 5th year. I am not trying to protect the returns of the investor. If I try to protect the returns of the investor, then this instrument is not an equity instrument. Here I am not trying to protect it, because if I was trying to protect the returns of the investor, I would have told you that I will issue so many number of shares depending on market price of the share after 5 years. I did not say that. I fixed the issue price. The moment I fixed the issue price, this is a proof that I am not trying to protect the returns of the investors. So that is true, but still the answer is variable. See sir, what is the nature of the bond? It is a foreign currency bond. Foreign currency bond, obviously dollar rate will fluctuate. Just because dollar rate is fluctuating and my number of shares are fluctuating, you should not forcibly call me as a financial liability. because my intention is never to protect the return of the investors. If my intention was to protect their returns and my plan is to deliver some fixed return to them, I would not have fixed the issue price. So in India, we took a carve-out, and even though the answer is variable, we still call it as equity provided issue price should be fixed. So ultimate summary is, if issue price is fixed, whether in foreign currency like the first above example, or in functional currency or local currency 20 rupees, any which way, if issue price is fixed, then the instrument is categorized as a equity instrument. So that is the story for our Indian scenario. Internationally, second case is classified as a financial liability. Then that leaves us with puttable financial instruments. Only theory questions are there. Once Ind AS 109 is over, we will try to cover this subject to time availability, sir. So this is all about your Ind AS 109. Sorry, Ind AS 32. Sorry. Now we'll move on to Ind AS 109. So sir, now that we have finished with Ind AS 32, we'll move on to Ind AS 109. In 32, one small point, sir. There are some scope exclusions from the standard. The scope exclusions, many are there, but this is the most important one. Normally, investment in equity shares of other companies is a financial asset as per definition. So, investment in equity shares accounting is definitely covered under Ind AS 109. Detail is given, very easy also. But if you have an investment in equity shares of subsidiary, associate, joint venture, 100% that's a financial asset. But accounting of that is not covered under this standard. It is covered under separate standard called as Ind AS 27. So, investment in equity of subsidiary, associate, joint venture, separate standard is there. This is not under the scope of financial instruments chapter. Sir, why is it not there? Simple, sir. In financial instruments, we will ask them to measure at fair value through profit or loss. But subsidiary investments are not held for sale in the near future and all. Long-term business purpose, we make investment in subsidiary. So when anyway I am not going to sell, why should I fair value? Why should I hit my P&L account with that fair value fluctuations is what companies will argue. So in Ind AS 27, cost choice is also permitted. That's why it's moved on to Ind AS 27. It's not covered under Ind AS 109. Okay guys, now coming on to Ind AS 109 officially. Ind AS 109 will be very interesting, sir. This is all about accounting of financial instruments. Pure accounting stuff. Anyway, broadly the story is this. There are three methods, sir, of accounting. One is called as amortized cost method. Second one is called as fair value through profit or loss. Third method is called as fair value through other comprehensive income. Total there are three methods. For a financial asset, all the three methods are possible. Don't misunderstand it as options. Which method you have to apply, that depends. Again, that is further discussion is there. But all the three are possible. ACM, FETPL, FETOC. When it comes to liability, only two methods are possible. Either you should account it under ACM or you should account it under FETPL. Two methods are possible. Now, what we will first learn is the ground rules of each method. How to apply ACM, how to apply FETPL, how to apply FETOC. Once we understand the ground rules of each method, then our further discussion becomes very, very easy. When to apply which method, all that was very easy, provided you know the method first. Now coming to the first method. First method is amortized cost method. ACM, which we call it as. Initial recognition of a financial asset or financial liability under this method should be done at fair value adjusted with transaction cost. What is the meaning of fair value adjusted with the transaction cost? Imagine I purchased a bond in the market. Bond I purchased for 100 rupees, but I also paid brokerage of 2 rupees. So 100 rupees is the fair value of the bond, 2 rupees is the transaction cost. A rule says that initial recognition should be done with fair value adjusted with the transaction cost. 100 plus 2. 100 is also outflow, 2 is also outflow. Add both of them. Entry will be investment in bonds account debit to bank 102, 102. This is one example. Example number 2. I took a loan of 100. I paid processing fees of 1.5. So loan ka fair value is 100. Transaction cost is 1.5. Now loan adjusted with transaction cost. Loan received cash inflow. 1.5 paid outflow. Net 98.5. Entry will be bank account debit to loan liability 98.5. So fair value adjusted with transaction cost means sometimes you have to add, sometimes you have to minus, depending on whether you have both cash outflows, both cash inflows, or one cash outflow, one cash inflow. Depending on that, the adjustment will happen. Second, under this ACA method, interest income or interest expense should be measured on effective interest rate basis. Effective interest rate basis means this is nothing but IRR. IRR to you have to measure, but instead of calling it as IRR, our standard uses the term called as effective interest rate, because IRR on a word means internal rate of return. We are only talking about returns there, and returns you will earn only on assets. But for liabilities, we can't use the word return. No, it is an expense. So instead of using the word IRR, the standard uses a neutral word called as EIR. Next, there will be no subsequent remeasurement. So first initial day you recognize fair value with transaction cost. At the end of each year, you recognize interest income, interest expense based on EIR, and on balance sheet date, you will not subsequently fair value it. There is no fair valuation under amortized cost method. See the name cost, subsequently there is no fair valuation. That's all. ACM is only this very important method. Come to next method. Next method is fair value through profit or loss. Profit or loss. So as the name itself indicates, a proper fair value method. Initial recognition of a financial asset or financial liability should be done at fair value. Not transaction cost, only fair value. Sir, so when I buy an investment 100, paid brokerage 2, entry will be investment to bank 100. Sir, brokerage I paid, you paid, but that will not be added to investment cost. That will be booked as expense in P&L account. Directly 2 rupees, throw it off into PRL. So fair value method, fair value through profit or loss, directly fair value you should record, expense should be transferred to PRL. Next, you should not be applying any EIR method in this case. EIR method you can apply only in ACM and FET-OCA, not in FET-PL. Coming to on every balance sheet date. In ACM, what did we discuss? On every balance sheet date, there is no subsequent remeasurement. But in the fair value method FET-PL, every balance sheet date you have to fair value your financial asset or financial liability. The resulting gain or loss should be recognized in PRL. That's it, sir. So that is about FET-PL. So ACM is done, FET-PL is done. Now the third method is FET-OCA. 1 second, guys, some disturbance here. Yeah, coming to FET-OCA. Initial recognition will be same like ACM, which is what? Fair value adjusted with transaction cost. Interest income also should be measured at EIR only, just like in the case of ACM. In ACM, we used the word interest expense or interest income, but here it is only interest income. Interest expense you should not use. Why? FET-OCA is not applicable for liabilities. FET-OCA is applicable only for. Coming to the third point. ACM, the third point is what? No subsequent revaluation. But here the method name is what? FET-OCA. Definitely there is a valuation. Pre-balance sheet date you have to do fair valuation, and whatever gain or loss comes, that will be shown on in OCA reserve. P&L account OCA section is there. There you once go and say hi. Our reserve will again go into balance sheet OCA. It is also pakka unrealized. FET-PL ka gain or loss also is unrealized. FET-OCA ka gain or loss also is unrealized. Clear, sir? But that will go into PRL. This will go into the OCA section of whatever gains or losses you are accumulating in that reserve. Today it is unrealized, but in future one day they will become realized. When they become realized, our reserve will be either reclassified to PRL or directly merged into retained earnings. That depends. That clearly here. I have given some examples on how to apply ACM. I just want you to go through detailedly one example at least. Follow on the screen and take you through. A Limited has issued 9% debentures of the face value ₹100 each at 5% discount. So issue price is not 100, issue price is only. These debentures are redeemable after 3 years at par value. So issued at discount, redeemable at par. What is the coupon rate promised? 9%. show the accounting in the books of A Limited by applying. Tell me, sir, every year the coupon rate promised is 9%, but the company cost won't be 9%, it will be definitely more than 9%. Why will it be more than 9%? Because I did not issue at par and I am not going to redeem at par. I am issued at discount and going to redeem at par. I received 95 but I have to pay 100. I extra 5 rupees whatever I am paying, that will increase my cost even further, isn't it? So, even though 9% is a coupon rate, your effective interest rate is something. Effective interest rate in this sum, it works out to 11.048. An example only, I have given it here. How to solve that? AFM you might have learned. A trial and error basis you have to work out. It is definitely more than 9%. Try at 10%. See whether the present value is equal to becoming 95 or not. Won't become. Try at 12%. It will go below 95. Go sit, do interpolation. It will fall somewhere between 10 and 12%. Came to 11.0. Okay. Observe the first rule, sir. What is the first rule of ACM? Initial recognition should be done at fair value adjusted with transaction cost. Transaction cost in this case are not there. So directly I am recording this at 95. At the end of first year, you have to pay interest to the investor. Promised interest. How much is promised interest? 9%. A 9% you have to apply on what? Face value of 100. But before you make that contractual payment, accrual basis lo first recognize interest expense. What is the entry for interest expense? Interest expense account debit to. Once upon a time we learned to bank. If you don't pay, we used to write payable. This time you will not do either. You will directly credit this to the financial liability. Interest expense account debit to financial liability. With what rate? EIR rate. So you have to cancel. You have to apply this entry. So when you do that, 95 into 11.048% is giving you 10 point. So this is your overall liability. Out of this, some liability you are paying now in the form of contractual coupon payment, which is 9 rupees. Remaining is still the first year ending. So this there is no revaluation. No, so the 96.5 balancing figure will be there. That will as it is flow into next year. Next year ending, again recognize a dummy interest expense. Whatever you promised that you pay, again there is a closing balance. That closing balance will again come to next. Again recognize interest expense. Again pay. This time since it is the last year, coupon also, redeemable value also. Total you pay. The moment you pay that, account should be. So there will be some approximation error that you will adjust it in this. Last year interest expense, take the effect of balancing. The entries are important, sir, because examiner these days they are asking this. Interest expense account debit to financial liability, financial liability account debit to bank. Interest expense to financial liability entry is for interest expense recognition. Financial liability account debit to bank is for payments made. A payment may be coupon, a payment may be principal amount, does not matter. For us, everything is contractual cash flow. Here, sir. Coupon payment is not interest. Coupon payment is different. Interest as per EIR is different. Now, just like that, visualize this. Sir, in this sum, had I issued the bond not at 95 but at 100 only, par value. Redeemable also at par. Effective interest rate would be how much? 9 only. It won't be 11.048 in that case. Are you understanding? In that case, instead of 10.5, here the answer would have been. Here also anyway it would have been. Any closing balance would have been 100. Here also it would have been 100. Here also it would have been 9. Here also it would be 9. This closing balance also means what? When there are no transaction costs. Bond is issued at par, redeemable at par, then coupon rate will be equal to AR. Not only that, your starting amount what you write in your ledger, that only will be your closing balance every year also. Very, very important observation. Why? Later on restructuring of loan questions will be there. A loan or bond that fellow issued for 15 years, but it is issued 5 years back. Today you are in 5th year. If EIR coupon rate, if coupon rate is, if issue price and redeemable value both are same, coupon rate and EIR also will be same, and therefore opening balance, closing balance will be same par value only. So you can get your carrying amount today easily. All these observations are. Whatever ledger account you are seeing, in ledger account you can draft it in the form of a table also. We call it as a ACM table. So opening balance plus interest expense minus the cash outflow, closing balance. This is the general format everywhere, sir. The format by it change will be there when payments are made at the beginning of each year. Payment is made at the beginning of each year, not first add interest. First make the payment, then you have to add the interest. Here you are first adding interest because the payment is happening at the end of the year. I understand this is pretty simple. In this also one beautiful observation. You see the ACM table, the starting is 95, current year interest expense is 10.5, I paid 9, closing balance 96 points. Similarly second year, similarly third year, by the end of third year liability should become 0. Now, do you agree that in 95 rupees, whatever is the starting amount, that represents the present value of future cash outflow discounted at 11.048%? 95 rupees is the present value of future cash outflows counted at 11.048%. Do you agree with that? Yes. Otherwise, that is not IRR. No. If it has to be AR, definitely it should represent the present value of future cash outflows. So 95 is definitely the present value of future cash outflows. Okay. Now what my is 96.5. 96. Is it representing the present value of remaining future cash? It will, it should, it has to. There is no option. If it is not representing that, our ledger or dabba will never become 0 towards the end. Compounding basis la box is ultimately becoming 0. No, if it is becoming 0 means what? When you are compounding, it is becoming 0. That means what, sir? Your 96.5 is representing the present value of future cash. The observation also equally important. Why 10 years bond? They will say 8th year, 7th year, some modification is happening. 7th year carrying amount, how will you know? You will prepare ACM table for 7 years. Waste your time. Oh, you are already standing at 7th year ending. Remaining 3 years is there. A 3 year cash flow you discount. Whatever present value you will get, ade account carrying amount. How can I do like this? Of course you can do like this. ICAI themselves have done that. You understand, sir? The 3 years ACM table I will also do table only. 20 years maturity, 8th year modification is happening. Do you think I will do 8 years ACM table? Or like a stupid I will do ledger account for 8 years? No. Remaining 12 years ka cash flows discount. 1/9 it will be over. PVAFA you will apply. Understand, sir? Anti-factor they will get over. The observations are important. On that ACM only couple of more examples are there. This is for interest, this is for liability, this is for asset. So asset key entries will be like this. Since it was interest expense there, we wrote interest expense account debit to financial liability. This is asset, financial asset account debit to interest and bank to financial asset for any recovery. Liability ki opposite side. ACM table observations are all same to. Now coming to when to apply which method. Should I apply ACM, should I apply FVTPL or should I apply FVT? Okay. Out of these three, which method I should apply to which asset? Coming to first category, investment in equity shares. If it is investment in equity shares, standard ka primary idea is you should go and apply FVTPL. When you apply FVTPL, what will happen? Every year you have to fair value and gain or loss will travel to PR. Some companies what they argue is, sir, we have investments which are highly long term in nature. We are not going to sell them at all. Then anyway I am not going to sell them. Why should I fair value, bring the gain or loss into my PRL and let it impact my EPS? I don't want to impact my EPS, so I don't like FVTPL. That says don't worry, you have another choice. The choice, follow FVTOCI. Follow FVTOCI, what will happen? You will still fair value the investment, but the gain or loss will not enter into your PRL, it will be recorded directly in OCI. The moment you record in OCI, a profit is not considered for computation of your. You understand? So, overall story is, if it is an investment in equity share, the entity has a choice to follow either FVTPL or FVTOCI. And this choice they have to make at initial recognition. subsequent reclassification not permitted. Is an irrevocable choice which you are making on the first time, either FVTPL or in case you choose FVTOCI, a small penalty is there. What is that? Subsequently, when you sell the investment one day, whatever gain you parked in OCI reserve entirely will become realized gain. Our gain cannot come to P&L. We directly adjusted into intent. Directly, what am I saying? OCI reserve is not reclassified. Choose FET OCI option. Clear here? As simple. Coming to any other financial asset. If you talk about equity, that is simple. Other than equity, any other financial asset, how to do? Any other financial asset, your identification is based on two tests. The two tests are called as, one is business model test, the other one is contractual cash flow test, or also called as SPPI test. First, observe the overall nature. Business model test, you will understand the objective of the entity. Why are you holding this investment? What is the objective of the entity with regard to these kind of assets? I will know your feeling there. Contractual cash flow test, what I will test is, I will know what right you are having from the financial. First one is, what is your intention, objective. Second test, I will test what right you are getting. Based on these two, I will decide whether SCM, FVTPL, FVTOCI should be applied for your financial asset. Other than equity, any other financial asset ki they rule. Sir, any other financial asset means what, sir? Loan given, investment in debenture, investment in redeemable preference shares, loan given to subsidiary, security deposits, staff loans. Every case, this only will be applicable. Okay, let us see business model test. Since we said that business model test, we are testing the objective of you holding investment. There are three objectives possible. What are three objectives? Objective number one, holding the financial asset till maturity. Objective number two, holding the financial asset till maturity is my objective, but if a good price comes, I am ready to sell also. Second objective, dual objective. Third objective is to sell. So total three objectives. First one, hold till maturity. Third one, sell. Second one, it could be hold also, it can be sold also, depending on whatever is convenient to me. Are you understanding, sir? Three objectives are possible. Coming to fourth one, next point, contractual cash flow test. In contractual cash flow test is deemed to be satisfied if the entity is having right to receive solely principal payment. Means you have a financial asset. E financial asset should give you right to collect what? Principal payment and interest. Other than this, if you have any extra right, SPPI test or contractual cash flow test is the test. If you have to pass, there is only one condition. What is the condition? You have right to receive. Right to receive what? Solely means only, nothing else. Solely principal payment, and if you have any extra right, point is, the total I have discussed this 4 points now. The 4 points I named it as ABC. A, B, C are objectives. D is the right. So depending on what points you are satisfying, I will decide which method we will have to apply. Now, first thought process. Sir, I am somebody who falls under this category. A plus D. What is the meaning of A plus D? I am going to hold till maturity. I am not going to sell. And I have right to receive principal payment and interest and nothing else. And let's say you will go and apply. Sir, why ACM, sir? Tell me, sir. In ACM, is there fair valuation? Is this fellow having intention to sell? When I don't have intention to sell, why should I do fair valuation? In ACM, EIR method is there. EIR is nothing but IRR only. IRR, when can you compute? Only when the cash flows are fixed. Correct? Only when cash flows are fixed and all the cash flows in the instrument you are going to get, then only IRR works for you. And this fellow has the objective of holding till maturity. Since he has objective of holding till maturity, interest income should be measured on EIR. Therefore, ACM is good. He does not have objective to sell. Therefore, fair valuation is good. So only ACM you have. Suppose I fall under this category, B plus D. What is B? My objective is to hold, but I may sell also. And my cash flows are purely interest and principal, nothing else. If I have objective to hold, I should apply ACA. I have objective to sell also, I should do fair valuation. My cash flows are purely in the nature of principal and interest. Interest income should be measured on EIR. Which method satisfies all this? Full like ACM, just fair valuation extra. Second one. Last one is any other case. We'll go and apply. What is any other case? Your objective is to sell FVTPL. No sir, my objective is to hold till maturity, but my cash flows are not SPPI, some other rights also I am having. D point fail aithe sir FVTPL. C point if you pass also FVTPL. Simply remember like this: A plus D ACM, B plus D FVTOC, any other case. You understand, sir? Now, if you have understood the rules of each method, why this method has to be applied for this condition is very easy to understand. The objective as a sell objective when I don't have, why should I apply FVTPL? Why should I apply FVTOC? That fellow will go and apply. And ACM when you are applying, EIR you will apply. EIR who can apply? Whoever, that fellow who is going to experience all the cash flows in the contract. That cash flows in the contract, when can you experience? Only when you stay till EIR. Second fellow, B plus D case law, that fellow has the objective of holding till maturity also. That's why he also will apply EIR. He also will do ACM. But on one side, he has intention of selling also, daily is watching market. So I have dual objective. Mixed method you will apply called as FVTPL. Third case, I have only pure intention to sell, or irrespective of your intention, your cash flows are not in the nature of interest and principal. Your cash flows are not in the nature of interest and principal. I cannot apply EIR. Since I cannot apply EIR, how can I do ACM and FVTOC? Therefore, you will have to apply. Sir, on this, your ICAI is too much obsessed. They have 24 questions only on this concept. Just identifying what is business model of the company. Full theoretical questions came in the exam. So if you ask me from a past experience point of view, important, absolutely not important. Absolutely not important. Or should we leave and go as sir? So, it's definitely risky. So, what we'll do is, I entire 20 questions ka juice is there in this next 8 to 10 points. The points if you study, a question you can easily handle. Simply have to say what is that fellow's business model, that's all. So let's go through these points quickly. Okay guys, look at this. Sir, Excel method, purchase day, investment in bond. This fellow says that my objective is holding till maturity, therefore I will apply ACM. Fine, correct idea only. This fellow came with auditor. He is questioning the company, Excel Limited, 3 years back to purchase a similar bond. At that time also you told that you want to hold it till maturity. You started applying ACM. But even before maturity only, you sold off that bond. So previous history if I check, you started with ACM, but you sold off the bond before maturity. So with what face will you apply ACM to this? How will I believe that your objective is to maturity? Fair enough question. Whatever standard says is, in the past, you might have disposed of financial assets before maturity, but still your objective is treated as held to maturity only. First case, the stress case scenario. Stress case scenario means this company has surplus funds, they purchased a bond maturity is 7 years, They wanted to hold it till maturity. They started applying ACM. After 3 years, the company is in urgent need of money. Dire situation is there. So when they are in need of money, what will they do? They have investment, they sold. The money they use for whatever purpose they needed. Our case you cannot contract, you cannot tell them that you are contradicting your objective, don't sell. Who are you to say not to sell? And surplus money, sir, their money, their wish. Their intention is to hold till maturity, but an urgent case is there, sir, I need money. Will I sell the investment? I will sell my kidney, sir. Investment only, no, I sold my investment. That is not to contradict your objective of holding till. That is first case. Second case is risk of investee as some company is issuing bond. One of my friend Ambani company, go and invest, it will be super hit, you're highly credit rated, you will get lot of money, returns will come on time and all. I trusted him, invested. Moreover, with a feeling that I will hold the bond till 8 years in maturity. After 2 years, I realized that is Chota Ambani. So that company is not doing well. He is already defaulting existing loans, only going for settlement. My date will come after 6 years from today. Do you think I am feeling safe and secure now? Will I say that once I commit, I will not come back? No. A bond nicely, sell off in the market, whatever you realize, go home. Risk of the investee has increased beyond acceptable level. Like a stupid, you should not sit there. No, I sold off. That is not contradicting my hold to maturity objective. Third case is for testing liquidity. Testing liquidity means, suppose I am a bank. I have lot of money, obviously. Business is that only. Is surplus money I have to invest somewhere. RBI guidelines say that you should not invest more than 25% in held to maturity investment. You can make investments, but don't make long-term investments hitting 25%. Total surplus fund I am having 100 crores, 25 crores only I can invest in HTM category. Remaining 75% immediately withdrawable money you have to invest on. The bank condition. Okay, 25 crores I am investing in some long-term bond. RBI says not sufficient. Every year out of this, sell some bonds and check how liquid they are. If you want to sell, how quickly you are able to convert that into cash, go check and inform that report to us. Liquidity test you are supposed to. So you think from bank's point. This bank has purchased 1 lakh units of some bond. 8 years maturity. 1 year is over. In 1 lakh units, they sold 200 units. Why? To book fair value gain. Urgent need of money. No. Why? Just to test how quickly they are able to convert this into. Like that every year they are selling small quantity. Just to test the. Is not a violation of your held to maturity. Clear here? On these three, almost some 5-6 questions are there. Next. Sir, what is D point saying? D point, what is it saying? You should have right to receive solely principal payment, and when you say interest, it is not any stupid interest that you write in your contract. Interest means it should satisfy the definition of interest as per Ind AS 109. So what is there in the definition? AFM, you must have understood this concept of required return for an investment, or at least you remember this formula, CAPM formula, you remember? RF plus beta into RM minus, what is RF here? Risk-free return. What is beta into RM minus RF? Risk premium. Risk premium. Risk premium means for taking additional risk, I want extra return, no? That is a second part. Ade definition of interest is used here. In our standard, when I say interest, SPPI interest is not any contractual interest rate. It should be required return. It should compensate for basic time value of money. Return plus additional return for extra risk. This is the interest definition. If instead of this you get anything, no sir, your SPPI test is I have given you one example. I'll take you to that example. This one. Look at this. Ex-limited company is there. For that fellow's risk, he should offer a return of 14%. This fellow is the investor. What that company did is, that company issued this bond. At what rate did they issue? 12%. The bond is convertible or redeemable at the option of the. Now, company point of view, okay, let's leave it, that we already discussed compound financial instrument. Let's talk from investor point of view. You are an investor who purchased this bond. My question is, D point is satisfied or failed? Failed. Why did it fail? What does D point say? You should have right to receive principal payment and interest solely. Here you have a conversion option also. Correct? There is an extra right. The moment you have extra right, D point is. Now, this investor, what he is saying is, sir, look at this, look at my face. I am taking God promise. What promise he is saying is, I will not take share. I will waive the right myself. The movie will cut his hand, no, like that. I am waiving my right. I will not take share. I will take only. Next 5 years he will receive 12, 12, 12, 12, 12. At the end of 5th year, he will receive 100 rupees only. Can I say D point is passed? Who is it not? Interest rate for that company's risk. How much return he is expecting? 14. Every year coupon, how much are they giving? Is it satisfying the definition of your interest? You understand, sir? It does not matter whether you hold the rate or waive the rate. A D point fail, what will happen is, the interest rate is basically tainted. Tainted rate I cannot apply. PTPL category you will. The concept only is given. The cash flows arising from financial asset should be in the nature of interest and principal to meet the CCFT test. If financial asset involves rights of conversion into shares, CCFT test is not passed. The moment CCFT is failed, D point failed, I have only one choice. Remaining are normal points. Day one difference directly I will explain. Okay, sir, financial asset story basically is set up. Now, in this, some special cases are there. If we cover that, financial assets predominantly is done. Now, coming to the first one, staff loan. Now, zero, one. Sir, I have an employee to whom I gave a loan of 1 lakh rupees to employee at the rate of 2% interest. So he will pay me 2000, 2000, 2000, and of course he will repay my money bullet repayment at the end of 3rd year. Market interest rate is 10%. That means he is not my employee, I would have charged. Because he is my employee, I am charging only. From company point of view, if you observe, do I have a contractual right to receive cash in future? Company point of view. Therefore, this is pakka financial asset. Since it is financial asset, I have to apply either ACM or FVTPL or FVTOC. Observe closely. Can I sell this? Do I have objective of selling this? Is my employee, sir. How can I sell loan given to employee to somebody? So the only way of realizing this is what? Giving cash, holding till objective A. Okay. Now, when normally you should charge 10%, you are charging only 2%. Why is it? Because there is a relation. What relation is there? Employer-employee. That means there is a normal loan also. At the same time, because of employer-employer relationship, one benefit also you are passing on to the employee. Standard says split both up and apply ACM. And ACM, the initial recognition is what? Fair value adjusted with transaction cost. I did not incur any transaction. So I have to recognize at what value now? Fair value. How will I get fair value? How will I get fair value? how you should think is, imagine for one moment that fellow is not my employee. He comes to me and says that, sir, I will pay you 2000, 2000, 2000. Last I will pay you 1 lakh also. Today, how much loan will you? What is the market interest rate? 10%. So what you will do? All these cash flows, you will discount it to today at the rate of, so 2000 PVIFA, 10%, 3 years, 2 lakh, PVIF, 10%, 2000, 2.4865, lakh, 251. This present value, whatever you are seeing, Omar, this is also called as fair value of the loan. Loan ki fair value means present value only. Share ki fair value means market price. Bond ki fair value means market price. Loan transactions ki fair value means present value, discounted with market interest rate. Loan ka price will not be quoted, no. Loan ka interest rates will be quoted. A interest rate, if you discount, whatever present value will come, a present value only will be there. Now, I will tell the employee like this, employee, for your face, you deserve loan of only ET105. But because you are my employee, I am giving you an amount given is 1 lakh, but the worth of the loan is only 3,000. How much extra did you give? 19,895 rupees extra. Tell me, sir, did I give it? Did that extra money, whatever I am giving, will I recover it now? But I will recover only by getting services from the employee, not in cash. Your accounting will be done. Loan account debit 80,000 to bank. This 19,895. This will debit it to something called as prepaid staff cost. Prepaid staff cost account means it's a kind of a prepaid expenditure. I am giving you money today only. You simply have to work for me, stay in the company only for the next. So what will happen? On this loan account, go and apply the prepaid staff cost. Since the benefit of this will come to you over a period of next 3 years or 5 years, 3 years in this example, will simply charge it to P&L account in 19,895 divided by 3. You do some amount will come every year, release it off. As loan account, you will go and apply ACM. When you apply ACM, what will happen? What is ACM now? The 80,105 is what? It is a present value of next 3 years ka cash flows. The moment you apply ACM, the loan account, by the time you recover the last 1 or 2,000, it is clear here. Very, very simple. In this, the thing is, there is a loan transaction, then there is an employer-employee relation also. By doing this accounting, we are separating both of them. That we are accounting as per employee benefit standard, simply expense P&L account, that we are top 80,105 accounting according to Ind AS 1. Yes, sir. In this one small special case is there, easy only. Watch this correctly. This is the maximum which ICAI has tested till now. Easy only. Watch. The employee has promised to make 5 payments to me. 5 payments. That's all he will make. So what I will do first day, all this I will discount it to today using the normal market interest rate. I will get some value. This is called as fair value of the loan, and this is the initial amount of my financial asset on which I will go and apply whatever extra amount I would have given to that fellow, that I will account it as what? Prepaid staff cost account. Sir, up to here clarity is there, no? Now, what happened is, first year payment he made, second year payment also he made. Second year ending comes and tell me that, sir, along with second year, I will pay one installment extra also. Means third year installment also he is paying in the second year itself. That means your actual position I am writing on the top. Here one box he paid, here one, two boxes he is paying. The moment he does that, what is happening is a 5-year loan is now getting translated into a 4 years. Hereafter, your remaining cash flows also will change. Ideally, a blue boxes should come, but hereafter what will happen is he will pay one box here, he will pay one cash flow here, not pay. Are you understand the total? How many installments he has to pay? 5. Over a period of 5 years. But second year he pays one installment extra. Because of that, remaining installments will be only. Now the question is, how will you handle this while accounting? Thought process very, very simple, sir. The moment that fellow pays one installment extra to you, your future cash flows are revised. Future cash flows are revised. Future timelines are revised. If remaining 3-year loan now became only 2 years loan, interest amounts also will change because outstanding balance has changed already. When future cash flows are changed, your existing carrying amount of staff loan in your ledger will not represent the present value of future. And it will not represent the present value of future cash flows. ANM will not. So then what should I do, sir? Revise the number, that's all. If books flow already one carrying amount will be there after accepting that extra payment. Revised carrying amount is not representing the present value of this revised cash flow. So what you will do is, at the end of second year, will simply remeasure the staff loan. To what value? Present value of revised future cash flows discounted at original. You should not take market interest rate. The moment you bring market interest rate into picture, that becomes fair valuation. Not do fair valuation. Why am I remeasuring it? One payment advance I received. Because of that, future ka cash flow ka term structure changed off. My carrying amount is not representing the present value of future cash inflows. To make ACM work, for that purpose I am doing a experiment. Do you understand what I am trying to say? Now, example, I am writing some numbers randomly. Existing carrying amount, let us say, is 2 lakh. Revised carrying amount of staff loan, 2 lakh. So from 2 lakhs, you have to increase it to 2 lakh 20,000. What is the entry we will write now? Increase, no. Staff loan is a asset. Staff loan account debit. The credit portion went to prepaid staff cost. All this drama is happening when? At the end of second year, he is paying one extra amount. First you receive. After receiving, check the carrying amount. The amount is there. Future cash flows revised. A revised cash flows you discounted. The amount comes. Update the amount existing to revised. Increases. That amount correspondingly adjusted to prepaid. So why should I adjust it to prepaid staff? What is prepaid staff cost account represent? For example, look at the previous number. Market interest rate 10%. I gave loan to this fellow only at 2%. A 8% benefit whatever is there for 3 years. That is included in which account? Prepaid staff cost account. So basically prepaid staff cost account represents benefit given to the employee. You understood that now? Now come back. But there are 2 employees. To one fellow, I gave a concessional interest rate loan for 3 years. Another girl is there, my favorite. I gave her loan for 20 years, concessional interest. For both of them, I am charging same 2% only. But this boy, I gave loan only for 3 years. To her, I gave loan for 20 years. Who is getting more benefit? He. Why? Even though the benefit per annum is same, the benefit is given for 20 years there. Here benefit is given to this fellow only for higher the life of the loan, higher the benefit. Isn't it, sir? Now here what happened is, when you initially recognized the prepaid staff cost account, you accounted concessional benefit for how many years? 5 years. But because that fellow made a prepayment, the loan effectively is coming to only 4 years. So the extra expenditure that is loaded in prepaid staff cost account, that I am reducing it now. There's a prepaid staff cost is benefit for 5 years, but because of a prepayment, the benefit is coming only for 4 years. So for that deferred revenue expenditure account, whatever you have, that I am full logic. Clear, sir? This is a staff loans. In this, one small concept is also there. The concept is, while you are applying ACM, yes, sir. What is the transaction value in this sum? Transaction value, amount. But what is the fair value? 80,105. Is there a gap between fair value and transaction value? Fair value to transaction gap is there. When gap is there, no sir, this is called as day one difference. All this nobody will ask you, sir, but standard it is there, so I am telling you. Day one difference, it's called as day one difference. Sorry, day one difference, how to account? The standard one guidance is there. Guidance is, whatever fair value is there, if that fair value is determined using level 1 input, as per Ind AS 113. Level 1 input means what? Quoted market price. Quoted market price, if that is how you obtained your fair value, then this difference should be thrown off into either as an income or as a, but in this case you observe 80,105, from where did I bring? Stock market, quoted market price, no, I computed. Interest rate I brought from the market only, but computation is not quoted anywhere. I myself did the work. When it is not a level 1 input, like in this case, gap can be recognized as a asset if appropriate. So why we have to account it as prepaid staff cost account? This standard is giving you that license. If that is level 1 input, you don't have a license, you have to book it into P&L only, because our fair value is very strong. Your fair value is not that strong, therefore possibility of a asset exists. The direct application I am saying, the concept part we here have. Because this is about your staff loan. Now, another example in this, similar to staff loan, watch this, this is a very easy one, important example. Sir, I obtained a plant and machinery on lease. At the time of obtaining lease, a lessor told, sir, give me some security deposit, because you can do anything with to my machinery. I gave him deposit. 1 lakh. He said, don't worry, sir, your money is safe with me. After 3 years, give me my machinery, I will give you your 1 lakh back. Security deposit released. Ask yourself, today you paid money, but in future you have a right to receive money, correct? Right to collect cash flow on a future date. Is it a financial asset? Right to collect cash. When are you going to get it? You are standing now, but money is going to come after. This is definitely a financial. Now, financial asset can be accounted in 3 methods: ACM, FETPL or FETOC. Is security deposit I will not sell now. I am only going to hold and collect the cash flow. Therefore, which method I have to apply? If I have to apply ACM, initial recognition should be done at fair value adjusted with the transaction cost. Transaction cost is not there, so I have to record it fair value. What is the fair value? The kind of transaction of fair value is present value. Whatever amount you gave, that is not fair value. Whatever you are going to receive in future, present value of that is fair value. The present value of that is 75,000. But how much did I give? 1 lakh. Write the entry and see what will happen. Security deposit account debit to bank. To bank, I have full clarity. Security deposit debit is 75,000. I paid extra 55,000. Like how employee case law you called it as a prepaid staff cost, here it is a kind of a prepaid rent. You paid money, not come back to you. Employee you paid 19,895, he'll only smile at you next to 3 years. Here, this fellow will not even smile. He says that my machinery is smiling, enjoy. So this is a kind of money you paid which will not come back to you. But if you don't agree to pay this, that fellow will not give you the machinery on lease. Indirectly, this is a. So ideally, you should call it as prepaid lease. If you call it as prepaid lease, and what will happen next? What happened to prepaid staff cost? Every year we amortize it to P&L account. Like that, this also you have to amortize it to P&L account every year over a period of next to 3 years. Clear? Now, because Ind AS 116 has come now, and Ind AS 116 does not permit you to book lease rent as an expenditure in P&L account, what the answer is revised in study material is, they made this link. Instead of prepaid lease rent, directly debit this to ROU asset. When you debit it to ROU asset, what will happen? Your ROU asset ka balance will increase, that anyway will be depreciated over the next 3 years, life of the lease. Understanding, sir? You call it as prepaid lease rent also, you will amortize it. You call it as ROU asset also, you will depreciate it over the next. Moral of the story is that will come to P&L account. That's the whole point. So clear here? This is regarding security deposit. Ask yourself, sir. Current account will give you how much interest rate? Current account low, how much interest rate will you earn? 0. Why is it 0? Why is it 0? You can do n number of transactions in that. Whenever you want, you can recover your money. Bank is obligated to pay you that money. Sir, you open a normal savings bank account like how we all have. Daily do business transactions. After 5 days, bank needs to call us. Not too many transactions you are doing in savings bank account. You like to convert this into. No, I don't want to convert. SB account. Start putting charges. So savings bank account, what we individuals open, that you cannot do transactions daily basis beyond a particular limit. Sir, no sir, I am privileged customer. Also there is a limit, little higher limit. At one stage they will ask you to switch over to current account. Current account lo bank point of view, bank big advantage will not be there. Our money they have to keep it ready, anytime you will take it. That's why they don't give you any. Now tell me, similarly, you deposited money somewhere, but there's a demand deposit. Demand deposit means you ask, they have to pay you immediately, spotly they have to pay you. How much interest rate will you expect? 0%. 0%. If somebody will pay you for that also, happily you will take, obviously. But ideally, current account ki demand deposit ki interest rate will be. Now, since interest rate is 0%, do you agree that transaction value and fair value both will be same? I made demand deposits, sir. My goal is to take that money after 1 year. What is the demand deposit? So, what is the fair value of that? If 1 lakh you discounted with 10%, because it is not a demand deposit. If I tell you that this is a demand deposit, you have to discount it with what rate? 0%. You discount with what? 0%. Answer will be how much? 0. No, answer will be 1 lakh. Transaction value ki fair value ki gap will not come. The answer will be demand deposit account debit to bank account. 1 lakh. Sir, which method sir are you applying? ACM sir, ACM. ACM, how much is EAR? 0. ACM does not mean that every year interest income you should record. Interest income I will record if interest is there. Demand deposit the interest rate is not record, that's all. ACM is. Trade receivables, same thing sir. If not, trade receivable accounting to some extent is also based on Ind AS 115. Anyway, I sold goods to somebody. That fellow is going to give money within next 2 months only. Very ordinary normal credit period. You will not split the interest and all. You simply write debtor account debit to sales. When he gives you money, you will write bank account. As simple as that. But if that debtor is taking 2 years time, definitely you would have sold goods at a higher price including interest. At that time when you write debtor account debit to sales, pass that entry without cash price you have to record or present value you have to. On the debtor, you have to unwinding of this. For example, the debtor agreed to pay me 1,21,000 after 2 years. Market interest rate is 10%. A discount will become, what is the entry I will write now? Debtor account debit to sales with an amount of, first year ending I will write debtor account debit to interest income 1 lakh in. He won't pay me anything, artificially I am writing. Second year ending debtor account debit to interest income 1 lakh already recorded. First year ending 10,000 also recorded. Total 1,10,000. That into 10%. Now my debtor is appearing at 1,21,000. Pay the money last life. Bank account or 1 lakh. Which method I am applying? Next case. Very, very important case. Follow the case, sir. The exam also highly important. Numbers we will talk. Sir, A Limited, B Limited, two companies are there. A gave loan to B, 1 lakh rupees at 0 interest rate for 3 years. Market interest rate $10,000. So today I gave them 1 lakh. They will give me 0, 0, 0. At the end of third year, I will recover another 1 lakh. Market interest rate is not 0, obviously. Market interest rate is interest free loan. Why did you give interest free loan? They are related parties. Parent, subsidiary. Group means parent and subsidiary. So who is parent, who is subsidiary? That we will see later on. First, tell me, what is the fair value of this 1 lakh? 1 lakh into PVIF 10% third year. Okay, approximately I am writing. Easy for. How much extra did they pay? Like how employer gave extra money to employee. Let's see how he gave extra money to lessor in a security deposit. Like that, parent fellow also gave extra money to him. A subsidiary gave extra money to the parent apart from the loan because of the relation. So, sir, how to account? Let's talk one by one. First case. Parent gave loan to subsidiary. If parent gave loan to subsidiary, how will parent account this? How will subsidiary? In parent books, loan account debit to bank is the loan receivable. Subsidiary books is the loan liability. Bank account debit. So coming to amounts, I gave 1 lakh. That fellow received 1 lakh. Loan for me is a financial asset, and our rules say that initial recognition should be done only at fair value. Of course, transaction cost, if it was there, I would have adjusted. Similarly, subsidiary point of view, loan is a liability. As I already told you, loan liabilities are accounted, financial liabilities are accounted using ACM or SPPI. For this one also, ACM only will be applicable. Officially, we will learn this later. So, there is a 25,000 rupees gap here. There is a 25,000 rupees gap here. We should learn how to account this. Yes. Who is giving to money to whom freely? Parent is giving money, is not recovered. This you should adjust it to what? Shares of. Sir, already in parent company books, one investment in subsidiary will be there. No? Investment in equity of subsidiary. If that investment is not there, the relation only will not exist. Our account kept it. Here. If he is investing in shares of subsidiary, how will they say? Investment in my capital. This is called as capital contribution. this will be shown as part of your other equity. Just like equity share capital only thing is shares are not. Existing shares ke extra money you get. Here sir, easy only. This is when parent gave loan to subsidiary. Now opposite case. Subsidiary gave loan to parent books, subsidiary books. In parent books, parent is receiving loan. So primary skeleton entry is bank account debit to. Subsidiary is giving loan receivable, financial asset. Since loan, financial asset, financial liability, ACM will apply. You have to record initially at what value? Fair value. 75. Cash portion is so there is a 25,000 rupees gap here. 25,000 rupees. Tell me, sir, if you are subsidiary, how will you account for this gap? You are paying more to your parent. They deserve only 75, but you paid 1 lakh. Extra 25,000 must be understood as dividend distribution by subsidiary, the parent. And dividend distributions, where will you account? Equity. Retained earnings will operate just. Other equity, debit. This dividend declared for them. Parent company point of view, if he is declaring dividend, there is a dividend income for me. This will do. Are we clear here, sir? Purely now. Once come back to the example starting to once again. I gave 1 lakh rupees now. When will the other fellow repay me? Since he told that he will pay after 3 years, I am able to work out the fair value correctly. I am able to identify the benefit component correctly. Then accounting we did. What if the other party tells me that they will repay money to me when funds are available? I gave 1 lakh now. Pre-limited is saying that I will pay 1 lakh. Surely I will pay whenever I have money. That is the answer that fellow gives. You say, go get lost, I will not give money. Not like that. Our subsidiary. Whenever he has money, he will repay. He is our subsidiary only. If outsider says like this, you ask get lost. If our own kid says like that, okay, but. Oh, the fine. Deal is okay. Accounting, how will you do? When you don't know the date. What is there, sir? We will ignore all this. Simply we will write loan to bank 1 lakh, 1 lakh. You write loan to bank 1 lakh, 1 lakh directly, you are accounting it like a demand loan. Is it a loan repayable on demand? If I ask money, immediately they will pay. In that case, fair value and transaction value should not be same. He will pay whenever they have money. What should I do? When they are likely to have money, estimate. When and when they are going to repay money, estimate that. Once you estimate the dates and cash flows, again the process will follow. Accounting is same. Only thing is, instead of third year ending you receiving money, some money here, some money here, some money in 6th year, like that different streams lo you will get money. Estimated basis lo ide accounting. Same accounting but estimate this. What you have to estimate when money is going to. Here, sir, no sir, A gave loan to B 1 lakh rupees, 0% interest, but money is repayable on demand. When money is repayable on demand, interest rate is 0%. When I take 0% interest rate, transaction value, fair value both are same. Then the entry will be what? I will write loan to bank, you will write bank to. Clear here? The entire drama, whatever we are discussing, this is only in separate books of pay. Consolidation point of view, it will not have any impact. Why? Consolidation point of view, parent and subsidiary put together is a single entity. When it is a single entity, how can I give loan to myself, get cancelled? We will get. So that is about loans within. This is regular way purchase of sale of financial assets. See sir, In stock market, when you buy any investment, any financial asset, it won't be delivered to you on the same day. There is settlements process, settlement cycle. Once upon a time, it was T plus 5, later on T plus 3, later on T plus 2, it is T. Internationally, many countries follow T plus 2 only. India also, it was T plus 2. They changed over to T plus 1. Scale basis where they are changing, it is T plus 1. The transaction executed on Monday will not be settled on Monday, it will be settled on Monday, gap will. The first day is called as a trade date, second day is called as, for example, you buy a share on Monday, it will be delivered to your demat account on Tuesday. Money also will be deducted only on the T plus 1 settlement system. T plus 2 instead of Tuesday it will be on Wednesday. Now here that's all okay, but how will you account this? When will you account it? Will you account it on trade data or will you do the accounting on? I purchased on Monday, so should I write investment account debit to payable there? Or Monday, Tuesday will not do anything. Directly Wednesday I should write the discussion. And it says you can make a choice, either trade date accounting or settlement data. Take it as an accounting policy, consistently apply. Any which way you do, ultimate impact or change will not come. Sir, a simple point, full thought process. Suppose you purchase this share for 100 rupees now. After 1 year, market value is 140. You are preparing financial statements only at the end of the year and you have to apply FVTPL. You fair value. How much is fair value gain? You are preparing financial statements only once in a year. At the end of the year, you fair value, you got a gain of 40. Again, you transfer it to PR. There is one fellow who has no other job. He is preparing financial statements daily. Every day. The 100 became 101, it became 101.25, became 99.75, became 98, it became 7, became 120, became 121. Like that daily he is doing fair valuation. Every day he does fair valuation, again or loss is coming to PR. Like that full year he did. An entire fair value gain or loss, whatever he did, if you total everything, he will come to understand. So whether you start accounting from trade date or you start accounting 1 day late, nothing is going to happen. Ultimate impact on P&L account will be same only. So nothing. If it is ACM, anyway you will not do fair valuation. How does it matter? That's the choices. Yeah. Coming to the next aspect, this is okay. Next concept is impairment of financial asset or loss allowance on financial asset. Sir, I will take you through a small example. Follow the example correctly. Next 2 pages, the example indicate automatically it will be over. But pay attention, important stuff. This is one area which is not properly tested by ICAI till now. Properly. One question came. Extremely cheap question. Even if you have left instruments and went to exam also, that question you couldn't solve. It is that kind of question. 2 o'clock 5 marks they asked once and never again. That is one question. This is one area where lot of good questions are there in IFRS exam. So you follow this example, whatever I am giving, everything will fall in place. Sir, impairment loss on financial assets or is also called as loss allowance. All this is basically overaction done for provision for doubtful debt. It is nothing but accounting of bad debts. Provision for doubtful debts. How to create this standard is giving you guidance. Name they change. Instead of that doubtful debts, they are calling it as loss allowance. Overall concept is called as impairment. Now, when you take a financial asset, it can be accounted under ACM, it can be accounted under FVTPL, it can be accounted under FVTOCA. 3 methods are possible. When a financial asset is measured at FVTPL, impairment provisions, whatever we are studying, they will not. Why they will not apply? Because the investment is measured at what value? Fair value. What is fair value? Market value. The investment is correctly measured. Sir, I invested in bond of a particular company. A company is not doing well. Its risk increased. Credit rating fallen down. Chance of repayment fallen down. Do you think market price will keep quiet? Market price also will fall down. When market price falls down and I am applying FVTPL, what will happen? A loss automatically will come into my PRL. Are you understanding, sir? Fair value loss by default will include impairment loss also. Apart from so many fluctuations, company ka risk also will be factored in the market price. So, when you are following FVTPL method, impairment loss naturally is accounted in your PRL. That's why impairment provisions will not apply there. So, impairment provisions are applicable only for financial assets which are measured at ACM, financial assets which are measured at PTOC. Sir, ACM case lo why are we applying? Why am I applying is, I invested in bond of one company, holding till maturity, a company worst performance, bond price fallen down, company credit rating fallen down, I never revalued it because I am following which method? ACM, but the chance of recovering money has, because the company is suffering deep losses. Should I not book the loss now? Therefore, here it is. Sir, ACM lo okay. Why are you applying here? Here also I am applying which method? Fair value method only. Here also every year a bond I measured it to fair value. If a company is not doing well, a bond price would have fallen down. A bond price fallen down means a loss I would have accounted. Investment in the balance sheet is already appearing at perfect value. What is your problem now? The problem is impairment loss should be accounted in PRL. But when you apply FET, you say what happened? Entire fair value loss went and sat under OCA section. So what I will do is, I will apply all the impairment provisions, identify the impairment loss, remove that loss from OCA, put it in. I will not touch the investment account. Investment I am very happy. Where? Because you are following fair value. My problem is with the place of loss. Put it in OCA. I want it in FETPL. I will not touch at all. Okay. So let's see how to handle that impairment loss. Sir, actually provision for doubtful debts, how to measure? The loss allowance, how to measure? The standard level detailed guidance is there. Study mat law, the entire guidance is given in the study material, but they have not given one question also on this model. One distant question is given, but not sufficient. I will tell you the entire process, question is likely to come. Okay? So follow the procedures, follow the example. Easy example. Sir, in my balance sheet, I have a loan receivable. Means our company gave loan to somebody. It is appearing at 10 lakh rupees. Coupon rate is equal to EIR is equal to 10%. I gave this loan long back. Today it is appearing in my balance sheet. My remaining life is this 1, 2, 3, 4. Next 4 years, though, the bond will pay me 1 lakh, 1 lakh, 1 lakh, 1 lakh. Last they will pay me principal repayment. You can very clearly see a future cash flows ka present value discounted at EIR 10% is matching with my 10 lakh rupees. Same par value. Okay. Now, if I have to create loss allowance on this receivable, I have 3 steps to follow. Step number 1. Identify cash flow not expected to if default occurs. Assuming that this company will make a default, go and estimate out of the remaining cash flows, how many cash flows you are not going to receive. The company makes a default, out of this money, how much I will not get. So let us say randomly I am writing, sir. I believe that 1 lakh I will not get, 1 lakh I will. Random. Remaining all cash flows I will get. This is step 1. Step 2. Compute present value of cash flow not expected receipt. The above cash flows that whatever you are not going to receive, discounted to today. So get the present value. And the step 1 ke present value you have to do. Discounted at original EIR. Don't take today's market interest rate and all. Whatever EIR is there, that only. Step number 3. The main step focus kar. It is called as expected credit loss. Then impairment loss, ultimately loss allowance. What you will do is, step number 2 lo whatever present value of loss is there, that you should multiply with probability of, if they make a default, then no, loss he will suffer. Will they make a default 100%? Don't know. You can estimate what is the chance of them making a default. Probability, so you have to multiply. Let us say some numbers I will introduce. 1 lakh at the end of year 3, I will not get. 1 lakh at the end of year 4, I will not. If 1 lakh and 1 lakh, the present value I worked out. Let us say it came to 1 lakh 40,000. Yearly correct only, but roughly average. It does not mean that I will suffer loss of 1 lakh 40. 1 lakh 40, when will I suffer? If the company makes a default, then I will suffer. What is the chance of they making? Let us say, the estimating. Let us say it is 5%. The answer is, go and create a provision for this is the model. Story not over. Listen. Starts actually. The probability of default is there, no? The probability of default of 2 types are. One is 12-month probability of. The other one is lifetime probability. The probability of default meaning is, look at this here. You are standing here. In the timeline today you are standing, you stand here. 12-month probability of default meaning is the chance of default happening within the, what is the chance of a default happening in the next 12 months? That is probability of default, 12 months probability. You consider only this thing. If I ask you lifetime probability of default from here to, for the next 4 years low, chance of default is how much? Now apply common sense and tell me which probability of default will be high. Chance of probability of default in next 1 year will be higher. Probability of default in next 4 years will be higher. 1 year will be higher or 4 years will be higher? 4 years will be higher. Why? 4 years by default includes 1 year. Second thing, more into future, more uncertainty. Are you getting it, sir? So somebody who joined here initially, just now is preparing for foundation exam. Exam is after 3 months. You ask him, what is the chance of you failing a foundation exam? Or C enter group 1, or group 2, final group 1, final group. Which chance is here? That you already prepared something, no? Final, inter, all are uncertain. They prepared. Here also risk is there, but at least known risk. But I go into future, I don't know what all I will see, how my life will turn. So more into uncertainty, more risk. Probability of default is. Okay. Now the point is, if you when to use which probability we'll talk. If you use a 12-month probability of default, this is called as 12 months EL. 12 months expected credit loss. If you use a lifetime probability of default, this is called as a lifetime. Whether it is 12-month ECL or lifetime ECL, step 1 and step 2 lo change is not. Step 3 lo no change will. Okay? With what probability you multiply. So ultimately the answer boils down to whether you will create a small provision Then we will create big provision. Normally, big provision when we have to create. Risk is increasing, then you have to create higher provision. Risk is low, you have to create a smaller provision. Do you understand? So, that's the process for that. Now, all this I have written here, step 1, step 2. 12 months ECL means what, lifetime ECL means what and all. Okay, now, main aspect. When to apply 12 months, when to apply lifetime. Then you are given important ones, you discuss that is sufficient. First one, come here, D point you see. Financial assets whose credit risk has increased significantly on the reporting date compared to the date of acquisition. Imagine, sir, a company issued a bond. A bond is rated AA. AA rated means quite good rating. Less risk bond only. You purchase that bond. 2 years is over. A bond rating fallen down to BBB. From AA rated, it came to B category. What happened? Credit rating fallen down. Does it mean risk has? If risk has increased, you have to go and create a lifetime. Lifetime ECL ka meaning is what? Estimate probability of default over the lifetime of the financial. Okay. Financial assets that are credit impaired at equity. I purchased a financial asset. I purchased a financial asset knowing that a financial asset already default is there. How stupid are you, sir? How can you buy that? Sir, I gave loan to, I am a bank. I gave loan to X Limited, 100 crores. He said, God promise, sir, I will pay you interest on due date. One day early only I will pay. After that, I never saw him. In 3 years, he is threatening me. So, bank has a loan, unable to collect. So, this time, another hero came. Janta Gar is going to happen. Who is troubling you? Sorry. Don't worry. How much he has to pay you? 100 crores. Factor what he did is, he paid me 60 crores, full and final settlement. Right to recover, I sold off to him. So, this hero what he did, he purchased this loan receivable from me at 60 crores. What is his confidence? He is bigger gunda, no? Sir, factor name only sounds fancy, sir. Factor means rowdy he is. Wear formals only. But inside full body. So that factor ka confidence is, I will invest 60 crores, I will buy the loan. He will beat him to pulp. I will kidnap his son or daughter. 1 or 2 fingers I will take. He will not pay 100 crores. That confidence. So, factor point of view, if you think, did I buy a financial asset which is already credit impaired? Already default in the loan he purchased. Litigation properties everybody will not buy. Come cheap. Already risk is there, no? Here also you have to go and apply. Any financial asset where amount receivable outstanding beyond 30 days from the due date. Khatam, lifetime ECL. This is why banks are running away from it. And 90 days they are crying today. On 31st March, what will banks do, sir? They will call every client, sir. 100 rupees is deposit. One credit in your account, your classification will be little above, less provision we have to create. The banks will keep on begging their customers. Some credit, interest portion at least to put little. So that we can create lesser provision. I am not asking you to repay. I will beg. 90 days. The standard says when outstanding amount crosses 30 days beyond due date, go with the lifetime ECL. This is the reason banks are not applying it. Running away. He saw this cannot be amended. The fellow is not coming forward. Anyway. If risky cases are all risky cases, lifetime ECL. Then when will you apply 12-month ECL? Go any other case. Any other case means it's a case where credit risk has not, credit risk is low, less problem. Now again order you see from where we started. Step number 1, identify the cash flows that will not come if a default occurs. Step number 2, discount it, work out the present value. Number 3, a present value, multiply that with what? Probability of default. That probability of default could be either a 12-month probability of default or it could be a lifetime probability. Lifetime probability of default you will use when risk is high. Risk is low, you will use a 12-month probability. Clearly here, now coming to the accounting part. Over concept is over accounting. Now, how will you account this? Accounting depends on which method you are applying for your financial asset. For example, in your balance sheet, financial asset is something like this. Loan receivable is there. On this loan receivable, you are already applying ACM. Now we have to create a loss allowance. Standard says write this in. Pure account debit. Loss allowance. A loss allowance is nothing but provision for doubtful debts account. Nothing else. Inching. This is 1 lakh. Loss allowance is a separate account which is having credit balance, but that's not a liability, as asset related loss provision. So you will show a reduction. Appear it. There are 2 ledger accounts which are offsetted for presentation purpose. Are you understanding this? When account is maintained at ACM. Sir, what if I have investment in bonds which is measured at FVTOCI. Since it is measured at FVTOCI, a number is perfect. You should not touch the investment account now, because a number is already appearing at what value? Fair value. So then what should I do? What you should book the loss in PRL. Since when you fair valued, a impairment loss already would have travelled to where? OCI. Put it back in OCI, the loss what you charge, and take it to PRL. So the entry will be PRL to entry. The accounting for impairment loss depends on which method you are financial. You observe in the second case what is happening. I am not touching the investment account directly or indirectly. Whereas in the first case, you have to disturb the investment account there. Here it is not appearing at fair value, so I disturb. Here it is appearing at fair value, don't disturb. But any which way P&L debit is common. Next. Okay, tell me, sir. Now what is the carrying amount of a financial asset? First case. 1 lakh was there, then you adjusted 7,000. It became now how much? 93,000. Zero time. After 1 year, again next year I have to record interest income. What is the entry for interest income again? Financial asset account debited to next year. I have to apply again year then. Question is, 10% you will apply on which amount? Gross. Don't forget the example. You are standing at 0 time today. So today you created a provision. After 1 year, again you have to recognize interest income. No. Entry is what? Financial asset account debit to interest income. When you record that entry, amount 10% you have to apply on which amount? Will you apply on gross or will you apply on net? Gross or net? Apply only on net amount, should not be per the gross amount. You have to apply interest rate only on net amount and default is certain. Default is certain means what, sir? The other fellow openly telling I will not pay. Unnecessarily estimate and all don't do. I will give you peace of mind. Interest I cannot give you. Peace of mind I will give you. To do anything I will not pay more. So now I will not pay you interest. Principal I will pay. Shut up and take. Do any overaction and all. Principal also you will not get. Okay, sir. Interest. Default is certain. Okay, so net amount. This is the story of impairment. Now this entire thing is called as expected credit loss method, the official method given in Ind AS 101. And it also tells that instead of doing this method, entities are at a liberty to follow any other method also. Any other method, generally what will they follow? Debtors, they will do aging analysis. I have a lot of debtors in my balance sheet. This fellow will have a policy outstanding from 0 to 30 days, 1% provision. 30 to 60 days, 2% provision. Beyond 60 days, 5% provision. Beyond 1 year, 15% provision. Like that one schedule they will make, they will follow that. Based on their past experience, they will identify the Sir, is that wrong? That is not wrong. That is also correct. Also allowed. This is also allowed. The question that came in the exam is that, whatever I just noted. They made a table, 2 column. Debtors outstanding from 0 to 30, 30 to 60, 60 to 90. Amount they gave. Percentage of provision question only gave. Requirement is calculate the amount of loss allowance. What will you do? Rupees into percentage, marry them. Total it. Whatever will come. 5 marks came in the impairment loss. But what is there in the background is all the stupidity is there. FC, dramas, it is there officially part of your syllabus. Question is not there till now. IFRS questions are there, exactly fitting questions are there. One question they can drop for 8 marks. Not gone. RTPL question came on this. Where computations are not there, the accounting is there. The PRL to OCA reservoir accounting. Important one. So guys, post impairment discussion we will take up into derecognition of financial asset. Easy concept. On these big questions are not there in study mat or in your ICAI resources, but theory questions are there quite a lot. One good case is there. Easy only. Overall concept is. Now, when will you remove a financial asset from your books of accounts? That is a derecognition concept. One thing is very obvious. When financial asset is sold, then you will obviously have to. Second case, when the cash flows from the financial asset are expired, then automatically financial asset should be removed. For example, there is a bond. A bond will give you 5 interest and 1 principal amount. You purchase the bond, you received all the 5 coupons, you received the principal amount also. What happened to the bond account? It automatically become zero. It's automatically getting derecognition. The cash flows have expired. Second, when you sell the financial asset to anybody, that means what? Risk and rewards in that asset. Transferring it to other party. Therefore, since you don't have risk and rewards attached to that asset anymore, you should derecognize the financial. There is another case. Is I did not sell the financial asset completely, but I have transferred a right to receive cash flow to party. So there are 3 cases of derecognition. Here, easy only, just on understanding the example. 0, 1. Sir, in my balance sheet, I have a financial asset which is in A Limited. I have given a loan received from B Limited from 10 lakh rupees. He will pay me 1 lakh, 1 lakh, 1 lakh, 1 lakh. He will pay me 10 lakh rupees. Now, this is a financial asset on which I am applying some A. Now, this A Limited is in urgent need of money. Fellow went to B Limited. B Limited, you owe me money anyway, but I want money right now, pay off. If you don't have money, come after 5. He is in no mood to pay, but I need money. So I found some other fellow. There is X Limited. X Limited says, I have money. Sell off your loan to me. Hereafter, I will collect the money from B Limited. Today, I will pay you 1 lump sum. Fair enough, I need money. So, what I can do? I can transfer this entire loan receivable to X Limited. If I transfer entire loan receivable, what will happen is all this future cash in Poska right I am transferring to hence principal cash flow ka right also transferred, interest cash flow ka right also transferred, entire financial asset has to be derecognized. Here, we'll look at another. What I told X Limited is, X Limited, I will transfer right to collect the interest fee. Principal right will be with you. So, what will X Limited get now? Every year, 1 lakh, 1 lakh, 1 lakh. 10 lakhs he will not get anything. This is one type of. Another, in this case, since you are not completely transferring all the rights, will not be eligible for complete derecognition to only a partial derecognition. Entire 10 lakhs you should remove, some portion of 10 lakhs you. Another case. You say that out of every interest payment, 50% is transferred. 50% you will retain. Principal totally retained. So first case, all cash flows transferred, complete deal. Only interest transferred, partial deal. Only principal transferred, partial deal. A portion of interest, a portion of principal transferred, then also partial deal. Means there will be cases of complete derecognition, will be cases of partial derecognition. The partial derecognition once upon a time was a very famous question in the finance. But last 7-8 years when Ind AS has come into it, they removed those questions. They are not available. Why they have removed is those questions which were asked once upon a time in the finance, whatever solution given by ICAI. At that time, Ind AS was not there. Despite that, only instruments was part of CA final syllabus. And the solutions were wrong. Our solution now they cannot ask. They cannot give. So questions are removed of everything. Today only theoretically partial derecognition concept exists. Practical numbers are not. Coming to the next point. Financial asset you have to derecognize. Most important condition. Transfer of risk. Hereafter, whatever benefits, whatever risks are there in that particular financial asset, all should belong to the counterparty. Only when risk is transferred, then only you can. Sir, when risk is transferred, what is the entry? The other party will pay me money, take that money. Financial asset you will derecognize at carrying amount, whatever book value it is. Entry will not tally, gap will go into in or sir, my investment is measured at FPT OCI, sir. Sir, at FPT OCI measured at ACM, you measure. Derecognition gain or loss will go only to directly go to PRL only. Cannot go to OCI and all. Free gain or loss on this will go only to. Now, tell me, sir, based on your intertalent, credit sale entry. Sir, debtor account debit to sale. Okay. The debtor gave you a bills receivable. What is the entry? Bills receivable account debit to debtor. So debtor died, bills receivable came. Bills receivable are discounted with the bank. Bank account debit, discount account debit to bills receivable. First debtor was there, we cancelled debtor. Debtor plus a bill came. Bill is now discounted. Bill plus what came? Cash or bank you record. Correct? Now who is having bill? Bank. On the due date, what is going to happen? Bank will present the bill to the customer. The customer pays happy. Customer does not pay, they will take money from your account. So, you know, when you gave a bill to the bank, the bank accepts the risk of bad debt also. When the bank accepts the risk of bad debt, the customer does not pay, the bank is bad, like what? Will they say like that, or will they take money from you? They'll take money from us. That means risk is transferred or not transferred. You need to remove this. You wrote bank account to bills receivable. You removed bills receivable, no? How could you derecognize bills receivable when risk is not transferred? Wrong accounting. Entire childhood was there. Risk, yes, let's not apply. Conceptually, we must understand. Risk is not transferred. Bank, why will it accept bad debt risk? Where bank is not factor, no. You should not derecognize bills receivable. Then what should I do? Listen. when you receive money on sale of financial assets, but risk is not transferred to the other party, then you should recognize it as a. Sir, what about my financial asset? I will stay with you only because risk is still there. Where so, debtor account debit to sale is correct. Bills receivable to debtor is also correct. A bill when you discounted with the bank gave you money, entry is bank account debit to financial liability. You should not eliminate the bills receivable. The balance sheet, what is there now? Receivable is also there, financial liability also there, but bill technically, physically is in the hands of bank. Bank will go and present it to my customer. If the customer pays the money to the bank, the bills receivable and the loan, both they will. Understand, sir? If the customer does not pay, what will happen is, bills receivable you will cancel, recreate the debtor account. The amount you have to pay to the bank, no, right? Liability account debit. How do you call it? Risk is transferred, remove the financial. Risk is not transferred, but still receiving money, credit it to a clear till here? Easy only. Next. I have a lot of debtors who are troubling me. Should I do my main business or should I chase this bugger, sir? What I did, I appointed one factor. I sold all my debtors to this factor. Told factor, give me some money to do whatever you want. They will pay. Factor will ask, sir, what if they don't pay? Will you pay me? Here it depends on what kind of arrangement you have. There is something called as a recourse factoring. There is something called as a non-recourse. Recourse factoring means factor will collect whatever he is able to collect. Whatever he is unable to collect, our loss we only have to bear. He will come back to us. I have to pay back the money back to the recourse factoring. The risk is not transferred. The risk is not transferred to the factor. Financial asset should not be derecognition. In a non-recourse factoring, what will happen is, I give debtors to you. If you are unable to collect, that is your loss. If you are going to threaten them, blackmail them and collect more, that is your gain. Understanding the risk and rewards are transferred when non-recourse. In that case, entire debtors must be. This is the basic. In this, one special case is there, which is called as continuing involvement. I'll show you a question. From there I will take you. This is there in study material also. Follow this question. Study mat question is also there. Next is that only. But that question, one mistake is there. So that's why that example I am not taking. What's the example? Easy only. A Limited has a trade receivable of 10 lakhs carrying amount. It has sold the right to receive cash flow to a factor Extinguishment for a lump sum consideration of 9 lakhs. 10 lakhs book value, sold it for 9 lakhs only. Show the accounting in the books of A Limited in the following cases. First case, the transfer to X Limited is on non-recourse basis. Non-recourse basis means risk is transferred. Since risk is transferred, can I derecognize my financial asset? Yes. So in this case, the entry what this company should write is bank account debit 9 lakhs, your trade receivables or debtors 10 lakhs. This is definitely a loss which transfer to PR. Case 2. The transfer to X Limited is on a recourse basis. Risk of bad debt is not transferred to X Limited. And risk is not transferred. No. Since the risk is not transferred, I am receiving the money. You will only create it as a financial amount payable to the factor. Are we clear with this second one also? These two are easy cases based on what we have discussed. Third case is a danger one. Carefully understand the case. A Limited has transferred the right to collect all the trade receivables and given guarantee to the factor to the extent of 2 lakh rupees. And the fair value of the guarantee given is 30,000. The company told the factor that to take the debtors, collect it. If you are unable to collect it, we will repay to the extent of 2 lakhs. We are not giving full protection, but we are giving a guarantee up to only an amount of 2 lakhs. And the worth of the guarantee is normally For example, you take a bank loan. Banker told, bring somebody of high credit worthiness, then only I'll give you loan. That fellow should give guarantee to me on your behalf. You went and you brought me. This fellow is not sufficient. Somebody big. Not somebody. That somebody, why will they give you guarantee on your behalf to the bank? Will anybody accept risk freely? Yeah? They will take money from you. If you pay money only, guarantee will be given. For example, in real life contracts, you have to give bank guarantee. Just because you took loan from ICICI Bank, I took loan from you, you are earning interest because of me, give guarantee on my behalf, they will not give. Give guarantee, but that also put security again. Commission you pay, then I will pay. I will give you guarantee. Guarantees are not free. Okay, so anyway. So like that, the guarantee what I gave to the factor, a guarantee ka worth is, we will talk more on that. Now, how to handle this case? First entry, bank account debit. Derecognize the debtors. You got a loss. Limited to the first entry. Second entry. Did I give a guarantee to the factor? They give a guarantee to the factor. Up to what amount of debtors did I give guarantee? Just because I gave a guarantee that overall loss I will suffer on your behalf maximum 2 lakhs, does it mean that really my loss is 2 lakhs? Sir? What is my loss? Really, what is the worth of this guarantee given in the question? So, what our standard says, the extent of 30,000 create a potential liability guarantee. This guarantee is accounted using liabilities law will study. Okay, just for a hint I am telling you. AFM law option valuation, options valuation, call option, put option valuation is a premium calculation. How much option premium a writer will charge? What is the likely payoff on the maturity date? Then discount it to today. Number only they will ask it. The option gets exercised in future. How much gain holder will make? How much I have to pay to the holder? That you discount it to today. That is the amount of call premium. If you apply any method, ultimate summary is that only. Why? Future law, because of this guarantee, how much loss I am going to, that is fair value of that. Guarantee ka fair value means because of this guarantee, how much you are going to pay to somebody. You are likely to pay. The 30,000 represents indirectly it represents expected. Like how option premium represents future ka payoff to the holder, that the guarantee ka value represents future ka loss to the opposite party. So I am going to pay this. That other fellow is not paying any money for guarantee. If he pays now, instead of PRL I would have recorded bank to. So since he is not paying anything, I am debiting it to. Our third entry is very nice entry. What is this? When I am standing as a guarantor to him to the extent of 2 lakhs of debtors, our company is still interested in the debtors to the extent of 2 lakh rupees. Daily I am praying to God. A 2 lakh rupees default I should not. Once you sold the debtors, you should not be interested, but I am still involved because I gave a guarantee. When you are still interested, still risk is there with you. With what phase did you remove entire 10 lakhs? It is wrong, no. But I removed. And it says, to remove, create again with a different name. Called as continuing involvement financial asset. Why I have to create an asset again? Because I am still interested in the debtor. Risk is still hanging on my head only to the extent of suppose a debtor really paid the money. 2 lakhs also paid. Can I keep that money? Money belongs to whom? Though I am interested in the debtor, money does not belong to me. Create liability. Associate basically last entry what I wrote is a dummy entry. One dummy asset and one dummy liability we are creating just for a display in the balance sheet. Sir, if I write only this, what will happen? Debtors get removed. Balance sheet nothing is visible. Debtor are not there. But am I still interested in the debtor? When I am still interested in the debtor, a 2 lakhs interest should be reflected somewhere. No. So, artificial dummy entry. What ICAI has done is they mix all these three and wrote a single. This is what ICAI. I told you financial liability guarantee, associate liability 2. That fellow merged both of them. They are calling both as associated liability. Wrong actually. Not do like. Because the associated liability is a dummy account. Whereas the FL guarantee is a real liability. And FETPL accounting is there. That's the reason I am not showing this question. I just called the number. The reason a question never came in like. Never came. 7 years, sir. Never came till the reason. Why is that? Put in correct and ask no. Who will remember that compound entry, sir? It nicely. This is how you do it. Then, just for understanding, I am telling you. Next year, imagine bad debts actually. So, factor suffered a loss of how much? We stood as guarantor to the extent of 2 lakhs. We have to pay him 50,000 now. But in my books, guarantee liability is recorded at what value? What you should do now is your financial liability. Now, will fair value at FETPL level. Financial liability, guarantee account to the moment I pay this 50,000, remaining debtors are collected. I am no more interested in my debtor. Dummy entry, whatever you wrote, simply have to say associated liability to continuing involvement finance. Have to derecognize this dummy asset. Understand, sir? So, if you club that associated liability and financial liability guarantee into one single account, how will I account it? Financial liability guarantee is separate, associated liability, dummy liability is separate, separately you have to have. Sir, what if bad debt is 0? Bad debt is 0, factor never suffered any loss. I need not compensate anything to him, but unnecessarily I created a liability of 30,000 last year. What should I do now? Let reverse it. Financial liability guarantee to motor. Need not pay him anything. The entry is same. You understand, sir? Now come to first case once again. What is the book value of a debtor? Carrying amount. Carrying amount is how much debtors? How much did factor pay you? Lakhs. Today you paid him how much? First case. 50,000. So he paid me 9 lakhs. I paid him 50. Effectively, I only received an amount of 8,50,000 for a book value of overall loss 1,50,000. 1 lakh. Total 1,50,000 losses. Come to second case. Second case, he paid me 9 lakhs. I never paid him anything. So overall, I only received 9 lakhs. Book value 10 lakhs. Loss is how much? Here 1 lakh loss booked. 30,000 loss booked. 130. 30,000 reversed. Actually 1 lakh loss only. Naturally, that process will happen. This stupid fellow, he did it wrong answer here. Can't club this. This is derecognition continuing in one. Actually, good concept at this point. In this three special cases are there. Then listen to this carefully. Remaining Repurchase agreement. Repurchase agreement means sale and repurchase. I sold, at the same time I made an agreement to buy back again at a later date. Follow this example. Standing at 0 time, I have a financial asset there in my bank. So today this financial asset is for 10,000. With an agreement that after 1 year, X Limited will again sell this back to repurchase the financial. Cash portion I am paying you will pay him an sale with repurchase concurrent. Answer is you should not derecognize. Today you sold. Later on anyway the asset is going to come back to you only. And prima facie derecognition, what is the main criteria? Then reward should be. Once go into the shoes of X Limited, you will understand. Today X Limited is buying the financial asset by paying me how much? 10,000. He holds the financial asset for a period of 1 year. After 1 year, market price of financial asset is 15,000. He purchased it for 10,000. Market price is 15,000. Is he happy or sad? No feeling. No feeling. Even though market price is 15,000, he is still forced to sell this to you only. At what rate? Reward is enjoyed by X Limited. Market price has fallen down to 5,000. He is sitting and crying. He will still sell to you only at 12,000. So, sorry, sale and repurchase. The repurchase price is fixed. The other party risk and rewards are not transferred. And rewards are still there with our zone. Risk and rewards are not transferred to the other party. Our share price increases also, decreases also. The other fellow will not have any. And rewards are not. Right? You understand? Sir, then how will I account this? Tell me. Loan. Our company received 10,000 now. After 1 year, we are going to repay that 10,000 along with interest. Loan accounting you will do. Bank to loan, interest to loan, loan to bank. Clear? In this one, small twist is repurchase price is not fixed. Repurchase is going to happen at fair value. What's the meaning of this now? Today I sold it, the other fellow paid me 10,000. After 1 year, I will again buy from him. How much I have to pay? On the day, whatever market price is there, that much I have to pay. If it is 15,000, I will pay 15,000. If it is 5,000, I will pay 5,000. Tell me, sir, now risk and rewards are transferred or not transferred? The other party is exposed to returns and risks also. Correct? In this case, for move it from there. Sale and repurchase, two cases of it. One is repurchase price fixed, one is repurchase price not fixed. Fixed case lo no derecognition, not fixed case lo derecognition. In this one case, look at this. You have a financial asset. The financial asset today is sold. After selling the financial asset, that buyer is there. To this buyer, along with the financial asset, you gave him a put option also. What does the put option give? This fellow is a buyer today, buyer of financial asset, but he is having a put option. What's the meaning of put option? Whatever he purchased now from me, that he has a right to sell it back to me only at a pre-decided exercise price. Today, derecognizer should not. Same like previous case only. Only difference is previous case or repurchase is forward contract. I sold, he has to sell it back to me. Here I sold, but he has an option to sell. Whether he will sell or not, I do not know. You do not know, okay, but today what will you do? So either derecognize or you should not derecognize. On what basis will you decide that? Answer is put option is there, no, whatever he is having. It is deeply in the money. What does it mean? In the money means what? Likely to be exercised. Deeply in the money, highly likely to be exercised. If that fellow is going to exercise the put, what will happen? Whatever financial asset I sold to him today, that he is going to sell it back to me only after 1 year. That means whatever I sold will again come back to. In any way it is going to come back to you. Why to derecognize? Not. Sir, what about other cases? Any other case? Any other case means who? Just in the money, not deeply, just in the money. Likely to be exercised, but not very likely. The money, at the money, out of the money, deeply, or every other case we have to deal. Only one case. Questions are there, sir. I am not lying, I am not creating all this. They are all there in study mat, MCQs, case studies, our 6th paper, everything will get tested. There all this, endure all this. Same story, a twist. This time, that fellow is not having put option. I myself am having a call option will give me what? I to buy. Today I sold, but if I whistle once, that will again happen. But will I whistle or not? Yes. So, in that case, what will you do? In same answer, answer no change is not there. I will ask the call option deeply in the money, highly likely to be exercised. Highly likely to be exercised, I will whistle. I am already starting. So what will happen? Whatever I sold will again back to me. But anyway, it is going to come back to you. Why to derecognize? Change the case. Answer is same, whether it is put option with the buyer or call option with the which answer will change. Okay, last one. Is actually, but still nothing, sir. It is a small case they developed. You can do securitization. You tell me, sir, securitization, what will happen? There is a bank, a financial institution, who is having a lot of illiquid asset called as loan receivables. They want cash immediately. What will they do? First, they will float another trust, another company called as, to this SPP, they will transfer the loan receivable. And this SPV will pay to our bank cash. First of all, how will they get cash? There will be some cash rich person. There are people who are having a lot of cash on a daily basis. Insurance companies, banks, provident funds, pension funds. Monthly, a lot of cash will be there. They have to invest it somewhere. No. So these people, you sell debt instruments. You study, no? Pay through security, pass through certificates, skipped securities, that securities you to give cash, cash you pay to your originator bank. Our originator bank will transfer their loan receivables. Understand? So, this is all securitization. In this entire drama, if loan receivables has to disappear from here, and if it has to appear here, risk and rewards must be transferred by the originator to the. Risk and rewards are not transferred, a loan receivable also will not be. Loan receivable will be there only, financial liability has to be created for the money risk. second reward if it is not transferred, a loan receivable will not jump from originator books to that one small. Okay, now that we have drawn so much of difficulties, so a bank books low, a loan receivable is there, no? Before the transfer and telling. So, it is a financial asset only, no? So, which method will they apply? I have loan receivables which I am going to pakka sell it, not going to sit and collect. I am pakka going to sell it. Which method I should apply, ma'am? Obviously, I have to go and apply. Clear? One day I sold. Okay? I sold. When I sold, what happens? Loan receivable will disappear here and they will appear in SPV's books. SPV books, what method will you? Because they are not going to create one more SPV, no. They are going to sit and collect all the cash flows from all these debtors and use that money in paying money to this. Here, last one. The bank has loan receivable. Transfer did not happen yet. You told me already that bank will apply which method? Correct one, you know? Hold on. The bank is now preparing consolidated financial statement. When this bank prepares consolidated financial statement, that SPV is also my company only. Consolidate. Of course, loan receivable is still appearing in my books only. Group point of view, what is the objective of the group? Bank, only HDFC Bank point of view, objective is sell. SPV point of view, hold till maturity. Group point of view, hold only. Our group is going to sell this to somebody else. Here again you have to apply. Before sale, the financial asset appears in bank's books, FETPL. Before sale only, SFSO, FETPL, TFS. After sale is over, this fellow's books, anyway you will apply ACM. Consolidated books, naturally ACM only will come when you do line by line addition of balance sheet. This is one. Okay guys, it's too much for today. Continue. So guys, in the previous session we were talking about financial assets. We are talking towards the end of the concept of derecognition. In financial assets, only one more small concept is left, which of course is never tested in the exam till now, but still easy, important also. What is that concept? That is reclassification of financial assets. Now, what is the meaning of reclassification? As we know, financial assets are accounted under ACM, FETPL and FETOCA. Now, whether you apply ACM or FETPL or FETOCA, on what basis are we deciding that? That is not a random choice, no. That is dependent on what? That is dependent on the business model and the contractual cash flow test, correct? Now, it is sometimes possible that company ka business model may change. For example, once upon a time, I had the objective of holding the assets till maturity. Therefore, I would have applied ACM. But even before that financial asset ka maturity period has ended, in between, our company ka business model has changed. Our business model is now not to hold it till maturity, but to sell it in the short term. That means what? There is a change in the business model. Because there is a change in the business model, the existing methodology what I am adopting for financial asset is not suitable for me anymore. Since I am interested in fair value, every day I am watching the market, I am seeing whether there is a gain or loss. If that kind of objective change is there, continuing with ACM does not make any sense. So now what you have to do, you are supposed to jump from ACM to FETPL. So this is one case. Like that, if you observe, total 6 cases are possible. From ACM, you can jump to FETPL or FETOCA. Similarly, if you are already following FETPL, you can jump to ACM now, or you can jump to FETOCA. If you are already following FETOCA, you can jump to ACM or FETPL. Total 6 possible cases are there. The 6 possible cases. So how to do accounting? That is the story of reclassification. Am I clear till now? Now here important point is, if you have to do this change in methodology, important condition is business model change should be there. It is not like, one fine morning you get up and say, no, I don't want to hold it till maturity. I'm going to trade with these bonds. Therefore, I will go and follow FVTPL. It is not that casual, simple intention. I'm talking about a change in business model. Business model means it is not mere intention regarding a particular financial asset. It is a overall objective of the entity in relation to financial asset. Just to make you quickly understand a small example. Imagine I'm a bank. Also, I receive deposits from public and I give loans to public, right? Now, these loans are long-term loans, 10 years, 15 years, 25 years kind of loans. But out of my experience, I know that even though I am good at giving loans, I am very poor at collecting the loans. I don't have proper collection machinery in my company to recover all the loans which are receivable to me. So, I have developed a practice of I originate the loan, I give the loans, after that I create a SPV and I sell all these loan receivables to that SPV. So, that has been my objective. Now, think from my point of view, when I have a loan receivable in my balance sheet, though it is a 15 years loan, I do not have the objective of holding till maturity. My objective is only to sell it. Since my objective is only to sell it, which method I should apply? FVTPL I should apply, and I am applying FVTPL only, correct? No? Now what happened? Our company acquired another company, business combination transaction. That another bank, what I acquired now, that bank has very strong recovery mechanism. There are proper legal team there. There are agents who go and suck the life out of our debtors, collect the money from them. So they have a proper recovery mechanism. Now that I acquired that bank also, that legal machinery is coming into our company also. So now my company is also able to recover the debt on our own. Because of that, my business model in relation to this loan receivables is now changing. Earlier my goal was to sell, but now I have all the ability and capability to recover my receivables. Why will I sell now? I am going to hold it till maturity. Now which method is appropriate for me? ACM. Are you getting it, sir? Business model means it's not simple intention. Business or some change should come where my way of looking and handling the financial assets also should change. Am I clear? This is called as change in business model. When change in business model happens in the current year, you can apply the new method not in current year from the beginning of next year. Reclassification is permitted but not immediately. If business model change happens in the current year, reclassified accounting, that is the new method accounting, you can apply only from the beginning of next financial year, not immediately. Not immediately. Are you clear? 2 points if you understand, then how to do accounting in each of those 6 cases we will discuss. Clear, sir? In this one important point once again, it is already discussed, but still I am telling you, if it is an investment in equity share, you prima facie have only 2 choices, FVTPL, FVTOCA, and this choice you have to make at initial recognition, and whatever choice you make, that is an irrevocable option. You cannot jump over or change your method. If you have selected FVTOCA, lifelong FVTOCA only. If you have selected FVTPL, lifelong FVTPL. You cannot change. So whatever reclassification we are talking now, that is not applicable for investment in equity. Any other financial sector we are talking. Clear, sir? Now, there are 6 cases. Now, how to jump from one method to another method? Accounting you have to learn. Now, listen, sir. The accounting is highly conceptual. I am not saying it is tough. I am only saying that it is difficult to remember. You understand it. If you understand it clearly, you need not revise also. Apply common sense. Answers will come correctly. You try to by heart that, you will spoil it. Okay. Now, I will show you one small example. With that example, we will try to understand this case. It's already solved example, you can watch on the screen. A Limited has purchased 10% debentures of the face value 10,000 rupees, which are issued at 20% discount. 8,000 purchased and are redeemable after 4 years at par value. Okay. And the original EIR in the financial asset is 17.3%. If you observe closely, face value 10, but I purchased the bond only at 8,000 because the bond is issued at discount. A bond has a life of how many years? 4 years. And each year I will receive some amount of coupon. How much coupon will I get? 10%, 10%. And that 10% have to compute on what? Face value. So 1,000, 1,000, 1,000, 1,000. And towards the end I will also receive my par value of 10,000 also. He says that since you purchased this bond, in this bond, the return you are going to enjoy is 17.3%. Even though the coupon rate is only 10%, my return from this bond is 17.3%. Why is that? Because I purchased at discount and ultimately I will get redemption at par. So there is an extra gain apart from the coupon. Overall return is 17.3% per annum compounded basis. So during second year, there is a change in the business model of the entity. Stop there. Business model changed in which year? Second year. So new method can be applied from beginning of third year, not in second year. The fair value of the financial asset is as follows. First year ending fair value is given 8,500. Second year ending fair value is given 9,500. Show the accounting for reclassification in all the possible 6 cases. Now, what is your existing method? What is your new method? I did not commit to that in the question data. I simply gave you data of a bond whose EIR I have given, whose fair value in the year 1, year 2 I have given. Now I will assume all the 6 cases with the same data. You will understand it more clearly how it works. Okay. Now, what I did is, I prepared an ACM table for year 1 and year 2. ACM table how to prepare? Opening initial recognized amount plus interest income at the end of first year minus contractual cash flow received and closing balance first year. Similarly for second year. Had somebody followed ACM, then by the end of second year their balance would have been 8834 in their books. Had somebody followed FVTPL or FVTOCA, then their balance would have been 9,500 by the end of second year. What is your existing carrying amount of the financial asset at the end of second year or beginning of third year? That we should know. No, for that purpose I have worked out. Clear, sir? Now, you tell me, sir. Don't think anything. Simple, very easy. First case I am taking, you are jumping from ACM to FVTPL. What should I do? What is your new method? FVTPL. Under FVTPL, the financial asset should always appear at fair value. But in my books, is the financial asset appearing at fair value? No. In my books, financial asset is appearing at 8834, which is as per ACM method, correct? But what is the latest fair value as on today? 9,500. So immediately what you have to do? Fair value the financial asset. From 8834, increase it to 9,500. Okay, so with that you will get a difference of 666, 666 gain you are getting. Tell me what is the entry will write now? Financial asset investment account debit 666 2. Again, where will it go? What is your latest method now? FVTPL, so this gain will happily go off into PR. This is one way of presenting. There is another way of presenting that is also correct only. What is that is, your existing investment whatever is there, a investment you completely cancel. Recognize new investment 9,500. Then also 666 gap will be there. A 666 gap you will take it into PRL. Any which way impact is same. Balance sheet impact is same. PRL impact is also same. Am I clear here? This is one method. Now tell me, in the same method, one more discussion. Year 1, year 2, you measured interest income based on EIR. Now that your new method is FVTPL, you should discontinue EIR. Sir, imagine in third year completely I held the bond. Third year ending I received the coupon amount of 5,000 rupees or 1,000 rupees from the company. What will I do? Directly book it as income in your PR. There is no EIR application. Till last year you never fair valued your financial asset, but from here after you have to fair value every year ending. Correct? No? That's also the first method. In this, your only thought process is I should do prospective accounting. First method is done. Let's talk about second method. ACM to FVTOCA. Since you are following ACM, in our books financial asset is already appearing at 8834 by the beginning of third year. But had I followed FVTOCA, or since I am following FVTOCA from now, my investment should appear at fair value of 9,500. So again you will update. When you update, again same accounting, investment account debit 666. This time instead of going to PRL, OCL, some reserve you have to create. Clear till now? Right. This is one thing. Till last year you are measuring interest income based on EIR. Since EIR is applicable even under FVTOCA also, you will continue applying EIR only. Your interest income under FVTOCA should be same as if you are following ACM. ACM lo whatever interest income you will recognize at the end of each year, same interest income must be recognized even under FVTOCI also. So that's why you will continue EIR. Till last year, you never fair valued your financial asset at the end of each year. But since our method now is FVTOCI, you must fair value the financial asset at the end of each year. And whenever you fair value, gain or loss will go where? OCI reserve will go. Clear, sir? This second method. There is nothing extra you have to remember. It's all very simple. Coming to third method now. This time I am jumping from FVTPL to ACM. Since my old method or existing method is FVTPL, already my investment is appearing at what value? Fair value of 9,500 by the beginning of third year. But what is my new method? ACM. Now, you should not be thinking like this. Had I followed ACM from the very beginning, by now, my investment would have been appearing at 8834. Unnecessarily, I recognized fair value gain in the last 2 years. Let me reverse it. You should not do that. You should not do that. You should not reverse what has already happened. Why I should not reverse? Think correctly. Last 2 years, what was your objective? Holding till maturity. Sorry. Last 2 years, your objective was to sell. Since at that time your objective was to sell, you applying FVTPL in the last 2 years is correct only. You should not reverse that. Your business model changed and therefore you are changing the method now. Up to last year, that accounting is correct. From here onwards, you will not fair value. So, you will not go and nullify the fair value gains recognized in year 1 and year 2. That you should not do. Okay, sir, hereafter what should I do? Simple. Hereafter, don't do fair valuation. Because what is your new method? EIR. Sorry, ACM. ACM. Now, under ACM, I have to recognize interest income on EIR. Now, how will I apply EIR? You are at the beginning of third year. This is third year ending. This is fourth year ending. Okay. In your books, already investment is appearing at 9,500. What are your future cash flows? 1,000 coupon here, 1,000 coupon here, and 10,000 par value. What you will do is, you will map these cash flows to this 9,500 and now work out a new EIR. With this new EIR, you will continue applying ACM. Hereafter, there is no fair valuation. An important point under last 2 years, whatever fair value gains you have recognized in your PRL, do not reverse it, do not nullify it. Today in your books, investment is appearing at 9,500 fair value. Simply remember like this, it is as good as you purchased the investment right now. And you want to apply ACM hereafter for the next 2 years. How you will do? Likewise, you have to continue. This is one case. In case ECM, EIR, if you work out, something come around 13% or something, 13% you will apply ACM. With FVTPL to ACM jumping. Next one, FVTPL to FVTOCI. My investment in my books is already appearing at 9,500 fair value. My new method is FVTOCI. That is also a fair value method. In that also investment should be appearing only at fair value. So I should not disturb the investment value that is given. Next. Till last year, whatever coupon amount I received, I directly put it as income in my PRL. But now that I am following FVTOCI, I cannot do like that. I have to recognize interest income only on the basis of EIR. And FVTOCI interest income should be exactly same as the interest income had you followed what? ACM. Correct? So what you will do? Again the same thing. In the previous method, how we worked out EIR, same EIR will be applied here also. This 13% will come. Since your new method is FVTOCI, accumulated gains in your, every time you will fair value the financial asset and gain or loss will be accumulated into your OCI. So 1, 2, 3, 4 methods are over. Coming to the last 2 methods. You are already following FVTOCI. From that you are jumping to FVTPL. Okay, tell me this, sir. So very interesting case. My books investment is already appearing at 9,500, which is fair value. Under FVTPL also, it should appear at fair value only. So I don't have a problem with the carrying amount of the investment per se. Till last year, I applied EIR for measurement of my interest income. Here onwards, you will discontinue EIR. Sir, why should I not apply EIR? I like EIR only. No, sir. No. Sir, EIR, if you have to apply EIR is IRR. IRR applies your sir, total life of the asset, whatever cash flows are there, all the cash flows you should be able to experience. That you will be able to experience when only if you hold the bond till maturity. If your new method is FETPL, you are indirectly what you are saying, I am going to sell the bond. When you are going to sell the bond, you will never get the maturity value. When you will never get the maturity value, EIR to income, how will I measure? I cannot measure. That's the logic for that. Here important question is, last 2 years whenever you fair valued, that gain you parked where? OCA reserves low you parked. Now what will happen to this reserve? The OCA reserve, whatever is already accumulated in your balance sheet, because you are following FET OCA till last year ending, but from now onwards you are following FETPL, the OCA reserve cannot exist for you. What you should do is this OCA reserve you have to reclassify to PRL. OCA reserve reclassification to PRL is not allowed for investment in equity shares. But any other financial asset to OCA reclassification to PRL is allowed under financial instrument. Entire standard, any financial asset related OCA reserve can happily go to PRL when the gain is realized. Except in the case of investment in equity shares which are measured at FET. This is last one, sir. The dangerous ones, you have to keep it towards the end. Easy, conceptual, but you should be careful. What is your existing method? FETOCA. So, in your, if I open your balance sheet, your investment is already appearing at 9,500. Since your method is OCA, you must be having a OCA reserve of 666 also. That is your fair value gain for first 2 years put together. What is your new method? ACA. So what should I do now? Think, wildly think, all the thoughts, let it entertain. Entertain all the thoughts and get me correct answer for this. ACM is fair valuation there or not there? Not there. So what, one thought of answer is, what is there, sir? Hereafter I will not fair value. Fantastic. Till last year I recognized interest income based on EIR. Ade EIR you will continue now also. No problem. Next, my question arises, what will you do with this? OCA reserve accumulated first 2 years fair value gain 666 that is there in your balance sheet. What will you do with that? You will never sell, no? You say that you will recycle it to PRL or transfer to retained earnings. Both are wrong. Wrong. There is only one way. I'll tell you why. What was your previous method? FETOCA. Tell me who will follow FETOCA? What objective you should have? Hold till maturity, or it can be sold. Dual objective fellow will follow FETOCA. Now I got clarity. Who will follow ACM? I have full clarity. I will never sell the bond. I will hold the bond till the maturity. Now tell me, sir, when you never will sell the bond, will you ever get fair value gain? Fair value gain, who will get? That fellow who is going to sell the asset, he will get market price fluctuation. If I am going to hold the bond till maturity, market price let it dance, will he get the gain? That means, he gain whatever you recorded here, you will never realize it. In lifetime it will not come to you. Why will it not come? Because I will never sell the bond. When you will never sell the bond, a gain is unrealized now, will be unrealized forever also. How can I merge it to retained earnings or PRL? Cannot do that. So what I should do? I should go and knock it off from the investment. Remove it from the investment cost. If I do that, what will happen? This amount will become 883. What is 8834? Had I applied ACM from the very beginning, by the beginning of third year, the carrying amount of financial asset would have been 883. Here onwards, normally you will apply ACM. Are you getting it, sir? This, if I discuss first, you will think that I am doing retrospective effect. I am not doing retrospective effect. I am not doing retrospective effect. I had no other choice. If I book it to PRL or if I book it to retained earnings, that OCA reserve, you are indirectly saying that I will realize that gain. You will never realize that gain because you will never sell the asset. Come to previous case once again. When you were jumping from FETOC to FETPL, why do you think I reclassified it to PRL? Because till last year your objective was hold it till maturity or can be sold. You followed FETOC and now you are jumping to which method? FETPL. Who will follow FETPL? Objective is purely to sell. That means what? Fair value gain will enjoy or not ultimately. That is the reason here we reclassified it to PRL. Here you cannot follow the same thing because you will never ever sell the financials. Clear, sir? This is about reclassification customer. The 6 cases, sir, the last case alone sounds like a little bit of retrospective. If had I followed him from the very beginning today, what amount would have been there? I amount you should bring. But that is not retrospective effect. In fact, everywhere it is prospective effect, even here also. Only thing is, OCA reserve, you do any other treatment that will give you a wrong signal. So this is correct. It never came in the exam, but it is a very important concept, means interesting concept also. These 6 cases how to account in our material I have given here, you can go through this. So sir, we are done with our financial assets. Now coming on to financial liabilities. Now, financial liabilities is not that complicated or that lengthy as financial assets, pretty easy only. Financial assets, you will apply ACM, FETPL and FETOCA depending on business model, contractual cash flow test and all. But when you come to financial liability, life is very simple. The answer is you will apply ACM in all the cases except in few cases where you will apply FETPL. So all cases you will apply ACM only. Few selected cases are there. There alone you will apply FETPL. FETOCA accounting is not there. There is no business model, there is no contractual cash flow, nothing. Answer straight away ACM. 5 or 6 cases are there where you have to apply FETPL. It's very easy to remember. Now how to apply ACM I need not tell you. You already know. Tell me sir ACM rules. Initial recognition at fair value adjusted with the transaction cost. Interest expense should be recognized based on effective interest rate. On every balance sheet date there is no subsequent remeasurement. Over. That's all you have to do. Are you understanding sir? It's pretty simple. Now there is a story of debt restructuring. Debt restructuring means there is a company is unable to pay or meet its debt obligations. You go to the banker and tell him that bank I am in deep financial difficulties, give me some concession, let us change the term structure of the loan, give me some concessions, I will not be able to pay coupons for the next 2 years, but you will extend the loan, I will repay the principal at a higher amount. Some kind of deal you are making with the bank to change the cash outflows of the loan. This is called as debt restructuring. In this, one small example means one chart I will make, based on that you try to answer. So in my balance sheet, I have a loan, 10 lakh rupees, where EIR is 10%, which is also equal to coupon rate. I am following ACM obviously, and 1, 2, 3, 4. Remaining 4 years life is there in particular loan. Every year I have to pay 1 lakh, 1 lakh, 1 lakh, 1 lakh. Here I have to pay 10 lakhs. Now, I am following ACM. Do you all agree that the present value of these future cash outflows will be equal to this 10 lakhs? Discounted at EIR 10%? You accept that, right? Now what happened? I told the bank that bank I am in worst position. I cannot pay the loan. If you don't give me concession, I will go for insolvency. Liquidation case, you will not get anything, you will stand in queue. Bank says, okay, don't do all that, I will give you some concession. According to that revised agreement, the deal is like this. Here actually I have to pay 1 lakh, I need not pay anything. Here also I need not pay anything. Here instead of 1 lakh, I have to pay 1.5 lakhs. 4th year also 1.5 lakhs. 5th year also 1.5 lakhs. 6th year also 1.5 lakhs. Last year, I have to also pay 12 lakhs. Also pay 12 lakhs. These red color cash flows, whatever you are seeing, they are all the revised cash flow. Because of your debt restructuring agreement, bank and you have modified the cash flows of the loan. Not only that, the loan period also got extended by another 2 years. Till your story is clear. Now tell me one thing, sir. is the present carrying amount of the loan, representing the present value of your revised cash flows. Will ACM work now? ACM, when will it work? If the cash flows of future are unchanged, timeline is unchanged, undisturbed, then only ACM will work. You go and tweak that cash flows. On the other day, we were talking about staff loan ka prepayment. That bugger came and paid me one installment in advance. Because of that, what happened? My cash flows are spoiled. Cash flows changed. Term loan 3-year remaining loan became a 2-year remaining loan. As a result, ACM will fail. What did I do? I updated the carrying amount of staff loan account. Likewise, here also ACM will not work when you go and disturb the future cash flows. Now, I will not tell you what is there in the standard. I am simply asking you how to make ACM work. You tell me. There are two ways, sir. You will tell me both. Think peacefully and answer. This is important. How to make ACM work? Okay. One method is, like you said, whatever cash flows revised are there, till today, you discount it using your original rate. What is that? 10%. You will get one amount. Remeasure the loan from 10 lakhs to this amount. If this amount is, let us say, 10 lakh 80,000. In our books already loan is appearing at what value? 10 lakhs. Increase the liability from 10 lakhs to 10 lakh 80,000. That means what? Indirectly remeasure the carrying amount of the financial liability in such a way that the financial liability amount will now represent the present value of revised future cash outflows discounted at original EIR. This is one way of making ACM work. There is another way. This is one way. There is another way. What is another way? Another way is, don't remeasure the liability, change the rate. These are your revised cash flows. This is your existing carrying amount. The amount I will not change, future cash flows have changed. At what EIR I should discount those cash flows so that the present value will be equal to 10 lakh. Change the EIR. This is second way. So either you can change the carrying amount of the loan, or you can change the EIR and you can make ACM work hereafter. Are you understanding roughly mathematically? Now I'll tell you what the standard is saying. What the standard says is, whenever a loan modification happens or loan restructuring happens, okay, wait, right on this it is here. Whenever a loan restructuring happens, you have to see whether this is a substantial modification or not. If it is a substantial modification, you have to do some accounting which is called as extinguishment accounting. No sir, this is not substantial modification, this is a simple modification. If it is a simple modification, to be honest, Ind AS 109 though there is no method given how to handle simple modification. If it is not substantial modification, how to do accounting, Ind AS 109 has got no prescription on that. But your ICAI study material is not silent. That fellow gave two alternatives. Since it is given in the study material, you have to study that. So, two alternatives are these two. One, change the carrying amount of the liability, make ACM work. Option 2, don't disturb the carrying amount, change the EIR. These are the two alternatives which study mat gave. But these two, when you should apply, when the loan is not a substantial modification. If it is a substantial modification, you should do some other accounting called as extinguishment accounting. Now the first question, so how will I know whether the modification is a substantial modification or not? For that, the answer is very, very easy, two steps. Step number 1, take the PV of your revised cash outflows discounted at original EIR. You should never bring a new interest rate, new market rate and all unless you establish that it is a substantial modification. You are in process of testing. Don't change the rate. Indirectly, in red color cash flows whatever are there are red color cash flows discounted to today using 10%. Some number will come. To this any expenses, legal expenses, modification charges, something like that the bank is charging, add that also. Let us say this came to 11,20,000. You should call it as A. Step 2. take the existing carrying amount of your financial liability. Let us say that is 10 lakhs. This is B. Step number 3, go and identify percentage difference between A and B. 1120 minus 10 lakhs upon 10 lakhs into 100. If this is greater than or equal to 10%, this is referred as a substantial modification. So in every restructuring question, you invariably have to do these 3 steps. Identify the PV of revised cash outflows, add legal expenses, compare the total amount with the existing carrying amount, observe the percentage change. If the percentage change is 10% or more, then the standard says that you have way too much modified the loan. You have to do extinguishment accounting. Now, what is the meaning of the word extinguishment? Extinguishment, general English meaning is what? Making something disappear. Fire extinguisher, what does it do? Make the fire disappear. Like that, here also you should make the existing loan disappear and create a new loan. So, extinguishment accounting principle is like this. Cancel the existing loan. Loan will have which balance? Credit balance, no? So, existing financial liability, whatever is there, cancel it. This will be cancelled obviously at its carrying amount, otherwise it will not die. Create new financial liability. Correct what amount? On this also you have to pay ACM only, no? So what you have to do? This should be measured at PV of revised future cash outflows discounted at today's market interest rate. Why should I go to market today and work out interest rates? Because you have way too much modified the loan. The standard says it's as good as you have taken a new loan. If you take a new loan today, what interest rate is applicable to you? Interest rate you have to discount. E entry pakka will not tally. In this gap will be there. A gap will go off into. Are we clear till here? Yes. This is the story of extinguishment accounting. Clear? Sir, if process like paid expenses, now what will happen to that? Expenses will go to P&L account. Expenses account debit to bank. Expenses you will transfer it to. So whenever you come across any loan restructuring question, you have to first perform the steps, identify whether it is a substantial modification or not, and if it is a substantial modification, this accounting you have to do. Expenses put it in P&L, existing loan cancel it, create a new loan. Obviously a new loan also have to apply ECM only, no? So a new loan should obviously represent the present value of revised future cash outflows. Only thing is, don't use original EIR. You have to apply latest current market interest rate applicable for a new borrowing. That's it, over. Clear, sir? This is when it is a substantial modification. If it is not substantial modification, that question ka chance is little lesser. It hasn't come till now actually. Reason is, I told you, no, 10 officially there is no discussion on that. But study material questions are there, RTPMT questions are there, you cannot take risk. 4 marks to 5 marks if it comes off, so you should be able to handle it. Now let us talk about simple modification. If it is not a substantial modification, then how to do accounting? First alternative. Whatever expenses you are paying, legal expenses, go and put it in your PRL. Then happily remeasure the carrying amount of your financial liability. To which amount? To PV of revised cash outflows discounted at original EIR. Current market interest rate, when you should use? Only when you are treating it as a new loan and old loan is cancelled. That when will you do? Only in the case of extinguishment accounting, which is the case of substantial modification. If it is not substantial modification, you should not go to the market and bring new interest rate and all. Existing year kane kaam chalao. Hello? Done, sir. Sir, when I remeasure the liability value will either increase or decrease. A corresponding effect where will you give? P&L account. P&L account. Corresponding effect will go to PRL. Clear, sir? This is one alternative. Alternative 2. This is quite interesting. Follow this. My existing carrying amount of the loan is how much? 10 lakhs. Let us say bank collected from you modification expenses of 20,000. The first alternative, what is the treatment of expenses? You put it in PRL. Extinguishment account, what is the treatment? Put it in PRL. But in the second alternative, you know what you will do? You will reduce this from your carrying amount of the loan. You paid money to whom? Bank only you paid, no? It is as good as you repaid some loan there. So effectively your carrying amount of the liability is now only 9,80,000. Now identify the remaining cash flows. 0, 0, 1.5, 1.5, 1.5, 1.5. These are your revised future cash outflows. Randomly I am writing. Work out a new EIR and happily apply ACM hereafter. You only told me two alternatives. No? One is revise the carrying amount. That is one alternative. That's what we did here. The other one is what? Revise the EIR. That is the second alternative. But when you are doing this revising the EIR model, any expenses you paid, that you will have to adjust it to the carrying amount of the loan. Don't take that to your. That's it, sir. This is loan restructuring. The upcoming exam is highly important. Highly important. I'll tell you what are likely questions that we'll discuss towards the end, but this as such is very important. Done, sir. With this, loan modification is over. Next case. Sir, in my balance sheets, let me ask you a simple question. I have a normal creditor. Creditor is also a financial liability only because we have a contractual obligation to pay cash. Normal credit period only, so interest income will, sorry, interest expense will be 0. Normal credit period. Okay, so creditor amount is 1 lakh. That I can pay this money after 2 months, not now, after 2 months. But I had surplus money. I immediately went and paid money to the creditor. Creditor told, sir, I am very happy. I am in urgent need. Luckily you came and paid. So I am giving you a discount of 5,000 rupees. You pay me only 95,000. 5,000 rupees discount you got. This is basically gain on settlement of financial liability. Where will it go? All gains and losses, where will it go? So it will go only to. Similarly, I had a bank loan. A bank loan is for 20 years. I paid interest installments and all for a period of 5 years. Suddenly I won a huge money in some lottery. I went to the bank, I want to prepay the loan. Bank says, sir, but still 15 years maturity is there. No. I don't want to see your face again. Tell me how much I have to pay you. He says, sir, you have to pay, but you have to pay prepayment penalty also. Because you are closing the loan way in advance. No problem, sir, I will pay. I am having a lot of money right now. So the extra amount what you are paying to the bank for closing the loan, that is a loss on settlement. That will go to any gain or loss on derecognition of liability will go to PRL. Just like any gain or loss on derecognition of financial asset was going to PRL, financial liability elimination of gain or loss also will go into PRL. Clear, sir? This is one thing. In this, one more case is there. That is, this is also a very good case. This is actually one good question is also there on this. Sir, you have a loan, 100. You are in worst financial position. You went to the bank, said that, sir, we want restructuring, we cannot pay that 100 crores loan. Bank says, bank accepts to forego 20. Out of 100, I need not pay 20. For remaining 80, entity has to issue 50,000 shares to bank. So just like see internally you did this internal reconstruction chapter where with a big begging bowl this fellow goes to everywhere, Babu forego something. If that bank told okay I'll forego 20, for the remaining 80 you give me your equity shares. Fine. Now first clarity, whatever 20 they have foregone which you need not pay, that is definitely a gain that will happily go into PRL. Now, the remaining 80 ka settlement is happening by way of equity share capital. What you should do is equity share capital and the related securities premium, whatever you will get, this should be recorded at fair value. Fair value of what? How many shares are you issuing? 50,000 shares. If 50,000 shares ka fair value to you have to record that equity part. The equity share capital plus securities premium put together. You know how to split na? Face value is share capital, remainder is securities premium. Let us say this came to 74. Means a liability whose book value is 80, I am effectively settling by giving shares worth 75. In this also I made a gain. How much gain? This gain also will go into, just because that fellow is taking equity shares, you should not go and write 80 here. It is wrong. Sir, this is compound financial instrument. No, compound financial instrument is different. There, is convertible loan. No sir, it is normal redeemable loan. But since I am unable to pay, today that fellow accepted to take my equity shares. This was never a compound financial instrument. It is ordinary financial liability, proper redeemable loan. But because of some exigency in the business, that fellow has accepted to receive our company ka equity shares. So the first time equity component is coming and that has to be recognized at fair value. If you do not recognize that equity part at fair value, you will never recognize gain or loss on settlement. That's the reason you have to record. Clear? Question is a study mat example, official question. Anyways, whatever we have discussed, restructuring, that story is here. The charts we follow. Derecognition discussed. Derecognition of a financial liability by issue of equity. This is an example what I just now discussed. Look at the last entry. Loan account debit settled value to equity at fair value. Definitely gap will come. A gap will go to here. Next. So invariably every case you will go and apply only ACM, but there are few cases where you have to apply FAT here. So what are those cases? Let us see. First one, when financial liabilities are held for the purpose of being traded. Financial liabilities are held for the purpose of being traded. The general example is derivatives. But anyway, derivative accounting I will discuss separately. So I will give you some other example which is other than derivative. Let us take a case of a short sale in a stock lending scheme. So there is SBI share. Today, the SBI share ka market price is 300. One investor feels that in next 3 months, SBI share price will fall. He wants to make a gain out of this information or this feeling. So what he can do? He can borrow shares in the market from some other existing shareholder and sell the shares right now today only in the market, wait for a period of 2 or 3 months, and because he believes the share price is going to fall, and when the price falls, you buy the shares and repay the shares back to the lender. If you do this process, effectively what you are doing is, you are selling now at a high rate and buying later at a low rate, thereby you are making a speculative gain. This is called a short sale, but it is not an intraday short sale, it is a long-term short sale, also referred as stock lending and borrowing scheme. Am I clear till now? Now for this, I want you to visualize one small point. I borrowed share from somebody and sold off that share immediately in the market today. Since I sold off today immediately, my entry will be bank account debit 300 rupees because I sold. Credit, what will I do? Can I credit investment? Is it my asset I am selling? No, you borrowed financial asset from somebody and you sold it off. So bank account debit 300 to, you know what? That is a liability. It's a financial liability. What liability? Because you borrowed share from somebody and sold off, now you have an obligation to buy the same share and repay it to the lender of the share. Correct? Now, so bank account debit to financial liability. And which method you are supposed to apply for this? FATPL. We are discussing that case only. And FATPL ke initial recognition rule is what? It will be recognized at fair value. If I buy the share today only, immediately, how much I have to pay? Today I sold the share for 300. No. Next moment only again I want to pay. At what rate I should pay? 300 only. So bank account debit 300 to financial liability also will be recorded at 300. Because this liability, if I have to settle right now, I have to buy the share at 300. So bank to financial liability 300, 300. That will be our first entry. Of course, this fellow purchased 1000 shares, so into 1000 also will be there. The drama happened on 1st March, sir. Okay. Now, meanwhile, balance sheet date came 31st March. And on balance sheet date, market price became 290. Tell me, sir, as an investor, as a trader, I am happy or sad? Happy. I borrowed the share, sold it off nicely for 300. After 1 month on the balance sheet date, market price is only 290. That means if I settle this today, my cost of buying the share is only 290. But in my books, financial liability is already appearing at 300. Reduce it to 290. There is a gain of how much? 10 rupees into 1000, total 10,000 rupees. This gain will go into PRL. So the FAT will know fair value gain will go into PRL. Now tell me, sir, what is the book value of your liability? 2,90,000. After 1 month, greedy fellow thought that it will come down even further. He waited for 1 more month. By the time share price nicely jumped up to 315. Do I have a choice? No? I am obligated to buy the share in the market at 315 and deliver it to you. 315 into 1000. What is my outflow? 3,15,000. But in my books, liability is appearing only at 2,90,000. Extra 25,000 is a loss on settlement. That also will go into PRL. Clear, sir? Are you understanding? Right. This is one thing. Second case where you will apply FATPL is in a business combination transaction, I am A Limited, I acquired B Limited. B Limited shareholders can paying PC. If PC cash is there, my equity shares are there, some deferred consideration is there. All these considerations are. Apart from these three, there is a contingent consideration also. Contingent consideration means that seller will say, is a fantastic company, sir, you should pay us 100 crores more because the company is going to do extraordinarily well. We have set up all the retail branches and all. Next 3 years, bumper profit you will get. I said, let us do one thing. If next 3 years my profit really is exceeding 100 crores, then I will pay you extra 20 crores. I made a promise to pay consideration linked to an uncertain event. This is called as contingent consideration. Such contingent consideration should be measured at FATPL. Because contingent consideration is a promise to pay amount on a future date. No, of course it is uncertain, but still it is a promise to pay money in future. That's a pakka financial liability. That financial liability should be measured at FATPL. The application we will see when we will go to Ind AS 103. Questions are not there in this chapter, it is there in 103 chapter. Next. When I derecognize a financial asset with a continuing involvement. What is continuing involvement, sir? Somewhere we have heard. Sir, I sold my debtors to a factor and I was also giving a guarantee to my factor that if you are unable to collect the money to some extent, I will come and reimburse you that loss. That is called as continuing involvement. In that continuing involvement, whatever guarantee you have given, that guarantee should be recognized at fair value. FATPL has to be applied. That is third case. Fourth case is a very, very detailed case. I don't think you want to learn it right now because this application is also not there. But still, I will try once. If you understand, it's fine. Otherwise, also it's fantastic. Okay. This is a case where financial liabilities will be measured at FATPL to avoid something called as an accounting mismatch. When an accounting mismatch wala situation is there, to avoid that accounting mismatch, the company may choose to measure the financial liability at FATPL. Now, just 5 minutes, so we'll try to finish it off. Sir, A from knowledge, sir. What is the value of the bond? Present value of future cash flows discounted at required return of the investor. Okay, required return of the investor is based on what? Risk-free rate and also the risk of the borrower. I am investor. I am giving money to somebody. If that somebody is very risky, I am still giving money to him. Won't I expect higher return? Definitely expect higher return. Just for breathing, I will expect RF also. For not doing anything also, I want risk-free return for sure. But for taking risk, I want extra also. Now, do you agree that if required return increases, what will happen to bond value? Bond value will fall down. Similarly, if RR decreases, bond value will rise. Clear? Clarity is there? Now, there is a company, sir. He is having a portfolio of investment in bonds. Many bonds, he made investments. For making investment in bonds, this fellow also borrowed some money by issue of debentures. This is also bond only. And our company handles this entire thing, means is asset and liability as a single portfolio. What is the meaning of handling it as a single portfolio? Is I won't dispose of that investments alone. If I am selling that investments to somebody, that somebody should also accept my loan liability also. As a group only I will deal with that. If you remember in your portfolio management, where there are questions on weighted average beta and all, if you remember, your portfolio consists of security A, security B and risk-free security 3. Sometimes a risk-free security can be negative also when you make a risk-free borrowing. Sometimes risky security also negative is there when you do a short sale. Possible? That means your portfolio may consist of assets with a negative weight also, which are effectively nothing but borrowings. So it is that kind of thing. Okay, now watch this correctly. This fellow, since it's a liability, normally he will be applying ACM. For this, he will apply either ACM or FETOCA or FETPL depending on your business model of how to handle that. Correct? If here you are applying ACM, you will never fair value it. Here anyway you are applying ACM, here also you will never fair value it. As accounting mismatch situation will not come in that case. But here if you are applying either FETOCA or FETPL, what will happen is fair value gain or loss relating to financial assets will get accounted in your financial statements. Simple example, watch this. Suppose market general interest rate and RF has increased. When risk-free rate increases, required return also increases. When required return increases, required return is discounting rate. When required return increases, what will happen to my financial assets ka value? If required return increases, what will happen to bonds value? Decreases. Sir, when my investment loses its value, I will be happy or sad? Sad. But silently inside I am happy also. Why? Why I am happy is when my asset value is falling down, you must understand my liability value also will fall down, because my liability is not ordinary creditor. That is also a debenture, and that debenture I am not going to pay. I am going to sell off that debentures also as a package. So financial liability value also decreases, but now I am happy. This is a loss, this is a gain. What problem will come is, since you are applying FETPL or FETOCA for financial asset, E part is getting accounted, but financial liability, which method are you applying? ACM. Since you are applying ACM, E part is not getting accounted. So your financial statements will be looking a biased way. Asset side loss is recognized, liability side gain is not recognized. Overall you have only a net gain or a net loss in reality. But financial statements only asset related loss is visible, liability related gain is not recorded, because liability is measured at ACM. This is called as an accounting mismatch. In reality I am not sad, but somebody looks at my financial statements and says, you are suffering loss. In reality I am not suffering loss, because when the value here falls, the value here also falls, and I am going to sell them as a package. Overall the loss will be lesser, or overall I may not have a loss also in fact. So instead of reflecting a net gain or a net loss, only complete loss or complete gain only is getting reflected in the financial statements, because of applying FETPL or FETOCA only on the financial assets and applying ACM on financial liability. This is called as an accounting mismatch situation. To resolve this accounting mismatch situation, Ind AS 109 suggests that both, this also, for both of them you will go and apply FVTPL. When you apply FVTPL, what will happen? Gain or loss will be accounted on both the sides. Asset related gain or loss also will come to PRL, liability related gain or loss also will come to PRL. Effectively net gain or net loss only will get reported in your financial statements. This is called as resolving a accounting mismatch. Am I clear till here? On these questions are not there with numbers, but theoretical questions are there. Am I clear till here? Easy only. Now last point, because you are attending our class, some extra points you should know. No? Here we have a financial liability which is getting measured at FVTPL to avoid accounting. Sir, financial liability, so financial liability, who is the borrower? We are only the borrower. In this investment in bond is there. Here we are investors. We invested in some other company. Some other company is the borrower here. Whereas as far as this liability is concerned, who is the borrower? We are only the borrower. Okay, now watch this correctly. Required return from A Limited. Our company ka required return. If somebody invests money in our company, our required return has increased. If that required return increases, value of financial liability will fall. When it falls, I will get a gain. That means when you apply FVTPL on your financial liability, every year you have to fair value based on latest RR discount days you have to work out. In that you got a gain. Since you are applying FVTPL, gain will go where? PRL will go. Now analyze why your required return increased. Required return is based on what? Two things. Market interest rate, which is RF. The other one is what? Risk of the borrower. Who is borrower in this case? We ourselves. Now, this only I am taking two cases now. Case 1. RF increased because of that RR increased. And because of that gain came. Definitely it will go to here. But there is another case also possible. What is another case? Risk-free rate of change is not there. Risk of borrower increase. Who is borrower here? We only. Our company became a worst company, high risky company. Public wants now extra return from me because of that RR increased. Because of that also bond value will fall. Sorry, liability value will fall. Because of that also gain will come. Since you are applying FVTPL, ideally this also will go into PRL. Standard says wait Babu, wait. This will go into. This is the only case where financial liability ka fair value gain will go into OC. What is happening here is, sir, I have a liability. Let's say I am Vijay Mallya. I am having 10,000 crores. My company is suffering huge losses. SBI fellow comes and tells me 10,000 crores are yours. Don't pay 10,000. We will raise 6,000. Pay 4,000. We will go. I am happy or not, whether I will accept or not. First of all, I am happy. No, why am I happy? 10,000 crores ka liability, I can now settle only at 4,000 crores. Tell me, sir, why did the value come down like that? Why is he accepting lower amount? I became riskier. When I became riskier, that fellow is scared. A SBI fellow, he says, "Arey sir, pay me 4,000. I will go on my way." He is coming down. He is lowering the value of liability. I am happy. I am buying tickets to London, but inside I am happy. Now, when you do FVTPL accounting, what will happen? From 10,000 liability, it has to be reduced to 4,000 liability. 6,000 gain is there. A gain should go to ideally where? PRL. Now, the standard says, just because you became worst company, just because your risk increased, just because somebody is coming for settlement to you, you will fair value that, put that gain in your PRL, increase your net profit, increase your EPS, show that you are a profitable company. We don't allow that. So in this case alone, the treatment is, you will fair value it, gain will come, a gain will not go into PRL, it will go into OC. From there it will come to balance sheet. This is the only case where financial liability is accounted in a OCA reserve. Financial liability gain or loss is accounted in OCA reserve. This is the only case. Own credit risk. I own myself became bad Because of that, my liability value fallen down. Because of that, our company got a gain. Again, you cannot take it to PRL. Again, has to be recorded in very deep, but theory questions are there. I am not making up anything, sir. Theory questions are there. In a regular classroom, just to make people remember it, we invented 2 or 3 examples on this with numbers. But theoretically, question is there. In fact, 2 questions are there in study matter. So that is this entire thing. Then financial guarantee. How to do accounting for financial guarantee given? Very simple, sir. I'll directly take full numbers. You understand this example, automatically you will be able to solve the sum. It will come for 8 to 10 marks. Very easy question. Sir, there is Y Limited. Y Limited is in urgent need of money. It went to ICAI bank. Bank, we want money, give us loan. ICAI looked at Y Limited space and said, okay, we will give you 1 lakh rupees loan at the rate of 14% interest. Y Limited is of 14% of market, general interest rate is only 10%. Now, why are you charging 14%? ICAI says, I don't like your face. You are very risky. Since you are risky, I am still giving you money. I want extra return, pay me more interest. And no, sir, I am not that risky, sir. No, you are risky. I saw your past performance and all. They are all having risky customers also. No, sir, wait, I'll bring my father. This fellow brought X Limited. X Limited is the parent company. X Limited tells ICICI Bank that, hey, why are you troubling my kid? I am there, look at my face, I am such a top company. I am giving you a guarantee. ICICI Bank, after receiving this guarantee, it feels that, okay, my risk has come down a bit. But still, this fellow's face I don't like. So, from 14% what I would have charged normally, I reduced it to 11%. So, who gave guarantee to who? X Limited gave guarantee to the bank on a loan which is taken by Y Limited. Here, this fellow is called as guarantor. Ind AS 109 talks about accounting in the books of guarantor. The person who gave guarantee at books law, how to account this standard gives you guidance on that. Okay. Now, answer prima facie is this only. You have to apply FETPL, but there is 1 or 2 more extra points in this. Let's watch carefully. First one, you have to work out the fair value of guarantee. Sir, what is the worth of this guarantee? How will I know? See, because I gave guarantee only, bank gave loan at 11% instead of 14%. So, because of my guarantee, did Y Limited save some money? Money saved by Y Limited is a value of guarantee. So, how to work out that is, normally interest would have been 14,000, 14,000, 14,000. I am taking a 3-year loan. Year 1, 2, 3. But actual interest rate is 11,000. Which means because of my entry and giving guarantee, that fellow is saving an amount of 3,000. This is savings. Now, discount this at normal interest rate applicable to that company, which is 14%. Tell me PE factors, 14% first year, second year, third year. Ah, 0. One more, 877, 0.769. Okay, next. 675. Okay, total return into 3,000. No calculator, fantastic. 69. Is 6963 is the present value of savings in interest cost for how many years? 3 years. This only is also understood as fair value of guarantee on first day. So, in the books of parent company, X Limited parent company, you will happily record a guarantee liability. At what amount did we discuss? 6963. So the question is debit where now? Now for this, if X Limited is charging some money from Y Limited because X gave guarantee on behalf of Y Limited, then you will debit bank. If X is charging something to Y Limited, then whatever amount they pay, you debit it to bank. Liability will be recorded at 6963 only. Gap will go to PR. No sir, they did not pay anything out of love and affection only, I gave guarantee. Okay. Your love and affection can name here is employer-employee relationship. No. Lessor-lessee relationship. No. Parent-subsidiary relationship. And who showed love on who? Parent shows love on subsidiary. It should be accounted as investment in shares of. Suppose instead of showing love on subsidiary, you showed love on somebody else who is unrelated to you. In that case, that is loss. Unrelated fellow, you are not supposed to show love freely, but you showed. In that case, it's supposed to debit it to PRL, depending on the case. Okay. So this is one thing. This is first day accounting, year 0 time accounting. Leave this. Now come to end of year 1. Normally, since this financial liability guarantee is to be accounted at FVTPL, what I should do? I should again fair value the guarantee liability at the end of first year. Whatever change is there, that I will put it in PRL as a gain or loss. Okay. Now, let us do that again. Which is present value of savings. Originally, how many years it was? 3. 3 years. So 3,000 you have discounted. But now 1 year is over. What is the present value of remaining savings now? 3,000 into PVIFA 14% for only how many more years? 2 more years. Please work out this one. Final answer, huh? 4940. In my books, the liability is appearing at what value? 6963. By the end of first year, what is the present value of savings? 4940. I have to reduce it from 6963 to 4940. Wait there. The standard says this is one way of thinking, but in reality, is it possible that a subsidiary company may not be performing well? Subsidiary company may be suffering losses possible because of that subsidiary company risk has increased, because of the chance of default also might have increased. Correct? That means you cannot always value guarantee a number based on interest savings. In reality, what is the risk of that borrower also have to consider. So what our standard says is you computed PV of savings now. Apart from this, also compute expected credit loss. Or somewhere we studied this. Impairment loss on financial assets, or whatever ECL we studied, no, that you do. What is the chance of this subsidiary company making a default? And if they make a default, how much we have to pay? If they make a default, we have to pay total loan amount of 1 lakh. Multiply this with probability of default. A probability you need not worry, question they will give you. So let us say I am hypothetically taking it as 5%. So 1 lakh into 5%, how much is that? 5,000. Now the standard says behave conservatively. Between these two, select whichever is higher. Who is higher? So we must understand that the worth of the liability today is 5,000. In my books already it is recorded at 6963. So from 6963 you come down to 5,000. So what is the entry I should write? Have to reduce, no. So financial liability guarantee account debit 1963 to PRL 1963. That's all, sir. In year 1, same to same, year 2, same to same, year 3, year 2. Normal fair value through profit or loss is simply measuring at fair value. Here what is happening is you have to do 2 computations, select the higher one as the fair value of the liability and then record the measurement date. Am I clear here? Why, sir? Because the interest savings ka story is something which is computed on date of giving loan. But now I am standing at the end of first year. In this 1 year, a borrower ka risk may have changed. So I have to independently work out if that fellow makes a default, how much liability will be there on my head. Adi expected credit loss. Both you work out, whichever is higher you take, then compare that with your existing carrying amount and see whether you are having a gain or a loss. Suppose if this is not 5%, this is not 5%, instead of 5%, if this is 15%, so the answer would be 15,000. In my books, liability is appearing at 6963. From 6963, you have to update it to 15,000. This time what is the entry? PRL account debit to financial liability guarantee. Are you understanding what is happening? Imagine, till the end of third year you go on doing that. Third year ending, a subsidiary company paid the loan to the bank. Do I have any more liability? What is the fair value of the guarantee on the last day? 0. Liability will become 0 on the last. Clear here, sir? That's all. This is a very, very important question. There is one question which came for where guarantee is given for 3 years. Question asked you to do accounting in the end of first year and end of second year. That is one question which came in the exam. Later on, the question came in RTP with a time frame of 4 years. Loan period is 4 years. Accounting you have to do for 3 years. That is numbers only different, matters totally same. Okay, so this is about guarantee custody. Now coming to the most important concept in entire financial instruments is compound financial instruments. Very easy but extremely important also. Okay, now coming to compound financial instruments, which is obviously extremely important. The meaning of compound financial instrument is given in Ind AS 32. The compound financial instrument is a contract where it has the features of equity also, financial liability also. Now, normally thinking, if it is a plain equity instrument, what is the accounting? Initially you will recognize and thereafter there is no subsequent remeasurement. Own equity should never be remeasured. If it is a financial liability, normally you should go and apply ACM unless you fall under that exceptional category, in which case you will have to apply FATPL. But what if an instrument is having the character of equity also, liability also? The answer broadly is this. You have to, on the very first day, split the instrument into two parts. Equity portion separately, liability portion separately. Once you do that split, hereafter game is very easy. Liability you apply ACM, equity don't do anything, it will sit in the balance sheet forever till the end of the maturity date. Here what is important is how to initially split, that is important. How to do accounting throughout the period of the loan. Towards the end, last day, how to close all the accounts neatly. 3 aspects are there. Once you get clarity on this, further what we have to discuss is how to do accounting of transaction cost of compound financial instrument, how to do early redemption of compound financial instruments. That means even though compound financial instrument has got a maturity of 9 years, the company redeemed the bond early at the end of 6th year only. In that case, how will you do accounting for that? In 3 aspects if you discuss, we are completely covering all the questions, all the cases of compound financial instrument. Okay. Now, I'll show you an example. Read this example. We'll use it. Use this. This is not a question officially anywhere, just classroom question only. It will just help you to understand the story better. Please go through it now. Jio has issued 10% debentures of 25,000 redeemable or convertible after 4 years at par value. The market interest rate on similar debentures without conversion feature is 14%. Stop there. On the debenture what I issued, what is the coupon rate? 10. But market interest rate is 14%. Yesterday I told you that convertible instruments ka coupon rate will be lower than the coupon rate on normal redeemable bonds. Because of the conversion feature, definitely the company will have some savings in coupon. That's what you have to observe. Next. Debentures will be converted into equity shares having a face value of 10,000 rupees. In case the investor chooses to take shares, then we will give fixed number of shares. Face value is given, no, that means number of shares is fixed. Show the accounting in the following cases. Case 1, assuming that the conversion or redemption option exists with the holder. Case 2, option exists with the entity. In 2 cases, complete picture we will have to understand, sir. Once you understand this, then we will develop on that. So the solution for that, just watch this. What's the first thing you have to do? You have to split this contract into 2 portions, equity
and liability. We are taking case 1, sir, where the option is there with the holder. Now tell me, if I split it on that liability, which method I have to apply? ACM. And if I have to apply ACM, our liability initial recognition amount should be representing the present value of future cash outflows. Yes or no? So what you do is make a table, identify all the future cash outflows which you are obligated to pay. Obligated cash flows you identify. Now what I have to pay for the next 4 years? Coupon definitely I have to pay. 25,000 into 10%, I don't have a choice, I have to pay. At the end of 4th year, the investor has a choice. He can ask me cash also, he can ask me shares also. But if he asks cash, can I say no? No, I can't say no. That means what? I have an obligation to pay cash also. I don't know whether he will ask or not. But if he asks, I am obligated to pay. Since there is an obligation to pay, the principal amount also you have to include it in computation of your liability. So your cash flows are 2,500, 2,500, 2,500, 2,500 and even 25,000 also. I don't know whether he will ask or not, and you are not supposed to make any estimates for that and all. You have an obligation, khatam, include it. Clear? Discount this with a normal interest rate in the market on a non-convertible bond. You will get one number, 22,087 you got. What is the meaning of this? Present value of future cash outflows. So this is your liability. But actually how much amount did you raise? 25,000. So extra amount whatever you raised, 2913. 2913 is the equity component. Indirectly, how you must understand is, I received from the people 25,000, but I have obligation to pay only 22,087 in today's terms. Okay, for how much money you don't have obligation? 2913. Therefore, it is called as equity component. Are you understanding, sir? So my first day entry will be this: bank account debit 25,000 to liability to equity component. Correct, sir? On that liability you will go and apply ACM. On that equity will not do anything. It will simply stay in the balance sheet till the last day of the bond. Just stay in the balance sheet, happily enjoy, relax for 4 years. Last year we will see what will happen there. Clear till now? Now, if I start applying ACM on that liability, what will happen? Instead of drawing ledger, I have drafted a ACM table. You observe. First year, interest, cash outflow paid, closing balance. Repeat for second year, third year, fourth year also. By the end of fourth year, ideally it should become zero. When will it become zero? If the investor asks you 25,000 rupees cash at the end of fourth year, then this liability will definitely become zero. But I wanted it, did not make it zero, because I will assume cases now. I will assume that he asked cash, he asked shares like that. So I just paid coupons only. My closing balance is 25,000. Liability equity component is 2913. Possibility 1. Holder is asking for redemption. He says, sir, I want cash 25,000. Exactly that is how I prepared my accounts also. Payoff. CFI liability account debit to bank 25,000, 25,000. Liability became zero. Now instrument life is also over now. You don't have any obligation to issue equity shares anymore. E2913 merge it into your retained earnings, general reserve, wherever you want equity low, you merge it off. Clear, sir? Next. Suppose that fellow asks you shares. I don't want cash, I want shares. If he is asking you shares, what you should do is, in your balance sheet you created liability, but he is asking shares. So what you do, cancel this liability. 25,000 rupees also merge it into CFI equity. In that case, CFI equity amount will become how much now? 27,913. From the 27,913 CFI equity, go and issue share capital worth the face value of 10,000. Fixed number of shares anyway. A balancing figure, whatever is there, that you call it as securities premium. Here, what you should not do is, 1,000 shares, whatever you are issuing, 1,000 shares ka market value should not work out and write securities premium and all. That is wrong. If you do that, you are indirectly fair valuing your own equity item, which is not permitted. Balancing figure you have to write. Are we clear till here, sir? Easy only. This is case 1 where option is there with the holder. Now I will not show you case 2. You will visualize and tell me. Case 2 is what? Option to convert or redeem is there with the entity. If option to convert or redeem is there with the entity, Entity point of view, what obligations do we have? Paying 2,500 in first year, second year, third year, fourth year. Regarding 25,000, do I have obligation? I don't have obligation. I don't have a obligation. If I don't have an obligation, I will not include 25,000 here. In that case, the amount will be not 22,000, it will be a very, very small amount. So let's work that numbers also. I remove 25,000 there. The moment I remove 25,000 there, my liability value is just merely 7285. What is 7285? Just the present value of coupons what you have to pay. Extra amount for which there is no obligation is 17,715. Look at the entry now. Entry is same, but look at the amounts. Earlier who was higher? Liability was higher, equity was smaller. This time, equity is higher, liability is smaller. When you apply ACM table and pay 4 coupon payments over a period of 4 years, liability will become 0. You understanding, sir? So by the end of 4th year, this is our position. This is our position. Now, who has a choice? Holder or entity? Entity. Now, entity decided to issue equity shares. Fine. You already have which account? CFI equity. Cancel that CFI equity. Issue equity share capital worth 10,000. Extra balancing figure put it in Securitization. Liability account anyway date, don't bother. Here. Next. Company decided to pay cash. If company decided to pay cash, look at this carefully. Don't ever create a liability account now. Or we are paying cash, no sir, it is a liability. No. It will become liability when you are having obligation to pay. I don't have an obligation to pay. I am making pay cash payment, but I am not obligated. So don't do CFI equity to create another account called as. Don't do this. Then what should I do? From this only you pay CFI equity account debit to bank. CFI equity is there with what amount? 17,000. But how much cash you have to pay? 25,000. Am I paying more cash? In a way, it's a kind of loss only, right? But it is a transaction with whom? Own equity instrument holder. Equity participant to any transaction you do, it cannot go into PRL. It has to be adjusted only into reserves. Equity related, nothing can go into PRL, sir. Here you are paying cash. You are not paying cash to him in the capacity of a financial liability. You are paying cash to him in the capacity of equity instrument holder. Equity instrument ki extra amount you pay, lesser amount you pay, everything will go into retained earnings only. Nothing will go into statement of profit or loss. That's why this you have to adjust it into retained. Am I clear here, sir? This is the maximum you have in terms of the basic structure. Now coming to issues here. Two issues, sir. Let's talk like this. So the company issued bond, received an amount of 1 lakh, 0, 1, 2, 3, 4. Some cash flows they are obligated to pay. All these cash flows you discounted with market interest rate of 14%, and you got an amount of 80,000. This 80,000 we will call it as compound financial instrument, financial liability component. But total amount we raised is how much? 1 lakh. So extra amount whatever you received, this we will identify it as CFI equity component. So what is the entry on first day? We will write bank account debit 1 lakh to CFI equity to CFI liability with amount of 20,000, 80,000. Am I clear till now? This is the basic stuff what we discussed till now. Now, this fellow incurred transaction costs of 5,000. Now peacefully think. When we discussed Ind AS 32, what we said is, you incur any transaction cost in relation to own equity instrument that cannot be recorded in PRL, it should be adjusted into retained earnings. When we incur transaction cost in relation to a financial liability, which is measured at ACM, ACM the transaction cost treatment is what? It must be adjusted into initial recognition value. Correct? No? That means what, sir? Liability related amount should be adjusted to liability only. Whereas equity related transaction cost should be adjusted in equity only. Other equity you have to somewhere adjust. But here I am incurring transaction cost in the compound financial instrument which is having the character of both equity and liability. So ideally what you should do, you should split this transaction cost into two parts. How much is relating to financial liability, how much is relating to equity. So how will I split? The above ratio you have to split. So which is in our case 80,000 is to 20,000, that is 4 is to 1. So this will be 4,000, this will be 1,000. This you will have to adjust to CFI financial liability only. Initial recognition amount you have to knock it off. Whereas this one you have to adjust actually in other equity. Other equity means you can adjust anywhere. You can adjust in retail earnings, you can adjust in general reserve, or in fact you can even adjust to CFI equity also, because CFI equity is also a other equity item. You can adjust there also. Okay. Now, if you want me to write an entry for this, entry wise it is like this. CFI FL, which is 4,000. CFI equity, which is 1,000. To bank 5,000. This is ideally the entry. But my suggestion is, don't write this entry. First net off with the original amounts and directly pass a net entry. What is the original entry if you write it separately? Bank account debit to CFI liability to CFI equity with an amount of 80 and 20, overall amount is 1 lakh. Instead of writing two entries like this separately, my suggestion is net it off. So effectively you should be writing an entry like this. Bank account debit 95,000. 1 lakh I received, 5,000 I paid, net effect 95,000. 2. CFI financial liability 76,000. 2. CFI equity 20 it was minus 1,000, so it will be do this, and hereafter you will continue with applying which method here. For this you have to apply ACM, for which you don't do anything, just simply stay in the balance sheet. So this is clear to know. Last final point. How did you get 80,000? How did you get 80,000? You discounted all the future cash outflows using market interest rate for a non-convertible instrument, isn't it? Right. In this case, since this is your discounting rate, this also will become your AR. And you can happily apply ACM. ACM will apply only when your starting amount is 80,000. But what did you just now do? You went and adjusted 4,000 into that. The 80,000 is no more 80,000. It is now only 76,000. The moment you change of the starting amount like that, you think that 76,000 is the present value of future cash outflows discounted at 14% now? What should I do? EAR you have to revise. The 14% EAR has to be updated. At what discounting rate I should discount all the future cash outflows so that the present value will be equal to 76,000. You have to work out a number. Let us say it is coming to 14.85. This is your revised EAR. With this revised EAR only you will be applying. Clear here, in the questions that came in the exam till now on this model, a revised EAR question they have provided it to you. You will not sit and work out that IRR computation and all, questionnaire they will give you. But you should know why they are giving and what they are giving. Questionnaire, two interest rates will be given to you. One is the general interest rate, which is 14%. A 14% is used to identify the initial values splitting and all. Later on, when you adjust the transaction cost, IAR what you use is no more relevant. That has to be updated. A 14.85 also question they will give you. You should take that only for accounting of ACM hereafter. A 14.85 first one if you use of, then it will be wrong. They are one side trying to do a favor to you by giving one extra information. You should not spoil that. Yep. So be careful. That's all, sir. This is about your compound financial instrument transaction cost. Coming to last aspect. Listen here. This is buyback of CFI. Before maturity, obviously, if I redeem it on the maturity date, why will I call it as buyback? Before the maturity date, only early redemption is called as buyback of compound financial instrument. Now, why this is extremely important, sir? This is highly due. Why it is highly due is CFI, whatever questions are there, till now, every question 2 to 2 times repeated in the exam, till now. The only model which is not tested is this one. This is the only CFI model which is pending. I did not create this. This is there. I say study mat one small question is there. RT below 2 questions are there. MT below 2 questions are there. All questions same model. Numbers different. Examiner did not come. Highly due. Fantastic question. The question concept is very simple, sir. But little background. Tell me, if you do buyback of equity shares, what is the entry we are writing? Equity share capital will cancel to bank. Okay. This is 100. I paid 130. So I paid how much extra? 30. Where will it go? PRL other equity. PRL other equity. Sir, it is a transaction with own equity instrument holder. Any gain or loss is suffered in this cannot go into PRL. It has to be adjusted only into other equity. Let us say I will adjust it into retained earnings. Other equity it has to go. So when you cancel equity, gain or loss will not come into PRL. Remember this. Next. In my balance sheet, I have a loan 100. The loan is actually repayable after 10 years. I went to the bank today only. Bank, I want to close the loan. Tell me how much you want. Bank say pay 103. I said okay. Loan 100. To bank 103. How much extra am I paying? 3. Where will it go? PRL. Tell me, sir, financial liabilities insider or outsider? Outsider. Any deal with outsider, gain or loss, cannot come to retained earnings. It has to go into PRL. Own equity, insider. Any transaction with own equity participant cannot go to PRL. It will be adjusted only into other equity. A clarity you should have. Now, individually, when you see buyback of equity, cancellation of a loan, it's pretty simple. Now, we are talking about buyback of a CFI. You will pay some money to the investor, take his convertible bond, tear into pieces and throw it away. Now when you pay this money, to whom are you paying? That fellow is split personality. Some portion of that fellow is outsider. Some portion of that fellow is insider. So whatever amount you are paying to that fellow, that you have to split. How much I am paying to him in the capacity of equity, how much I am paying to him in the capacity of liability. Are you understanding, sir? A split if you do not do, you will not be able to understand how much gain or loss will go into PRL, how much gain or loss will go into retained earnings. Easy only, but a concept base building important. Hello, sir. On this also, one small question is there. I'll just take you through that question directly. Because of all these RTP, MTP questions, no sir, the book became very highly loaded. Almost 170 questions are there in this. So that is kind of scary, but actually most of the questions are repeated. What can you do when exam RTP, MTP that they are giving? No, it's better we keep it. Because later on we can claim that it came from our book. Okay, 163. So this chapter never cheated us till now. Everything, even questions which are not there in study mat also are there in this book, because I once upon a time old CFNL asked. Those questions also safe side I kept. Last 2 exams, so small questions only, but they came 5 rupees only. But still, book is fat, but I can't help that. Okay, read this. On 1/1/2000, entity issued a 7% convertible debenture with a face value of 1000. Maturity is on 31st December 2008. Tell me, sir, what is the maturity period? What is maturity period? 8 years. Congrats, wrong answer. 9 years. Yes. Stupid people, you are not supposed to come. Once you decide that it is 8 years, no. There is no point of reading remaining question. You already spoiled it. You understand? First working note gone. The rest of it he will not even see. Experience. The debentures are convertible into ordinary shares of the entity at a conversion price of 50 per share or redeemable at par at the option of the holder. One more point. Suppose the question tells you that bond is redeemable or convertible at the end of the maturity period, but the question is silent whether it is at the option of the holder or option of the entity. You will have to assume that it is option of the holder. You have to assume like that only. Sir, why sir? It can't be otherwise, sir. It can be anyway, sir. The question is not clear. I am just asking you to play safe. When the question is silent like that, I say assume like that in the past. So just to match your answer with I say answer, I am telling you to assume like that. Sir, no sir, I don't like to follow trend. I will create new trend. Create. But till that results come, no, 2 months will be in one tension zone. Why do you want to invite that? Okay. Interest is payable yearly in cash. At the date of issue, the entity could have issued a non-convertible debt at an interest rate of 10%, market interest rate. On 1/1/2005, the convertible debenture has a fair value of 1450. Okay. With today's market value, after 5 years, today market value is 1450. The entity made an offer to the holder of debenture to repurchase a debenture for 1450, for which the holder accepts. At the date of buyback, the company could have issued a non-convertible debenture with 4 years life at a coupon rate of 6%. Today's market interest rate is 6%. Show the accounting for initial recognition and on the date of early redemption. Let's quickly come through this. First day, initial recognition, what I will do? I will have to do a split accounting. How much is liability portion? How much is equity portion? What is the maturity of the bond? 9 years. 9 years I have an obligation to pay coupon. 9th year ending, if that fellow asks cash, I have an obligation to pay even cash also. So including principal amount, discount all the cash flows till today, you will get the liability value. Here I included coupons 70 rupees and principal value 1000 rupees at the end of 9th year. That way I got an amount of 827. This is liability. I received an amount of 1000, which means for the extra 173 what I received, I do not have a obligation to repay. Therefore that becomes a equity item. So my first day entry is bank account debit 1000 to equity 173 to liability 827. Liability I will apply ACM, equity I will not do anything. Am I clear till here, sir? In the first day accounting. When is buyback happening? After 5 years buyback is happening. So if I want to know gain or loss, forget about buyback price splitting. First of all, I should know my carrying amount in my books of accounts. No? After 5 years, what carrying amount you will have? Since this is CFI equity, since you will not do anything, after 5 years also, this will still appear at the same amount, 173. As far as liability is concerned, on that you will have applied what? ACM. So after 5 years, whatever is carrying amount as per ACM, that you have to record there basically. Now how will I get that number? There are different ways. One way, prepare ACM table for 5 years and get it. That is lengthy way. Smart way. Total maturity of the loan, debenture is how much? 9 years. In that how many years is already completed? 5 years. Since you are following ACM, ACM ka balance should always represent what? Present value of remaining future cash outflows discounted at original EIR. So 5 years, sorry, 9 years of 5 years is over. Remaining life is how much? 4 years. A 4-year remaining cash flows, if you discount at original EIR, you will get one present value. That only will be your carrying amount in books also. I applied that technique and I got an amount of 905. So this is your carrying amount as on today. Am I clear? Now last step is you are paying 1450 to him to buy back the bond. A 1450 la, how much is towards equity? How much is towards liability? A split how to do. Is split how to do is a very very easy case, at the same time extremely means equally complicated also if you think too much. Tell me sir, bond life total 9 years. Till now how many years are over? 5. Remaining? 4. That means as on today bond life is only. If I issue a new bond today, do you know how to split equity liability? If you issue a new bond today, do you know how to split equity liability? It will be similar to this one, you know. Only thing is, instead of 9 years, you have to consider only 4 years. Same thing you will do. You hypothetically assume that you are issuing a new bond. If you issue a new bond, how will you split? What liability I have? I have an obligation to pay 70 rupees for the next 4 years, 1000 rupees at the end of 4th year. But today's market interest rate is 6%. So discount all that, you will get fair value of your liability, which is how much? 1035. 1450 is the overall value of the bond, but obligation to pay cash is there only to the extent of 1035. A extra amount 415 is what? Equity value. Means 1450 la 1035 is towards liability, 415 is towards equity. Compare it with your existing carrying amounts worked out in the previous step. Here also excess you paid, here also excess you paid. Liability portion ke whatever excess you paid, that is a loss that will be debited to PRL. Equity component ke whatever extra you paid, that is also a loss, but that will not go to PRL, that will be adjusted directly into retained earnings or any other equity component. Sir, are you clear, sir? Yes. That's all. This is maximum. Top end. Beyond this, nothing else is there. This is maximum. This never came, sir, is important. Study matter questions are there, RTPM typical questions are there. But every, I go, there is another question, same text, same model. So guys, that is about your CFI. Next we have to do derivative, better derivative, and it will be little bit of hedge accounting, and we are done with this. They are easy concepts only. Okay guys, so now that we are done with CFI, we will next take up derivative accounting, which is given under Financial Instrument Standard. See, the meaning of derivative and all we have already discussed. Now, we also have spoken about this. Derivative can be classified as financial asset, financial liability. It can be classified as own equity item, or it may be even scoped out of the standard. Scoped out means that accounting is not covered under the standard. That's pretty simple to understand. If a derivative is identified as an own equity instrument, then the premium what you pay or receive, the gain or loss in the derivative contract, everything should be accounted only under other equity, and there is no subsequent fair valuation because it is a own equity item. And that leaves us with these two cases. Derivative classified as a financial asset or a financial liability. When a derivative contract is classified either as a FA or FL, the standard says life is very simple. You will simply apply FATPL accounting. So generally most of the students remember that for derivative you have to do FATPL. It's not like that. Derivative, if it is classified as equity, then you will not do FATPL. It has to be directly accounted into other equity only, and there is no subsequent fair valuation. Imagine there is X Limited who writes a call option on its own equity shares, 100 shares. Exercise price 20 rupees. Call option is pakka derivative, there is no doubt in that. X Limited is a writer. We have an obligation to sell. Who is underlying asset? Our own equity shares. How many shares? Fixed number of shares. Consideration also fixed. Even though this is a derivative, it also satisfies the definition of own equity instrument. Now, since I wrote this call option to somebody, that somebody will pay me some premium, a premium you cannot take it to P&L account. Bank account debit, directly retained earnings you have to adjust, because that is a equity item. On the maturity date, a call option either gain or loss will be there. You are not supposed to account that. Why? In the own equity item, subsequently there is no fair valuation. Are you getting what I am trying to say, sir? So, derivative FATPL is wrong answer. Derivative, when it is classified as financial asset or financial liability, then derivatives must be accounted at FATPL. Now tell me FATPL rules. FATPL rules. Initial recognition should be done at fair value. Transaction cost should be thrown off into PRL. On every balance sheet date, again fair value. Whenever you fair value, there will be a gain or loss. That will go into PRL. That's all. That's all you have to do. Now, there are examples and all of this. I will show you one small question. In fact, two questions will go through. By the end of first question, you will have lot of clarity. And this question, old CA final it came. Old CA final means CA final examination before Ind AS. At that time, the question came in the exam. Numbers, I slightly tweaked the numbers, but model is same. It's a fantastic question, sir. Thereafter, this kind of question never came. Only a small easy variants of this only they are asking in exams right now. But if you understand, this is a master question, easy only. So, read, sir. There is a forward contract, sir. A forward contract accounting we are talking. Today's spot rate is $1 is equal to 62 rupees on 1st of Jan. X Limited entered into a forward contract today to buy $10,000 at the rate of 60 rupees on 30th June 2018. So standing on 1st January, our fellow entered into a forward contract which is going to be executed after 6 months from today. Fixed rate, 60 rupees per dollar. In between balance sheet date also is the 31st March. The spot rate on the 31st March is 60 rupees and on 31st March, 3-month forward rate is also given as 63.5. On 30th June, which is the ultimate settlement date, maturity date, marketless spot rate is 65. Show the accounting of forward contract in the books of Excellent. First of all, who is the underlying asset here? Dollar. It is not my own equity, no? It is not own equity. So it is either a financial asset or it will be a financial liability. Therefore, which method I have to apply? FVTPL I have to apply. FVTPL initial recognition rule is what? You have to recognize the instrument or contract at what value? Fair value. Tell me, sir, if I enter into a contract to buy $10,000 at the rate of $1 is equal to 60, which will be executed after 6 months from today, tell me, what is the fair value of this contract as on today? What is the fair value of this contract as on today? I agreed to buy dollar at the rate of 60. Like that $10,000. After 6 months I will execute. What is fair value today? Because initial recognition should be done at. So you should tell me the fair value. If you don't tell me the fair value, I can't write an entry now. Okay. Leave this. We'll take another example. Forget about derivative. Market loss, sir. One company ka share listed. It is trading at 150 rupees. I went, I purchased that share at 150. I paid to bank 150. Investment in equity share. I should debit at what value? I paid 150. Debit also should be at 150. Debit will be at 150 because, not because you paid 150, because the fair value of equity share is 150. If you sell that share today at the spot, you will still recover that 150. Wherever you come across the word fair value, Ind AS 113 says that fair value is a exit price. Exit price means what? You have an asset. Asset if you sell off, how much will you get? That is the fair value. You have a liability. A liability, if you transfer it to somebody, that somebody who is accepting your liability, why will he accept? You have to pay him money, no? How much money you have to pay to somebody to accept your liability? That money is called as a fair value of the liability. Fair value is defined as an exit price. Am I clear till here? Now think again. As on today, I entered into a forward contract with 6 months validity, 6 months maturity. As on today, if I ask you what is the fair value of forward contract, how you should think is, if I exit out of this forward contract now, how much will I receive or how much I will have to pay? That is the fair value of forward contract. Tell me, sir, how to cancel a forward contract before maturity date? Simple, you have to take a reverse position in the opposite contract. At what rate? Remaining period. What is the total maturity period? 6 months. Where are you standing? 0 time. Now only you entered. Immediately if I ask you to cancel, the opposite contract also should be taken at 6 months forward rate only, which is how much? 60. In the first original contract you agreed to buy it, 60. In the opposite contract you will agree to sell it, 60. Gain or loss is 0. So fair value is, bank quoted $1 is equal to rupees 60. 6 months forward rate. I agreed to buy, bank agreed to sell. Okay, so customer point of view, we are having a long position. If I say hypothetically get out of this contract, how to get out today only? Simply you will have to agree to sell. Another contract you have to enter. That contract also will be entered at what rate? 0 rupees only. So agreed to buy at 60, agreed to sell at 60. Effectively gain or loss is 0. Therefore fair value of this forward contract on the inception date is 0. Therefore no entry will require. This is original logic. Suppose the question quoted rate like this. You agreed to buy at 60. But if you want to close this contract right now, the transaction will not happen at 60. It will happen at T8. Bid rate, ask rate are separate, correct? In that case, a contract, if I exit immediately, I'll suffer a loss of 2 rupees. I have to pay to the bank. Derivative liability you have to record on first day itself. You understand, sir? In this case, question the two-way quotes are not given, single quote. So you see the answer here. Here on 1/1/2018, spot rate is $1 equal to 62. Ex-limited agreed to buy $10,000 at the rate of $1 is equal to 60 after 6 months. This is a long position. Initial recognition should be done at fair value, and fair value of this forward contract as on today is 0. Now how do I know it is 0? You should not say, sir, I did not pay anything, therefore it is 0. No, sir, not like that. Not like that. If you cancel this contract right now, you will neither receive anything nor you will pay anything. That's why it is 0. No entry. Clear? Now, this is on 1/1/2018, the starting date. Come to balance sheet date. Balance sheet date, the question gave you two information. One is spot rate. One is remaining period 3 months ka forward rate. Tell me, sir, FATP, what is the balance sheet date measurement? Fair value again. Fair value of the forward contract. Sir, what is the meaning of fair valuation? Again, same. If I exit out of this contract, how much I will get or how much I have to pay? Tell me, sir, original contract, like you agreed to buy at what rate? 60. What is 3 months forward rate today? If I want to exit this contract, what I should do? I should enter into an opposite contract. Since my original contract is agreed to buy at 60, my opposite contract will be agreed to sell at 63.5, which is forward contract for the remaining period. So buying at 60, selling at 63.5, if I run away out of this contract right now, I will get a gain of 35,000. A contract which is potentially favorable to the company. Financial asset definition. Entry, derivative financial asset account debit to PR. Are you getting it, sir? Tell me, is it realized gain or unrealized gain? Unrealized gain. Did you really exit a hypothetically notionally? Notionally. If I exit, what will happen? If I exit, what will happen? Like that, you have to imagine a hypothetical exit and go on doing the fair valuation. Here, you did not really exit. Now come to balance sheet, sorry, ultimate settlement date. On the ultimate settlement date, spot rate is how much? 65. But under the forward contract, we agreed to buy only at 60. 65 rupees ka dollar, I am able to buy only at 60. So how much gain I am making? Per dollar into $10,000. What is the gain? 50,000 gain. Tell me, sir, should I record entire 50,000 gain now? No. Why? We already recorded earlier 35,000 gain. It is sufficient if I recognize remaining 15,000 gain. What entry? Same entry. Derivative financial asset account debit to PRR 15,000. Am I clear till now? Now wait. Towards the end now, in the balance sheet, derivative financial asset is appearing at what amount? 50,000 rupees. Now how will you receive that money? How will you enjoy that benefit? It depends on how you are settling the contract. If the contract is closed by way of net cash settlement, the physical delivery of dollar and dollar is not there, gain or loss we will deal directly. If I am gaining by 50,000, the counterparty bank will be losing by how much? 50,000. The bank will pay me 50,000. If bank pays me 50,000, the entry I will write is bank account debit to derivative financial asset. A financial asset account will get closed. No, sir, we are not doing this net cash settlement. We are taking physical delivery. Fine. What did you agree to buy? $10,000 at the rate of 60 rupees. Buy foreign currency cash. How many dollars? 10,000. Wait a moment. Foreign currency cash, is it a financial asset? Financial asset definition, what is the first item? Cash. Cash. As home currency or foreign currency, it doesn't matter. Cash is a financial asset. So any financial asset should be recognized at what value? Fair value only. But today fair value of each dollar is how much? 65. 6,50,000 you record. But you will pay only 60 rupees. You bank 6 lakhs. Whatever you are not paying, that you are not paying because you are having a gain under derivative contract. That's how you close your derivative financial. Are you understand what I am trying to tell you? Initial recognition at fair value, balance sheet date subsequent measurement at fair value, ultimate maturity date, find out the overall gain or loss. In that some gain or loss you would have already recorded, barring that remaining gain or loss you record now, and ultimately you will either have a derivative asset or a derivative financial liability. If it is cash settlement, simply receive cash or pay cash. If it is gross settlement, physical delivery, then whatever asset is coming to you, you take that and pay whatever you promised to pay. A difference to a derivative financial asset account will be closed. Am I clear? The full length big questions are actually, but it's a very good conceptual question. Now, on every balance sheet date, you are doing hypothetical notional cancellation. No, that is referred as marking to market. Marking to market means if I go to the market and exit. If I go to the market and exit, what will happen? What will happen? That is called as mark to market. Clear? Am I clear till here? Now, this is I told you so old question. I'll show you what question came in exam and which is there in study mat also. Look at this. On 1st Jan 20x1, Sam agreed to buy $20,000 from JT Bank in future on 31st December, that's after 1 year, at a rate equal to 68 rupees per dollar. This is also agreed to buy only $20,000 at the rate of 68. Study mat question, sir, don't worry, just watch. Sam did not pay any amount on entering into the contract. Sam is a listed company, all this fine. Following the principles of recognition as given in 109, you are required to record the entries for each quarter ended. After that, look at the language. Till the date of actual purchase of US dollar, which means what? If forward contract is closed by way of physical delivery of dollar, net cash settlement we are not doing. Am I clear here, sir? The closing part you should know how to handle. Then, for the purpose of accounting, please use the following information which is representing marked to market fair value of forward contract on every reporting date. So in this 1 year, this fellow is every quarter preparing balance sheet. So on every 3 months time, he is giving you fair value of the forward contract. If you see, sir, previous sum, fair value we computed. 35,000 we computed. 50,000 we worked out the gain. But in this sum which is there in your study mat, you need not do. They already gave. If you run away out of this contract, how much loss you will suffer today or how much gain you will get. Question only computed. All you have to do is simply write entry, that's all. Tell me, sir. What is the contract initial date? 1st Jan. On that day only, what is the fair value of forward contract? 0. Since it is 0, you will not write any entry. Adjust it. 31st March, first quarter ending. He says that if you run away out of this forward contract at 3 months time, you will suffer a loss of 25,000. You only have to pay an amount of 25,000. Tell me, sir, will gain a loss? Loss. Tell me the entry. PRN2, derivative financial liability. 31st March. Come to 30th June. 30th June, if you run away, you have to pay only an amount of 15,000. But in my books, already liability is appearing at 25,000. What is the entry? Derivative liability account debit to PRL with an amount of 10,000. You have to reduce the liability by 10,000 rupees. Correct? Right. On 30th September, if you run away, you will get a gain of 12,000. But in my books, what is appearing? Liability of 15,000 is appearing. What should I do? First, cancel the liability of 15,000. Create a derivative financial asset account debit to PRL with an amount of 12,000. So by 30th September, you are having a derivative financial asset of how much? 12,000. Finally, on the last day, he says that marketless spot rate is 66 rupees. At what rate did he agree to buy? 68. When market rate is 66, I am going to buy this at 68. I am paying more or less? More. Gain or loss? Loss. How much loss? 2 rupees per dollar into 20,000. Overall loss. Ultimately, contract I am suffering a loss. When there is a loss of 40,000, but in my books, what is there? A derivative financial asset of 12,000 is there. So first and foremost thing, what you will do is first cancel that derivative financial asset of 12,000. Once you cancel this, in your books, nothing is there. Now, actually, your loss is how much? 40,000. Book that loss. PRL2 derivative financial liability. How much amount? 40,000 loss. Okay, sir, if 40,000, how will I close now? How will you close? By cash. Foreign currency cash. Count debit. How many dollars you are agreeing to buy? $20,000. What is the market value of each dollar today? 66. So that is 13 lakh 20,000. to bank. How much did I promise to pay? $20,000 into 68. So that will be 13,60,000. So I am basically paying how much extra? 40,000. 40,000 is nothing but this is how you close your derivative financial. Before exam 8 months. In this, the easiest part is nobody is asking you to fair value the derivative. Everything they only give. Simply have to write entry. Compared to the previous sum, you see how much low level they have come. Again, a similar question is there, same model, where this time Sam did not enter into a forward, Sam entered into a written put option. Sam wrote a put option. Put option will give a right to sell. Here, right to sell, other party is having. So Sam is having what? Obligation to buy. Instead of entering into a forward contract to buy, they wrote a put option, means it is an obligation to buy. Here also same story. That fellow gave off the fair values. You simply have to look at the right entries. Fair valuation you will not do. You will have right entries. Fair valuation you will do. Some other subject you will do. Not here. So this is how derivative accounting is. There's nothing much. Okay. Now coming on. Next concept. This is embedded derivatives. Before last exam question came, they played with some very cunning adjustment in that. But anyway, let's see. Embedded derivative meaning, as the name itself suggests, derivative is embedded into one existing contract. There is a contract. To that contract, derivative element is added. Overall, we call it as an embedded derivative contract. The plain contract to whom derivative is added, a plain contract is called as host contract. A host contract, when a derivative element is added, overall contract is referred as a embedded derivative contract. Sir, what is host contract? The host is the original contract without the derivative element. Sir, a host contract example. A host contract can be a financial asset. It can be a financial liability. It can be a contract to buy or sell non-financial assets on a future date. Now, if you observe, contract to buy or sell non-financial assets on a future date is prima facie scoped out of Ind AS 109. Why is it scoped out? We already discussed contract centered on non-financial assets. If they are going to be closed by way of physical delivery to meet your own usage, sale, purchase requirements, they are out of Ind AS 109. In that kind of contracts also, derivative element can be embedded. Okay, this is about host contract. Derivative ka meaning we already know, that is this derivative. Both put together we are calling it as embedded derivative. Now the point here is, plain financial asset is there, sir. A plain financial asset, you will apply either ACM, FTPL or FTOCA. If it is a financial liability, you will apply ACM or you will apply FTPL. If it is a contract to buy or sell copper on a future date, which is going to be closed by a physical delivery, this is not accounted under the standard scope. So host contract ki alone the accounting I know. Standard already told you that. You need not learn anything new. Come to this one. Plain derivative contract accounting I know. You have to apply FTPL unless it is an equity instrument. That means only derivative I know the accounting. Only host contract I know the accounting. But when they both are mixed, what you should do? What you should do? A derivative element you have to separate it. After separating it, on the derivative element you have to apply FTPL. A remainder host contract will be accounted as per the usual principles of Ind AS 109. That's all. So the entire story is all about you splitting the derivative element from the host contract. If you separate them, after separating, how to account, that is easy only. How to separate only is difficult here. Clear, sir? Now, invariably, your examination question will be a case where definitely you have to separate. If you are not separating it, there is no special accounting you will do. The embedded derivative ka game will be there only when you are able to separate it. In our standard, there are few cases where The standard says the derivative element is very closely related to the host contract. Closely related. When it is that closely related, you are not going to split it. You are not going to account derivative separately. When, sir? When it is closely related. But I am telling you, our case will not come in the exam, because if it is closely related, how will you do accounting of embedded derivative? You will not do. What will they ask in the exam? So it will not come. Since it will not come, our people very smartly what they did is, 2-3 questions where separation is there, that alone our people prepare and go to the exam. Last year RTPL one question came. The fellow gave a nice story. 2 questions. First question is, should I separate it or not? If yes, give reasons. Second, if you have to separate, show accounting interest. Accounting interest part we can write, because you know how to separate. But should I separate or not? Whether they are closely related or not? If they are not closely related, then only you should split. A story you should know. Otherwise, a question you can't touch. People are smart, but they also know what you people are doing. So they modified the question, put it in study material officially. Very important. Anyway, let us see. There are few cases where separation of derivative from the host contract is not required. Don't split the derivative, let it go. First one. If the host, first one, second one actually kind of same only, but anyway. If the host contract, which is a financial asset or financial liability, that is accounted at FVTPL. If the host contract itself is accounted at FVTPL, why do you want to split it? When host is directly accounted at FVTPL, derivative element included in that host also will be naturally accounted at FVTPL. Why do you want to split it? Because after splitting also, you will have to apply which method? FVTPL only for the derivative. If you don't split also, anyway they are accounting at FVTPL, don't split. The classic example for this is investment in convertible bond. Till now we are talking about CFI. Convertible bond should be identified as equity component, liability component. Who? Issuer. Holder. For investment in an optionally convertible bond, how will you account? Which method is applicable? Tell me. You are an investor. You bought a convertible bond, optionally convertible bond issued by Reliance Industries. Which method will you apply? Your objective is holding till maturity. You cannot. Holding till maturity, point A is okay. D failed, no. What is D? You should have rights to receive solely principal payment and interest. The moment you have a chance of getting equity shares, D point is failed. The moment D point is failed, you will apply only FVTPL. Correct? So investment in convertible bond by default is accounted at FVTPL. Now you observe. Normally bond ka price should fluctuate only because of changes in interest rate or change in the risk of the borrower. Only 2 reasons. But convertible bond ka price will change because of change in market price of share also. I issued convertible bonds are market interest rate constant, my risk constant. Ideally bond price should not change. But my share is crazily growing. Do you think bond will keep quiet? Bond price also will grow. So here that is the derivative element. Or I will split it, sir. No. Why? I investment in bond. Anyway this fellow is accounting at which model? FVTPL only. Why to separate it unnecessarily? Let it go. Automatically it will be fair valued. Again or loss will come to PRL only. Are you understanding, sir? E cases, you should not split. There is no need for you to split. Then another case is the inclusion of the derivative element is very natural and acceptable. The host contract and the derivative element are closely related. That means you cannot, it is not appropriate to split them. It is correct to include them, let it go. Simple example for this previous page I have given. Come to example number 3. Third example you will show. A Limited is an Indian company. They agreed to sell goods to B Limited, a US company, not now, in future, at some $1 lakh. So this is a contract to sell non-financial asset on a future date. This prima facie scoped out case. But if you observe closely, In this one, derivative element is there. What is a derivative element? Pricing is in which currency? Dollar. Dollar rate can increase or decrease depending on that A limited is exposed to some gain or loss. Yes or no? Yes, there is a derivative element in that. You should not say that you are doing speculation, I will go and separate it and I will account it separately. You should not say that. Why? Because, tell me sir, is there any other way? I am A limited Indian company sir. I am dealing with whom? US company. If I am dealing with US company, either me or the counterparty, one party will be definitely exposed to risk, foreign exchange risk. That fellow will definitely experience a gain or loss, either me or him. Tell me sir, is it wantedly kept? It is natural, acceptable, closely related. Don't split. Come to example 4. A limited Indian company agreed to sell goods to B limited, also Indian company, after 6 months for $1 lakh. I am A limited, you are B limited. Where are you staying? Adjacent building only. I agreed to sell machinery to you, not now, after 6 months, for how much amount? $1 lakh. So when I sell machinery to you, you should pay me an amount of $1 lakh. Now ask yourself, sir, can that fellow pay me $1 lakh after 6 months? Can I hold foreign currency like that? He is US national, he will give me $1 lakh. Then what will happen? $1 lakh into on that day whatever spot rate is there, he will multiply. I amount rupees, he will pay me. Tell me sir, is there any need for me to enter into a dollar transaction with my adjacent fellow? Then why did I do? Apart from selling goods to him, night sitting low, what we decided is, I told dollar rate will fall. He says no, dollar rate will rise. Bet. Tomorrow we will write legally. Anyway, we are doing sale of goods contract, in that only we merged this also. That means sale of goods is happening, one transaction. Another transaction, speculative motive is also there, that is also merged into the same transaction. Tell me sir, is it natural, closely related? You have to separate it. After separating a derivative, separate accounting you have to do. Are you getting it? It's unnatural, not accepted, not closely related. Another example, right? I am Indian company, you are a Dubai company. From you, I agreed to buy oil, crude oil. Since I am Indian company, my functional currency is rupee, you are a UAE company, your functional currency is UAE dirhams. Invoice amount should be either in rupees or in dirhams, but invoice amount is in dollar, US dollar. Immediately you came up, you people are playing, you people are betting on dollar. No. But then why did you enter into dollar contract? Reason, crude oil prices in the market are traded only in US dollars. Since the commodity is traded only in US dollars, we also entered contract only in US dollars price. It is closely related. Don't split it. Another case. I am Indian company, you are China company. We both entered into a deal. Indian company says, we want invoice in rupee, we don't want to take risk. Chinese company says, no, we also don't want to take risk, we will have invoice in Chinese yuan. These people are fighting. Deadlock came. Two people are fighting, third fellow will come. He says, oh, don't fight. Not rupee, not yuan. Take one third party currency which is stable. Let us bring US dollar. Invoice in US dollar. Tell me, just because I put US dollar invoice in, that does not mean that I am speculating in dollar always. I put US dollar because that is more stable currency. My goal is not speculation. In that case also they are closely related. Don't split people who are closely. If they are unnatural, we should go and split it. The whole point here. There are other two exceptions which you won't see. What is that is, gain or loss from the derivative element is not substantial. That means with lot of difficulty you split. After splitting, what will you do? On the derivative element, you will apply FATPL. Gain is 5 rupees. Gain is 22 rupees. Loss is 15 rupees. What is the fun of doing this? Ultimately, chiller is coming as gain or loss. Ignore it. Finally, fair value of derivative element cannot be determined. Impracticable case. Even if you split it also, I don't know how to fair value it. Then why to split it? Leave it. So in this, what is relevant from an examination perspective is only C point. When it is closely related, don't split it. If not closely related, split it. Examination point of view, only C point the question is related to you. Okay, now how to do that split and all, we'll take up one question and we'll handle that. Tell me, sir, easy question or difficult question? Simply asked anyway, don't worry. Okay. Read these numbers, study mat question, exam also came. Go through this. Entity A, brackets, an INR functional currency entity. INR functional currency entity means Indian company. Entered into a US dollar 10 lakhs sale contract on 1st Jan 20X1 with entity B, also INR functional currency entity, to sell equipment on 30th June 20X1. Prima facie observe, two Indian companies entered into a purchase sale contract executable after 6 months, but contract price is in dollars. There is no need for two Indian companies to have a invoice in foreign currency. Pakka, not closely related, you have to segregate it. Then he is giving you extra information. What is today's spot rate? He gave rupee dollar, spot rate on 31st March given, 3 months forward rate on 31st March given, 6 months forward rate as on today given, ultimate maturity date ka spot rate is also given. So many forward rates are given, spot rates are given. Let us assume that this contract has an embedded derivative that is not closely related and requires separation. Please provide detailed journal entries in the books of A for accounting such embedded derivative until the sale is actually made. He is asking split this and start doing accounting for this. Okay, so now your thought process, how it should be is, you think only from A's point of view. Tell me, sir, what will A do after 6 months? A will sell some equipment and the counterparty agreed to give him how much? $10 lakhs. That means our company, entity A, agreed to receive dollars, give dollars, knowingly only. Even though I could have entered into a rupee contract with my opposite company, I entered wantedly a contract where I am going to receive dollars on a future date. Tell me, ma, why are you interested in receiving dollars? So, based on what feeling you agreed to receive dollars? What is your anticipation? Dollar price will rise any feeling, fall any feeling. What is dollar rate given today? 45. Imagine, I am eliminated. I believe that after 6 months, dollar rate will become 42. If that is my feeling, tell me, ma, will I agree to receive dollars? Will I agree to receive dollars? No. If I wantedly, willingly agreed to receive dollars after 6 months, the meaning is what? I prima facie believe that dollar rate will appreciate in future. Do you understand how you have to think? If you are willing to receive dollar in future, prima facie you are having a bullish view about dollar. You believe that dollar is going to rise. Now tell me, forget about this entire sum. You are a normal speculator. You believe that dollar is going to rise. Forward contract, which position will you take? Forward contract, which position will you take? Buy or sell? When the price of something is going to increase and you know, today you will take long position or short position? Long or short? Long position. When price is going to increase, you will agree to buy. When prices are going to fall, you will have to take a short position. Rising market la long positions, falling market la short positions. That's what a speculator will do. Same thing, you will make entity A enter into a forward contract long position now. Okay, now your entire thought process is important in this. Let me show you this example. Follow this, sir. Entity A, Indian company, agreed to sell equipment to entity B at 6 months for $10 lakh. Entity A expects dollar to increase in 6 months. Sir, understand this. In every question on embedded derivative, the most crucial aspect is this only. What is this fellow's feeling on the underlying asset? If you do not know that, if you cannot identify that, the answer. If somebody is willing to receive dollar means, what is his feeling? His feeling is dollar will appreciate. This is the contract. This is the original contract what you entered. Now we will split it. How will I split it? Entity A enters into a long position in a 6 months forward contract to buy dollar at the rate of 55. What is 55? Question gave no 6 months forward rate for dollar is given as 55 rupees. You make him enter a forward contract. Sir, did he really enter into forward contract? No, dummy forward contract. Now that from the top contract you remove the derivative element separately, remainder contract you write. Remainder contract as it is, the entire contract as it is you write. Only thing is, since you separated the dollar element already on the left side, this you convert it into rupees now. At what rate did you enter into forward contract? 55. 55 into 10 lakh dollars, 550 lakhs. That means there are two contracts now. One is a derivative contract, one is normal contract. Derivative contract, our company has taken a long position in forward contract, and in the other contract we agreed to sell goods to B Limited at 6 months for rupees 550 lakhs. Let me tell you very clearly, sir, a forward contract is a hypothetical contract. This is not existing. A Limited never entered into bank. A Limited never entered into any forward contract in reality. It is a hypothetical contract. For hypothetical contract, why are you doing accounting? Simple. Compound financial instrument law. How did you split equity and liability? How did you split? You took the future cash outflows, discounted with what rate? Market interest rate for a non-convertible debenture. Correct? Tell me, sir. In your contract, that rate is there. Did you go to the market? Did you bring a new rate separately? Use that rate for splitting? That rate can you work out EIR also every year? Like how you use an interest rate there from the market to split equity and liability component. Here I am using forward contract data in the market to split the derivative element and the host contract. Like how that 14% is a dummy number there, here a forward contract also is a dummy forward contract. It is reality not there, but accounting purpose it is there. Here now. The derivative element will be accounted using FETPL. The host contract is there, the other one after separation, it is scoped out of Ind AS 109. Why is it scoped out? It is based on non-financial asset which will be physically delivered. Therefore, it is scoped out. There is no accounting for that till actual delivery of that goods. So, tell me, sir, derivative FETPL accounting first day, what will you do? Initial recognition will be done at what value? Fair value. Tell me, what is the fair value of forward contract on first day? 0, 0, 0. So there will be no entry. 1st January, no entry. Come to 31st March, balance sheet date. On balance sheet date, you have to do fair valuation. What is the meaning of fair valuation of a derivative? If notional cancellation. Notional cancellation. What is my original position? Long. How to cancel this? Take a short position. If original is agreed to buy, now you have to agree to sell. At what rate? Forward rate for the remaining maturity period. The question definitely will give you that. This one. 3 months forward rate on 31st March will be given in the question. Originally, I agreed to buy at 55. Now I have to agree to sell at 45. Buying at 55, selling at 45. Gain or loss? Loss at 10 rupees per dollar into 10 lakh dollars. Total loss 100 lakhs. Go and write the entry. PRL account debit to derivative financial liability. Clear, ma'am? Come to climax closing date. On the ultimate date, spot rate is given as 60. When marketless spot is 60, I agreed to buy dollar at what rate? 55. Market rate is 60, but I agreed to buy dollar at 55. Gain or loss? Gain. How much gain? 5 rupees into 10 lakh dollars, 50 lakhs gain. But in my books, what is there? 100 lakhs derivative liability is there. So first you are going to reverse the liability and freshly recognize a derivative financial asset. Clear till now? Now, a derivative financial asset, how will you close? If it was a real forward contract, then you would have asked, is the net cash settlement physical delivery of dollar on? Is the real forward contract? Is the dummy forward contract? Nobody will come and give you cash. Nobody will come and give you FC cash also. So then how to close? Simple. Now, execute this part. You agree to sell goods? Sell. Debtor account debit to sales. Now, you agree to sell at what amount according to this number? 550 lakhs. But the other party owes you how much money actually? 10 lakh dollars he owes me. What's the worth of each dollar today? 60. 10 lakh dollars into 60, 600 lakhs. So debtor account debit 600 lakhs, sale recorded at 550 lakhs, he gap extra 50 lakhs, whatever that fellow owes, you know, that is how you realize your derivative financial asset. You have created a derivative financial asset account here now, that you will close it. This is how you do embedded derivative accounting. Clear now? So in this, what is the most crucial point in splitting? The first point. What is that first point? What is your anticipation regarding the foreign currency? Do you believe foreign currency to appreciate or depreciate? If you believe it will appreciate, forward contract you will be taking a long position. If you believe you are going to depreciate, then you will take a short position. And you should have very full clarity that if forward contract is not existing in reality, look at dummy forward contract. A dummy forward contract, here also I did dummy cancellation also. This one. Forward contract not there. A forward contract I imagined, I started accounting in the dream only, that is again cancelled also, notionally. Okay, so little deep, but it is easy, it's not difficult. The question that came in recent examination, same question only, but very cunningly they planned. What they did is, you see, entity A. Entity A point of view, he started the question. Entity A gathered the following data, and a table also they gave. Entity A feels that this is an embedded. I will like the total question is from entity A. Last requirement is show accounting in the books of entity B. The moment people read half of the question, they understood. Okay, this is the same question. Entity A point of view, the question is there. Started splitting and all. Full entries correctly they wrote. 0. Gone, no sir, you have to think for the counterparty. A is believing that dollar is going to rise. If B is willingly going to give dollar, B is believing what? Dollar will fall. A forwarder, B will take a short position. Like that you have to do accounting. Be careful. Question came only once. Cunningly they planned, people asked marks. Some people, they wrote identified correctly only. I saw these answer sheets, no? They did what mistake? A derivative financial asset, they settled it in cash. Bank to derivative financial asset, gone. Last marks there. 8 marks ki 3 or 4 he gave. Just because the last entry is wrong. Why? You should understand that a derivative is not existing in reality. That's a dummy derivative. Because people are too involved in this. Derivative financial, bank to derivative financial asset, somebody gone over marks lost. Be very, very careful. So with that we are done with embedded derivative as well. So finally, there is one more example of embedded derivative that is not important, so I am leaving that, which is prepayment of a loan. And that question is not there, so you can ignore that. Whatever we discussed now, this question on this, its steps are there. You follow these steps, easily you will be able to remember all this. There are 2 cases now, sir. Either FC is expected to appreciate or FC is expected to depreciate. That if you are able to identify, rest of the story is normal. Finally, hedge accounting. See sir, hedge accounting, actually it's not very important from an examination angle. In fact, in hedge accounting, there was one question in ICAI study mat, which they removed it also, when they last time revised the study material. Why this is not important, why this is not tested till now? Maybe the reason is, a hedge accounting which is given under Ind AS 109, this is not compulsory. Optional accounting. Even for real life companies also, hedge accounting is not mandatory. If they want, they can follow hedge accounting, otherwise they can ignore. There are no questions on this. So there is no point in discussing this actually, because you will not see any application. I have hypothetical questions, I have IFRS questions and all, but that will be too far-fetched. It's not likely for exam, but as such this is not difficult. I have simplified to a maximum extent. You go through this one page, you will understand. If you don't understand, I will again explain in the next session. So with that, I am winding up our financial instrument discussion. And 107 is there, disclosure standard. Not even a single question is there. There is nothing to explain also. Whatever we studied till now, in that which items you have to give separate disclosure, a table 8 is given. In 2 pages is Ind AS 107. If you see, financial liability, what disclosures you have to give, assets, what disclosures you have to give. how much is interest income, what is your EIR, how much is reclassified from OCA section to PRL, is there any reclassification, meaning ACM to FETPL, ACM to FETOCA, this kind of disclosures you have to give, that's all. It's not difficult, but remembering this is honestly irritating also, but luckily questions are not there, so just give 1 or 2 reads and leave it, not important from an examination angle. So that's all with our financial instruments.